Hi everyone, we're going to be starting in a couple of minutes, so please could you make your way to the presentation hall for the first presentation of the day. Thank you. Hi everyone, we're going to be starting with our first presentation in 1 minute, so please make your way to the presentation hall. Companies, feel free to make your way as well. We're going to be starting in less than 1 minute.
Good morning, everyone, and I hope you're hearing me outside. Could everyone just please make their way into the presentation room? Because it's my time to talk. Just kidding. All right, so welcome to day 3 of Venture and Capital. It's been an incredible first 2 days. It's one of the things in putting these on is where I get sort of, it's a funny thing. I have this love-hate relationships in doing events and doing conferences. So the love part is when I actually see all of you networking, when I see from the investors engaging with companies, when I hear about different conversations that are taking place, when I hear about the off-site conversations going on as well. I absolutely love this stuff. What no one will ever see is how much effort goes from our entire team in bringing this all together, from the software perspective, to the promotional perspective, to the organization of the companies, to the logistics aspects. Every part, it's the reason why not many people do what we do. It is a logistical feat, it's a marketing feat, and there's just so many moving parts to it. So I genuinely appreciate all the companies that are participating, and I appreciate everyone that's attended. And as I've been saying to everyone, it's funny how much effort we go to bring people into our events. The funniest thing about what we do is the easiest thing to always bring people to is the drinks this afternoon. We don't have to do any promotion. Everyone just seems to know when they're on. So that's obviously coming up later today. So just to kick off, obviously just go through the formalities for today. By now you've been using the software. It's great to see yesterday a massive kick up in the amount of activity on the software. That's why we built it. I don't want you to leave these 3 days feeling like you didn't have the conversation that you potentially could have had. Sometimes not in the way this game works is one conversation can change the entire trajectory of a business. It can change the entire trajectory of an investment opportunity. I know for me, the entire region of Singapore got opened up to me from one conversation. And that's the power of this space, and that's the power of people, the right people networking with each other. So we designed, so my hope is that, as I said, always I've been getting some good feedback from people about ideas for future improvements. Keep them coming to us. We love those ideas because, as I said, our goal is to make this whole entire experience as seamless as possible, whether you're watching the stream online or you're with us in person. That's obviously the whole theme for the 3 days. Am I pressing the wrong button? There we go. The agenda for today, we've got an incredible lineup. Like this first panel session, I love that you get the opportunity to hear from the likes of Sean, to hear from the likes of Matt Allen. to actually hear how they're looking at generating yield from their opportunities. And I know in different markets, I said we've staged these 3 days where sort of first day had a focus on digital assets, second day was a focus on sort of technical, sort of deep tech, life science, etc. Today still has a bit of that in the sort of final session, but then also this opportunity for accessing funds and yield opportunities is really covered quite well today. And we've got some great companies that are actually presenting as part of it, as highlighted in that. Once again, when you hear the bell, just please make it easy for us to come in. So when you hear that bell, please come into the presentation room. So today finishes a bit early. I think we finish around about sort of 3:30, something like that. And then we'll go straight into the sort of networking drinks after 3:30. So, typically it's really funny. Like I said, for me, I love that sort of 2 to 3 hours when we sort of all just wind down and sort of network. We couldn't ask for a more beautiful area to have a nice sort of open balcony space that we can have our networking drinks in, which, to me will just be a nice sort of finale to the actual event. So yeah, how to get the most out of the event, as I've said to everyone, just to make sure, is anyone here for their first day out of curiosity? Okay, a couple people. The encouragement I have to everyone for these events is that you may have 5 to 10 people in your networks which are relevant to the companies that are presenting. Have that in mind. So network with the CEOs, use the software for your introductions, and then just connect. Basically said this is about bringing as many people into the ecosystem as possible. Couldn't say thank you again enough to our sponsors. I hope you guys enjoyed the presentation from Youngami yesterday. I said I love the impact that kid's having, and people that we may never get to meet or get involved, but literally has the potential to impact millions of people. Digital X, I've said enough about that because I said very proud to have an association with them. The Rocking Horse guys, so it's hard not to love Giles and his team. Leonie Hill, Binance, Latrobe, and ZeroCap. If you haven't had a chat to Praz throughout the last 3 days, please do. Praz actually used to work with WI, so he's an incredibly nice guy and he's done an incredible amount for himself, and I love that he's got this role with ZeroCap and how he's working with them. So that's it. So enjoy today. Now we're going to kick off today with me. I was giving a bit of a keynote for the first presentation. So just while we wait for the slides up, my presentation is really about, I suppose, my vision that I see for this space. Now, to me, why this is relevant to you guys is the sense that we're in this space. When you come into this space, number one, we're optimistic, and number two, we're ambitious and we're also patient at the same time. This space typically takes years to evolve. And it's funny that when we see some of the OGs like Mike Nichols yesterday sort of coming involved, we've been involved in this space long before it was popular and long before it was sort of become in everyone's mouth. And to me, it's still really only beginning. There is so much potential for this space to grow, and how it grows through people like you and me, proactively building it, proactively bringing people into the area. So this is our vision for what we see as the future of capital raising. From Wholesale Investor's perspective, you guys may not know this, but we've got a 13-year track record. We launched October 4 to October 8, 2008. If you remember that week, the Dow Jones was actually crashing 18%. We were launching. I remember hosting the launch party, and I remember listening in on a conversation where they didn't know that I was the actual founder, and someone made the comment that these guys are crazy. I can't believe they're launching this right now. They were right, but it also worked in our favor, and you find that sort of doing things in times like pretty much now where there's fear, there's plenty of fear, there's plenty of uncertainty, there's plenty of doubt, it creates an incredible opportunity, and that's what we see. Every single thing we do is about creating an opportunity for tomorrow. Every conversation that we'll have today, every introduction that I want to make, every email we send, every text message, everything we do, every bit of software we build is about creating an opportunity which doesn't exist today and sets up for another opportunity for tomorrow. That sits at the core of our DNA. Everything that we think about is how we can empower innovation, capital, and ambition. I said, if you can find one part of our company that's not aligned with those two key areas, let me know. But that is basically what sits at our core. So when you think about our decision making for what we do, whether it be pushing into the UK, where most people don't know, we've got a team of 7 in the UK now. And it's been great to watch that business grow there. In Singapore, in I think 3 weeks' time, 2.5 weeks' time, we've got over 400 attendees registered for their event. Nearly 100 of the top VCs, that are actually coming along to that event as well. I said, we've spent that time building the bridges between countries as well. It could have been much easier for me to sit at home and be a one-man operation, sending out emails, doing promotions. Said, but everything we do sits at a core from those aspects. And in fact, what else underpins that is how we can utilize technology, platform, and partners as part of that process. So as a final component, everything we're thinking about is the enabling of cross-border collaborations. What is nice is every single one of you potentially have people in your networks that are now based in the US, that are now based in Singapore, that are now based in the UK. The idea is how can we actually make this more open, make this more visible, and make this more sort of relational across those different cross-border opportunities. The other thing most people don't know, I've had 10 of our clients achieve unicorn status in that time, which is incredible. There isn't actually that many sort of VCs or investment groups in this actual region that have been able to achieve that just from us providing our service. Yesterday, you guys would have seen an announcement about, I think it was Mike Cannon-Brooks or Scott Farquhar, one of the guys, doing a deal with Gen X Power. We literally had them on sessions that we were doing a few months ago. But actually we've been working with Gen X for years. What I love about every company that you see out there today, for me, they're the examples, whether they be the yield companies, whether they be the fund companies. One of the companies that we work with that people know is Folkestone that ended up getting acquired by Charter Hall. We worked with them when they were a 20 to 30 million market cap. To me, when I look at the companies that are presenting today, they're the future ones that are going to be making the headlines. They're the ones that are going to be doing the announcement of deals. We just get an incredible opportunity to see them years before most other people get to see them. And a lot of people in our ecosystem, been with us for years, would have seen those actual stories play out. Now, of course, it is the innovation space, and not all go that well, but that's how this space is, But effectively, we're seeing now, I think, 68 exits in total. Typically, when we deal with investors, the common thing that you guys are asking for us is, I want you to introduce me to the good deals. And my comment is always the same, is I don't know what your version of a good deal is, because everyone's got, basically this is a marketplace. And that's typically how it operates. And then every company will come and say to us, I want you to introduce me to the good investors. And then my feedback's always the same, is I don't know what I said, I can introduce you to good investors, but that doesn't mean that you're relevant for them. And that's what really drives this space. And then there's a fundamental question that we have, is how can we actually facilitate the scaling of capital raising? Like John Sharp yesterday, everything he thinks about is how do you scale investing? Everything we think about is how do you actually scale capital raising and then remove friction from the process? So from the software perspective, how do you save time, save money, improve efficiency? That's the principles from our decision making. And then the last part is how do you do it globally? And you'll see that in the next 6 months for us with some of the announcements coming out. So this is, I showed this internally to our team members, and now I show it to everyone, because effectively this was the actual issue we had as a business, right? In effect, that you can't scale doing this. You can make it impactful and meaningful for people during 3 days, but it's incredibly hard to scale. So for the last 3 years, we've been working diligently on setting ourselves up so that we can actually scale what we can do from a platform perspective, and then have what we do in person as a complement to what we actually do online. And effectively, this period that we've been in is effectively this transition period, really for the last sort of 3 years, as we just make the incremental steps. And that's not easy to do when you've got a business that's fighting things like COVID and also going through these periods as well. But also at the same time is in growing our team, introducing into another country, etc. And then also we acquired our own AFSL as well. So all these things take place over a period of time. But to me, that's such an important milestone for us, because effectively in the next sort of 6 months, we'll be able to break out of that sort of area of transition for us because of some of the implementations we will make from a platform perspective. Now, our version of how we see the problem with our space is that effectively it's super inefficient, right? And it's actually, most of it's actually manual in the way in which people operate. And it's like, I know Dan, so I get an introduction and then now I can have another conversation. Whereas to me, that's pretty much capital raising 1.0. It's who do you know and who can introduce you. For me, I see our version as sort of capital raising 3. But effectively, if you look at this, this whole process is inefficient and it's very frustrating for most people. It's one of those things where it sits on your shoulders and you don't know what an issue it is until you actually don't experience it, right? And then you understand what it's like to do something different. And for me, when I see our solution, I said, it needs to be software driven. It needs to enable the ecosystem. There needs to be intelligence on both sides, both for founders and also investors as well. And to me, the other part is the whole thing needs to be integrated. So our position is that vertical area of sort of capital raising and venture investment needs to be completely aligned to actually assist the ecosystem to grow faster, because the ecosystem can't scale as fast if it's reliant on mate who knows mate who provides introduction to other mate, which is typically how it's been done so far. And if you look at the elements of our investment into AI, if you spend any time with me, you'll find me introducing you to someone, right? My brain is a natural matchmaker. So we thought, how can we actually deconstruct what happens in my brain naturally and then overlay that across a platform perspective, utilizing the data that we've been able to capture for the last sort of 9 years. That's got some relevance, and then the data which we are able to capture going forward. That's how we've thought about our AI and ML. And I'll give some examples to that. And the funniest thing about this space is it's so driven by transaction fees. You know, my belief is you'll see over the next sort of 5 to 10 years that the platform approach and the subscription approach will become the actual dominant force as the market starts to change, and also as the generational trend starts to change in this space as well. And we've seen that with every other industry. So how we operate, as I said, is as a subscription business. And then the last part is making sure that both advisors, investors, and founders have the tools, because the beautiful thing about investors, and you guys know this, is that one day you're buying something, one day you're investing something, and one day you're selling something else. Everyone's always wearing multiple hats. No one's ever just wearing one hat in this space. Or you may be an industry participant, and you could be a lawyer by day and you're investing into private companies by night. Everyone wears multiple hats. So it's really about making sure you have the tools to be able to do that. And everyone makes these things feel so complicated, whereas really software can make it efficient for most people. So this is what we think about from the integrations perspective. And most of these we've actually done and got the capacity for inside the platform. The SME debt part, to me, is the next area to provide, because effectively what we've built inside Crisp is effectively just a capital hub. Like, it's just a way for organizing information in a way that relates to how people, you know, for capital, whether it be equity, whether it be debt, whether it be grant funding, it's just a mechanism for that process. So when we're speaking with investors, the common elements that investors are chatting to us about is, firstly, they want access to opportunities. And then when they get access to opportunities, they're like, oh, I need help with relevance, right? Because for someone like us, where we're working with 300 to 400 companies a year, sometimes then they need help with the actual sorting mechanism. So then it's about deal relevancy. Then the next part is how do you actually streamline and standardize the process? Because it's very difficult for you when you're getting information from all sorts of different directions. You know, how can you actually keep track of that? And the last part is the speed to action. I remember it was a family office that told it to me that once they actually engage with a deal where they're mentally locked in and want to pursue it, for them there's like a ticking timer. What are those things called? That's it. It's like an hourglass that's counting down, right? And it's the time for information. And you have no idea how many stories we hear about investors that just decide to not go with companies because of the lack of speed in which they get information. So, and this is typically the areas that investors have reported to us the frustrations. And what you don't know on the other side is we're spending so much time educating founders on these aspects of whether it becomes communication, being ready, being prepared, etc. Right? Because as I said, the whole idea is we want everyone to have a seamless experience in the process, which means we have to work on both sides, both the companies and the actual founder side. And over time, and you'll see this, and this, I said, I'm very pragmatic in that this takes years to change. This space was very much driven around transaction, transaction, transaction. Show me a pitch, show me a pitch, show me a pitch. Everything we want to communicate to people about is about building relationships over time, right? Because ultimately, investments in private company, I always make the joke that it's actually sometimes harder to get out of a private company than it is to get out of a marriage. right? And so, it's understanding that it is a relationship between two people. And so that part's really important from us from the relational side, but of course we want to encourage that investment activity as well. So therefore, preparedness is a key part to it. So for me, this is what we've sort of worked towards in how we think about things. And from a platform perspective, sorry, I forgot to mention about the sound, that when I think about this as a product, I said this has been 3.5 years of working to this point. So when you actually go onto the web app, every single part we've tried to think about that's really got an element of all those principles that I've talked about beforehand. But that personalized deal flow is the key thing that I want people to experience, because as I said, I can't recreate myself 1,000,000 times to actually do that. So it's like if I can provide personalized deal flow every single time an investor logs in and make sure it's relevant to them, then that's important. If companies can be providing product updates, investor updates every time an investor logs into their platform, that helps the opportunity keep in front of mind for investors. Not what was traditional where send pitch deck, get rejection, never hear from the company again. When I interviewed Jason Calacanis, he had the best stat. I asked him, because he says at the end of every rejection, he says to each company, please keep me updated with your progress. And I asked him how many companies actually update you with their progress of their business. His response was low single digits. And I found that really important. So we actually built, and I'll show this in there, we actually built investor relations into it. So for me, when you actually log in, the idea is when you see that recommended list, it starts out, as preference. The deal relevancy part starts out as a preference matching because it's sort of what you're looking for. Then the second part is the more active that you get is it starts to become more personalized for you, because what we've found with you guys as investors is there's what you say you're interested in, and that's what you'd select in the sort of pre-settings, and then there's what you're actually interested in. So we'll have lots of conversations where someone's like, I only want businesses that are generating revenue, they're doing this, they're doing that. And then I ask them, which company is most interesting to you? And they tell me about a life science company, that may not be generating revenue for the next 10 years, right? And that's the weirdness about this space, but that's also what makes it beautiful, right? And sometimes it could be personal reasons as to why they're interested. Other times they just have a change of thesis during the course. And that's what's important about that deal relevancy part. Sorry, sorry if I'm just shining green lights in people's eyes. The streamlined process is also important because I want you to get access to your information as fast as possible. So we make that, so everything we've thought about from a future perspective is how to actually streamline that positioning. The FAQs, right? Once again, you've already got questions that have likely been asked by other investors. This frequently asked question management tool is so simple, but yet it makes such a difference for you and also for the companies as well. So for you as an investor, you're seeing the questions which have been most asked, but that most other investors have looked at previously. For me as a founder, I'm getting intelligence on what's important for investors with my opportunity. I never had that before. 3 to 4 years ago, I never had that. And funny enough, it's amazing how those questions can help shape the strategy of a business, right? Because what's hard thing about a founder is we're so locked in on building our businesses, we don't have that helicopter view that you as an investor typically have. And sometimes these questions actually help us get perspective into your helicopter view that you have. Auto-filling out share applications. I know it's one of the frustrations for this space is actually just the simple filling out of applications for it. So the fact it can be preset is something that we want to streamline. Or uploading your own share application if it's, if you're in a different region or so forth. Storing the venture transaction online so you've got recall for it at any time. Simple things like this make a difference, right? Rather than, of course, most people have their own spreadsheet. We also use Cake. Right? I think Cake's an incredible simple service for any founders, with their business. We used to use accountants and it's just a nightmare, the registry part, whereas they've basically solving the pain point for people on the online registry part. So Jason and Kane and his team have done an incredible job with the Cake software to actually do that. The investor relations part is super important as well. And he said, we've created a simple little dashboard and a simple little communication mechanism. I sent out a message to my networks this morning just talking about the software aspect. I said, we're trying to what happens is that when you're building a business as a founder, sometimes it just all builds up too much. But it all builds up, and then people stop communicating because it ends up being such an effort, where we've just tried to make it really easy for companies to do that. Sharing good news. Often companies get covered by media, they get featured in different industry publications, and they don't tell anyone about it. We wanted to simplify that. The messaging software. Most of you would have probably had some sort of messaging over the last few days. I said we've just redesigned that. Literally, we launched that about a week ago, that redesign. That's designed to actually streamline the communications. In fact, for the deal makers in the room, that messaging software actually can cover multiple deals at the same time as well. So not only your own room, but you can actually have, if a corporate advisor working across 5 to 10 different deals, that's all centralized in that communication point. So it's not just for the private, also in the future we'll be having conversations with the advisory side. And then obviously the conference software, I won't spend too much time on that because I did that yesterday. So look, here's some of the things that we're building that we think are important to sort of, the future of what we're building, and then also this space as well is firstly the integration. One of the big frustrations we've still got running 2 sites effectively, the Wholesale Investor site and the CRISP site. In the next 2 weeks, they will actually be integrated. With the AI matchmaking, it's actually one way at the moment. It's for you as investors, sort of founders. We're actually working on the data aspect for the other way as well, because we as a company firstly want to understand for future introductions who's the most relevant investors for companies, and then facilitate those introductions as well. Because we understand you're busy and you may miss some deals in there, but as I said, we're always going for that 1% where we want to make a right introduction. Project X, I won't talk about at the moment, but that's a massive transformation for us, and will actually become one of the key foundations that we build our global opportunity off the back of. And then also, over the next sort of 12 to 18 months, a potential enterprise or white label version of the platform, because one thing we've proven is how to actually run deals at scale. So we want to make the software available to other groups that also run deals at scale as well, because effectively they'll be able to make their own internal processes a lot more efficient. So I've got 1 minute left, so I'll quickly go through the opportunities with WI. Obviously, the collaboration with the Wholesale Investor team, working with your investee companies, working with companies that you're working with, and also working with directors about setting up for future raisings as well. One of the challenges for us is people typically come to us when they need us, right? Whereas we want to actually get people set up 3, 6, 12 months in advance. Investment opportunities, obviously, we provide the opportunity for investors to invest in us as a company as well. So I'll be mentioning more about that over the next sort of 2 to 3 weeks. And then also the HNWI ANZ Fund, which obviously John Sharp presented yesterday as well. So we provide an opportunity for investors to invest into that. And then we've got our model for investing into some of the best sort of incubators and accelerators in Australia, and then obviously supporting those investee companies. I won't go too much into this, but just want to simplify that. From a foundation perspective, every bit of the foundations we've set up relates to, we've got an incredible 3-sided ecosystem, which you guys have experienced over the last 3 days. Obviously a recognized brand across Australia, Singapore, and the UK. Our own distribution network, which is super important. Media and production capabilities, which we didn't have 3 years ago, but now you can see it between the streaming and everything else that we actually do. And then obviously the software aspect. So from those key elements, if you can get a picture as to what we see the foundation and the future of this space, it is a lot more content driven, it is a lot more software driven, and it is providing opportunities for engagement online and then also the offline aspect as well. So that's a summary for me. There's my details. Feel free to add, I put in my LinkedIn name on there. Feel free to add me on LinkedIn. Obviously, I'm in the software as well so that you can message me, and said happy to have conversations with people throughout the day, and obviously happy to make introductions for investors to our clients as well. So I've gone 1 minute over, so apologies for that. So on that note, I just want to say thank you very much for the opportunity to speak and tell you a bit more about what we see as our vision and future of this space, and a bit of an insight into some of our plans for Wholesale Investor. Thank you.
Thank you, Steve. So first of all, today we have our panel on the hunt for yield. Here joining us is William Fong from Zero Cap, Matt Allen from Tractor Ventures, Sean Fox from FOXI Group, and Chris Pack from EG Private Wealth. And we also have Peter Baker from Unhedged. Sorry about that, Peter.
Got me? There we go. Hi, everybody. So, the hunt for yield. I don't know about everybody here, but when I saw that, I was hoping that we'd see lots of whips and hats and adventurers sitting up here. But don't be disappointed. We've got an amazing collection of people here from an exciting background to give us their opinion on yield. What I'll do is I'll do a bit of an introduction for everybody that's up here first. So we have Matt Allen here from Tractor Ventures. Exciting company, helping tech companies fund them, also giving them strategic advice. And you've got a fantastic history yourself. I'd say definitely a dedicated entrepreneur, software developer, serial investor across a broad spectrum, but a lot in the tech space. We've got Peter Baker here from Unhedged. We keep running into each other at all the events, but working on the next level sort of AI software platform. Passion of yours, healthy, unhealthy, since about 2012, I'd say, so you've got a lot of time on the clock. We've got Chris Pack from EG. So we've got a good 28 years worth of experience here in property, investing, in commercial sort of retail and strategy. And then we've also got William Fong. Sorry, William, I didn't have you on my list to do some research on you. Can you give us a quick, brief background on yourself?
Yeah, definitely. So you can call me Will. Basically, I look after the treasury and the OTC trading for ZeroCap. You might have heard of us recently through media outlets. Basically, ZeroCap's a Melbourne-based company. We're literally a cryptocurrency investment bank and asset management company. We are kind of well known recently because of our collaboration with ANZ Bank on generating the world's first ecosystem for bank-based stablecoin and real-world usage of that stablecoin in order to create a Aussie dollar digital currency conversion into USDC, and then using that to purchase tokenized carbon credit and moving along the ESG to save the planet. All Melbourne companies, basically. We've got Beta Carbon here today. We've got ANZ, obviously, is headquartered, a world institution based in Melbourne, and so is ZeroCap.
Fantastic, thank you. So we have, and this is going to be interactive, guys. I am going to ask for questions at the end, and you guys are definitely a super vocal group, so think that through for me. But look, we've got an amazing collection of people here. So we've got property, we've got the current sort of integration of blockchain into the world. We've got funding on a base level to technology, and we've got AI algorithms in here. So Steve made a fantastic comment before. When talking to investors or people say, they're looking for great returns, it's all relevant to the people, right? It depends on what is your definition of great returns. And we're going to run this as a conversation, guys, like talking amongst yourselves as well. But who wants to start? What does yield actually mean for you in your industries or personally?
We're probably pretty simplistic from the perspective, we're a very data-driven real estate investor. From that, we've evolved into prop tech and then moved into fintech. So our investor base can do everything from, our major success in the prop tech would be Willow, which does digital twins of buildings. Now, there's got 16 offices around the world. Nicholas Moore, the ex-CEO of Macquarie Bank's now the chair. And so getting those insights help us make better decisions. Last year, for one of our clients, we bought half of the Queen Victoria building. And what we do is that insight that we do in doing major investments, we provide to our property syndicates. So whether it's a $10 million deal, our largest last year was $1.1 billion deal, it is still the same methodology and detail that we go through. And from that, it's about providing yield to all our investors. So for us, it's pure cash yield distributed to them. So it's pretty simplistic.
I love you said simplistic, like it's, but there's a lot in that.
I might jump in. So at Tractor, we let the VCs do the rockets, and we provide revenue-based financing to tech companies with dependable recurring revenue, and we share a top line rev share to get our loans paid back. So we believe that yield from our perspective is a monthly yield, and these tech founders who are building these amazing growing companies with very diversified customer bases themselves, who may not be wanting to build the next Atlassian or Canva, but still have a great company, have always struggled to get capital into their business to allow them to grow faster. And the massive opportunities for us as investors to be able to support them. So we have a very large debt warehouse that we've paid some pretty great coupons in, and lend that out into our revenue-based finance product. We've built a big software platform, which is taking variable payments from software companies on a monthly basis is not an easy thing to do. So we built some tech to make that easy. So we're scaling that up, and definitely, the difference between locking up your capital in an equity investment in a 10 to 12 year horizon, hoping to get 100x versus getting some yield on a monthly basis is an interesting thought process when you look through the technology lens.
That's great. So you're looking at that just strong, performing, revenue-generating sort of infrastructure type tech companies. That's great. Yeah, so stability.
A lot of them are quite boring, and they look niche, but they're not. They've got customers around the world. They've got revenue that goes up into the right most months, and the VCs may not be super excited about them, but we are.
That's great. That's it. Money, right? That's good.
Yeah, for unhedged, it's a little bit different. What we're looking at is that there's a very portfolios used to be very static, right? So when people build a portfolio of yields, then they are married usually to an asset class, or they combine asset classes and want to create yield there. So we are using a more flexible approach. So we have a yield portfolio that basically is algorithmic traded. And that means that although we hold them on average like 18 days, we are far more flexible when we look at the yield curve, when I look at events in the world, that we either go up or down the yield curve and up and down the risk curve. And that means for us that, for us, yield is an algorithmic game, and which is a different approach than most people, because most people just want to have a sliver of that pays yields. We approach it from a different way. We say, well, this yield is more risky now than that yield, so we'll switch. So that's how unhedged sees it.
So you're looking for that movement in the markets. You're looking for that sort of growth, change, a little bit of instability.
Well, yes, but for example, now the interest rates go up, right? So why would you keep a static paid bond? Because the bond will go down because the duration is fixed and the yield is fixed, right? So at the moment, it makes more sense to go to mortgage-backed securities, where you go to the tranches that are variable.
So keeping agile in the markets, that's great.
Correct.
Will?
Yield, return on investments, probably the most important element in day-to-day life of zero cap. Because what we do is continuously looking at correlation between the real asset world, or the traditional asset world, fixed income, equities, property, venture capital, versus the crypto space. How we could help investors, family offices, high net worth clients, institutions, migrate some of the portfolio allocation into the crypto space. What do we actually look at the correlations, and how do we enhance the portfolio without increasing beta, without the element of ultimate credit risk? Of course, there's always going to be market risk, right? And people go into this portfolio allocation, most of them understands there's element of volatility, there is market risk associated to it. But how do we actually measure the market risk respective to the return on investment in a portfolio allocation that allows that increment without reducing or increasing the overall delta risk of the whole portfolio? So yield to us, it's almost bread and butter. Every day we're harnessing volatility, we're trying to move, take out the credit risk associated with the crypto space, counterparty risk, et cetera, and how do we actually net down and filter out and reduce it to the point that we could recommend to our clients?
That's great. You've actually led me into my next question as well, Rich. You've got both feet in this next question, and it's how to protect that yield, right? How to actually future-proof or plan for, especially now. Like, look at the huge amounts of instabilities in the market. We've got heaps, right? Just pick one, throw a dart. There's a whole stack. We've got crypto winters. We've got recessions. We've got war. We've got famine. It's all there, right? So the question is, you did a really good job of already answering that. Is how do you guys future-proof against it? How do you sort of set that marker? And what are the secrets behind it? Do you have a guru or a Ouija board? Like, what are we looking at?
For us, it starts with interviews with tenants of the buildings we're buying, understanding what makes their businesses work, doing credit reviews of them. Because at the end of the day, that lease is what you're banking on to do your distributions. How much can they afford to pay for rent? And making sure that it's sustainable, therefore. And then the other benefit is that we've obviously got fixed increases. And I think with the evolving market, having inflation-linked leases with the volatility of inflation, that's kind of buffering it out as well. So, but it really comes down to credit worthiness of our tenants to pay rent every month so we can do our distributions.
That's really clever. That definitely comes from that 28 years of experience and retail strategies that you have. We can see that shining through.
Yeah, from our perspective, we've effectively built a credit and risk engine that can take a forward position on recurring revenue, non-tangible asset businesses, which is not many banks can do, if any. And the team that's done that, I actually have 5 guys on my team who are ex-Prosper that have done this to the tune of several $1 billion. So we're using a slightly different asset class, but that 1,000-point risk credit score is what we're doing and continually iterating and testing on to try and take a relatively risk-adjusted position in the future of recurring revenue.
That's fantastic. So just using solid backgrounds and experience in there to really sort of proof it up. You definitely have a wizard in the cupboard, right? You've got what have you got?
We have a number of PhDs that are... they actually came to the startup space because they were fed up from working at big banks. And so 2 of them come from Goldman Sachs and 1 of them from Baronia. And these guys are just absolute wizards. What we found is that, especially when you're looking at hunt for yield, that you can't forget the macro picture. And I know that's for Matt as well. Matt must see that if the macro changes, the micro will change as well. And so what we are trying to combine is basically alternative data with trading data. And one of the things that we are working on now is a lot of blockchain data. And we don't use blockchain data necessarily to trade blockchain assets, but what we have found is a way to be able to determine whether we want to be exposed to the blockchain sector. And so we are basically launching now an algorithm that uses the blockchain data and all the miner behavior and all the yield behavior of the whole sector. And then we buy companies like Coinbase, Silvergate, blah, 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 that have their balance sheet exposed to Bitcoin and or to crypto in general. And what you then see is that what we've seen is that in this game of yield, it's very important to use alternative data that's not directly related to price, volume, fundamentals. And I'm pretty sure that you guys use a lot of other data sources than the numbers, right?
Shall I go?
Oh, I'm going to lead one to you. That's actually interesting. I had an image in my mind then back to the adventurer part of the hunting this, of the alternative information of you guys opening like trash cans and pulling stuff out and getting deeply involved.
Satellite pictures of heat exhausts of iron smelters, yeah.
That's great. Okay, we're getting right into the adventuring part. So I'm going to lead another question because you absolutely answered the question the first time around, and this one's in the wheelhouse for you as well. So guys, the absolute, I'm going to say the emergence of blockchain, right? But it came in like a freight train. It's like it's been with us for the last 3 decades, is what it feels like. And how's that, it's definitely for you, but how's that playing into your investment methodologies and looking for that yield, and also staying ahead, particularly with property, right? Because there's a lot of blockchain that's happening out there. How do you stay ahead of that curve, but you can.
This is quite interesting because I was just listening to both Matt and Peter, and I was thinking, wow, this is, that's something we've been developing in-house for a long time. So basically, we've got a research team and a credit analytical team within the house. And the research team looks at historical macroeconomic information, blockchain data, etc. We analyze it and put it in a big picture, basically. And we try to forecast how the portfolio investment climate will actually evolve. Our credit analysis team, it's probably more related to your second, the question you just mentioned, is that we've actually tried to replicate a Moody's and S&P credit agency in-house. I don't think there's too many that's attempted this explicitly, but personally, I used to be a credit portfolio manager, and every day I come into the space, I look at ratings, I look at jump to default ratios, I look at CSO1s and all those things, and I've noticed none of that actually matter in the crypto space so far. No one's been looking at it. No one's looking at counterparty risk. No one's looking at counterparty leverage, the use of funds, anything like that, right? It's like 30% yield, that looks good. Here's the money. But we've been a bit more conservative. We've been a bit more stringent on our, how we actually look at client funds, how we actually look at portfolios, and how we look at the lending space. Now, I would say that in cryptocurrency asset management for the last 3 months, market risk is no longer the topic, right? It's credit risk. Because most of these altcoins has dropped 80%, right? If you believe in the protocol, you've done your DD, what does market risk matter, right? You allocate 2% of your capital into it. So what if it goes down under 50, right? If it's long-term investment, if you're into a VC, that's beautiful entry. But can you get your money back? That's the issue, right? All these big topics coming out, $10 billion hedge funds, suddenly put down a draw gate. And you're going, whoa, draw gate, hedge fund, 2009, all over again. What happened?
It's return off capital, not return on capital.
We should talk afterwards.
That's fantastic. So I'll just comment on that for a minute. And it's such a great, unique perspective here, because we'll get perspectives from everybody on how blockchain's affecting their industry. But to have somebody in blockchain, but then what the effect of blockchain is on that industry itself or the crypto markets. And you're absolutely right. Being ahead of the curve and seeing what's happening, because that's where it's moved to. It's all traditional format with a new face on it. But nobody's been doing that yet, right? It's like being in the 1920s and just going, oh, I see what the next 100 years looks like. We can start building.
I won't grab the mic for too long, but there was one interesting fact that in May this year, for the very first time in the history of cryptocurrency, we saw that an event risk came from the crypto space and moved the entire S&P NASDAQ, right? During the terrorist collapse, basically shocked the entire world of asset management. And I've never seen that before. Right, and I believe that it shows the world crypto matters. And it's not going away.
No, that's very true.
I'll take my slightly more controversial perspective.
Perfect.
As a first half of my career as a software developer, every time someone says blockchain, I think database. I think slow public database that a lot of the use cases out there who are being presented should be in an actual database for a whole bunch of reasons. And I think that it's really interesting to hear, I'm going to use the derogatory term of normal people, talking about a piece of technology that has obviously use cases to do a bunch of stuff, but there's a bunch of bad shit that shouldn't be out there.
Yep.
And it's to that point, I think the signal to noise ratio out there in crypto space is extremely difficult to unless you've got a lot of time to try and decipher. Maybe you need some abstraction layers between the actual stuff and what you're putting your money in. But from my perspective, also it feels like lessons being relearned. Like you just said, reinventing the wheel. It feels like we may be raging about our financial system, but there's a bunch of reasons things happen in it. And just because you don't like the reasons doesn't mean you should start again.
Absolutely.
Yep.
And you've tied that together perfectly, and with what Will's doing there, and looking at that and building that, that just taking simple credit risk policy to, I don't know, a $3 trillion industry that doesn't have it yet. It's like 15%.
There's something interesting about crypto. What I think is interesting is almost counter. I mean, I'm on both sides of the fence, but one of the things that I really think is remarkable is that the crypto industry only borrows to the crypto industry. And you see really little spillover into real finance, into finance of mortgages. So how I see this is, as long as the crypto industry is playing with itself, as kind of a masturbation in finance, I don't think it will go really hard to the real economy, because the real economy in long term grows at 4%. If you take risk above 4, if you want more yield than 4%, you take risk. If you have an industry that only borrows to itself to generate 20% interest, then you stack up risk.
20% is probably for a reason. But, for us, we're looking. EG's got its own, or had for a very long time, its own proprietary risk system to try and remove the emotion of a deal. Everyone loves a deal. Real estate people are probably even more prone to that, and so we actually go through all the assumptions and use those different data to actually remove the emotion, because the deal team is, driven to try and do a deal, and as a CIO, my job is to actually just sit there and go, okay, let's just break it down, and all those alternate data sources, and whether it's logistics, where you're looking at toll roads, container movements, all those different data sources are important about it. Mobility data, about really are people going back to the office, all those different data sources, we need to look to really inform us to, where is the best place to put the next incremental dollar, because, there's so much data, we actually need to work through what's the best decision.
And how's blockchain coming into the methodology for you guys as well? Like, what are you seeing on the horizon there? Yeah,
look, I think all of it comes down to weight of capital and movement. So for us, it's something that we need to look at where financing is going and real money. So for us, it's about being open to how we can actually interact with it, because real estate's very traditional. You have a lease, you pay a rent, we distribute the rent to our investors. So it's definitely something that we are really conscious of.
One thing that's really interesting that on the blockchain, the anonymous, the decentralization, what's a bug worth, what's a feature? So, we live in the land of securitization, fancy word for debt. The last thing you want is an anonymous rando on the end of the debt that you've taken, because they've got some pretty significant levers they can pull on your business. Yeah. So the anonymous abstraction part of it is actually, if I was a borrower, the last thing I'd want is to not know who I took my money from and not know the person who's sitting in between. So it's interesting that what is touted as a feature quite often, I think presents itself as a bug depending on which side of the equation you're on.
Look, absolutely, and I think what's been great, because I've been spending a lot of time in America in the conversation there, and that movement and the qualifying what DeFi sort of means now, which is great, and it's gone away from that people wanting that super anonymous, living in a cave in nowhere, and now it's just they're wanting to just remove and just go peer to peer is kind of what DeFi means now. Lose the brokers and get out, and seeing the involvement of the SEC in that conversation now, like this former chair of SEC running a blockchain company, and the movement into that regulatory space.
So here's an interesting thing. I think the bigger the transaction, the more likely that someone actually wants a person in between. So the people we hate, being real estate agents, car salespeople, things like that, there's a reason there's a person in between a lot of the time, which is it's infrequent for one side of the equation, and it's highly emotive, and it's a big ticket a lot of the time, and they don't do it very often. So having these distributed DeFi protocols is all well and good, but there's still a thing where I think people want some hand-holding a lot of the time.
You've actually nailed it, and I saw it firsthand over there. And I met with a lot of guys who have a lot of coins and a lot of exchanges, and the reason it's moved and yield, right? They've all made yield. They all own like a Bugatti or 7 Maseratis, or and they're 26 years old. I'm seeing it over there now. They want centralization because they don't want to lose their Bugatti or their Maseratis, so it's the conversation has moved, and that's with what you're doing is
This is interesting. I love this panel. Basically, they're giving me a lot of ideas on what we're doing. ZeroCap, it's basically the bridge between traditional finance and the new world, or the new emerging world. So you talk about how there's limited trust, obviously. We've went from obviously GFC, too big to fail, everything that we don't want, debanking everything, right? Went to the space where it's almost like a tech bubble 2.0, right? We saw everyone jump in, try to take advantage of it. And once again, we had all these people who's migrating and taking advantage of leverageness, of people trying to get out of centralization. And what we're seeing now is 2000, once again. We're shaking out the bad blood, right? What comes out is going to be Amazon, Facebook, Google. They're not they didn't do anything wrong before 2000, but it wasn't something that, it's evolution, basically. It's how we actually progress. And to the point of, if you say that the cryptocurrency space has not had involvement or lending by itself, I kind of slightly disagree. Many banks has been taking advantage of the high yield with the crypto space using stable coins for almost 12 months plus. Because let's say the LIBOR curve, right? We've been trading on a LIBOR curve between 0 and 30 basis points for many, many years because of the quantitative easing, zero interest rate policy, central bank money printing. So what better than for a bank to borrow at LIBOR at 30 basis points and lend on a stable coin for a 10% annual return without a currency risk? It's the credit risk that matter. But who's better to be able to sit there, except for a bank, to move into this space and own piece of that credit?
And I think you're right, because that's where that movement, we're seeing a lot of that movement in space. Guys, we've got about 4 minutes left, and I did say I was going to offer questions, but I'm going to hijack that. But feel free to ambush any of these guys for any specific questions on the way down. So look, we're fund managers, asset managers, interested investors, right? And we're at the point right now where people make money, right? We are in this crypto winter. We are in a recession, or, the quote of, blood in the streets, right, is where money's made. Guys, what are you, whether it's with your company or yourself, what are you guys, like, 'cause I know I've got my peepers on a whole bunch of stuff at the moment, but what are you guys looking at right now for opportunity as we're entering into probably more darker days of spaces? What are you looking for?
I'll jump in. So, as it turns out, Tractor's about 18 months old. For the first 12 months, we were telling all the founders that, selling equity is really expensive. The return people want when they're backing your company early is really expensive. We've got this relatively cheap source of capital over here. So our competition is expensive equity. Now it's really expensive and really slow. So as the VCs sit on their hands and, I'm going to say their backbones shrink even further, and not being able to actually have any conviction, that founders are now actually realising they don't want to sell their shares to people. So I think the opportunity here is actually a little bit of education lag, even when things come good again. VCs can't sit on their hands forever because they've got a big pile of capital they need to get out, a couple of quarters maybe. Is that founders actually go, well, hang on a bit, if I can build a great business here, I may not need to sell these shares forever and a day and sell 20% of my company every single time. And I think there's be a flip here, where great businesses will fund themselves differently.
That's great. So as the market sort of shrinks, or big institutional sort of firms pull back for deployment of capital, that's where there's going to be a glut in the market. Who's next? What do you got?
For us, logistics has been super hot just with supply chain and the pandemic. So we saw people globally aggressively buying logistics assets. We've shown price discipline. Those that overpaid, we're here when they're due for refi to see what we can buy at a reasonable price. So I think those that aggressively bought over the last few years, as well as we're seeing those that are having difficulty getting funding. For us, it's about watching deals fall over and seeing, actually, can we opportunistically buy them at attractive prices in a less competitive market.
This is definitely the market for property at the moment. And I'll come and see it because I've got some of those things I overbought and paid for. So
For us, it's a really interesting time because we we launched really at the top of the market, I think by the day. We just chose the top of the market that day we launched. And that means that we saw most of our competition, like Spaceship and Race, shed 30, 40%. They destroyed hundreds of millions of dollars. And we didn't. And what that means is that we suddenly have now a pool from other asset managers, like what can you do for us? So while we started as a B2C business, we're probably going to ramp up now the B2B2C, because the skills we have in quantitative investing can actually be rented out pretty quickly to other players. And so for us, it's a I call it a blessing in disguise. But yeah, no, it's really
This is
good
definitely
for
the
us.
market for you guys, like everything that's about to happen. And Will.
Okay, so even with recent retracement asset markets, there's still roughly about $80 trillion in the world of equity investment. It's over $100 trillion in fixed income. So basically, crypto space is only $1 trillion at the moment, market cap, right, roughly, very small relatively. But we are offering a lot of opportunities with this space, as long as you can mitigate and done the right DD on credit risk, right? For example, if you look at the volatility on the S&P 500, VIX is still trading at extremely low level relative to anything that could be offered in the crypto space. But in order to mitigate through the counterparty, we can actually push past basic borrowing and lending or leverageness. We can look at the optionality, derivatives, structured products, and all the harnessing of volatility, which could generate a yield without the full impact of counterparty risk. Now, some of these derivatives and opportunities are only offered for institutional and well-known insiders. And that's where Zero Cap comes in. We're basically offering all these products, and we've done the homework for you, right? We're saying that, we've gone through the credit assessments, we've done the market assessments, and we're saying that this is the risk, this is the opportunity, and this is what you need to do. Come through the journey with us, and we'll hold your hand through the new world.
That's great. And so, guys, look, that's the end for the hunt for yield. And you've seen from our adventurers here and the mindset and the methodology that goes into it. I'll leave this one thing with you. As a professional investor, the one thing that we don't want to do is buy high, sell low, right? That's the number one rule. That's what makes the market for us. Everything's low now, so don't be afraid to get investing now. We will see the big institutions sort of pull back a bit because they've got to keep cash positions in case they have to do bailouts. They've got a lot of different industries and businesses that they're committed to, so that's the reason why they're pulling back. But for now, and especially as you walk around this room and you're looking at the different opportunities that are here, this is when you make your money, right? So this is when you start deploying money and putting it in. We started getting prepared for something like this about 2 years ago, and a lot of the big firms will, right? They'll start pulling back. Look at Berkshire Hathaway, right? Just watch him. Whenever he's holding a lot of cash, start hanging on to cash, right? He's about to go on a buying mecca at the moment. So the hunt for yield would be in this room. Go out and have a chat with people. Honestly, ambush as many of these guys as you can and get some information. Now, guys, this has been a great panel. Thank you so much.
Thank you so much for coming in, guys. That was fantastic. So for anyone that wasn't here for days 1 and 2, I just wanted to remind you that you can use your headphones, and there's some headphones at the back if you can't hear what the speakers are saying or if you want to walk around and listen. So please do use them. We are going to be announcing the final investor draw at the drinks tonight. So you just need to have registered for the event, have your full account set up on Crisp, and you could be the lucky winner of a luxury bottle of wine. So to start off the next session, we have one of our key sponsors here today, Giles Karkan from Rocking Horse Finance.
talk to you about what we do at Rocking Horse. We've been lucky enough to work with Steve and the team here for a long time, actually. We've got very complementary businesses, and Steve and I were going along a very similar path for a good 7 years now. So it's exciting to see what Steve has been able to do with Wholesale Investor, and we work with him here and also in the UK. So it's fantastic, and it's great to see the turnout here today. I'll just talk quickly about what we do, and I'm the founder and also CEO of Rocking Horse, and we provide debt against R&D. So basically, we are able to provide debt against R&D spend that companies, especially smaller companies, loss-making, can continue to develop their product through to commercialisation. Okay, I don't think the presentation's going, no. All right, I think we might. All right, you might just have to listen to me for a few more minutes. So basically, we can provide the finance so that companies can continue to spend on R&D. So we started about 6.5 years ago. Okay, we started about 6.5 years ago. We've lent to over 500 companies in that time. We're really agnostic to ideas. We lend anywhere from $40,000, and our largest so far is 24 million. We really have no cap below and above. We're just here to assist with companies to continue to do their R&D so that hopefully one day they turn into a successful business. I'll just keep on going through here because, look, as I said, we've been going for about 6.5 years. Now, why do we do it? Debt is better than equity. I think we all know that. What we provide is non-dilutionary capital. It's done on a yearly basis, so we don't, we get repaid on the tax return each year, and we're not dilutionary, not venture debt. We don't take equity. We are simply debt providers. And so companies, I guess I don't want to go, anyone who wants this presentation can get it. I guess the most important point about what we do is that we can provide the debt so that companies can get through to a certain point, whether it's a milestone, whether it's a capital raise, well, whatever that point is, we can help you get to that at a better valuation. So when you look at 3 main uses for our facility is you come to us now, you're about to get your tax return, you need to get through that point because you're going to get $500,000 back from the government. So you go, Giles, I really need some money, short term, 2 months. Great. I do not care how long it's out for. All I care is that you are able to survive through to a certain point. Other people will use it they are doing a capital raise. So they go, well, we want to have money in the bank. We don't want to be looking like sitting ducks to any investor. So they'll get their money on their R&D. They'll have it sitting in the bank account, and they look much more attractive to an investor. And also, they're not prey then. They have options. The last thing that people really use, and this is for companies who can plan on their R&D. And it's one thing that I really suggest, if you're going to look at this sort of financing, if you can plan what you're doing on R&D and you can have a plan, you can look at what you're doing over the 12 months, it can be really, really powerful. Because what we can do, we can provide you with the R&D claim through the current year. So you can do it on a quarterly basis, you can do it whenever you have major accounts that have come due, whether you need to buy a machine, whether you've got a payment for whatever it is, a clinical trial, for whatever reason, we can meet those liabilities when they come due. You only pay for what you get, and it's fully flexible. You can pay it back at any time. Hence why people, when they're doing a capital raise, will use our facility because they get it 2 months later. They've got the money from their investors. They pay us back, and off they go. We don't take personal guarantees, anything like that. So it really is it is a very flexible way of securing debt when no one else, frankly, will give companies who are loss-making, who have zero revenue, really any debt at all. And that's where we've come in. And we've been lucky enough that I started this with some very well-known investors in Australia. The first one's to venture capital, private equity, and they really saw how this could support the ecosystem. Hence why we work so closely with Steve and the team here, because the companies, there's only one company out of the 600 that we've lent to were not raising within the next 6 to 12 months. And that was because they were a minor and they were finally going to get their ore out of the ground. Otherwise, everyone else is raising. Everyone else needs to get to a certain point where their valuation is maximised. And if you have that extra money, hopefully you can get yourself to that point. And so I do have one more slide that I will go through very quickly, sort of just to show you the... so as I said, there's short term and then there's what we call sort of quarterly, but it's really just depends on when your liabilities are due. And so just to finish up, it's this slide. So if you think about it, if you have $1 million at the start of the year, or I think we've done it here on $500,000, but if you have $1 million at the start of the year and you finance it, that means an extra about $120,000 per quarter you can spend on your R&D. But then what you've got to remember, the most important thing is that increases your claim at the end of the year. So not only are you using debt to accelerate your spend, but you're able to claim that back as part of your R&D refund. And that's where the real power of this can be. And, you know, really, you're getting yourself to market a lot faster. When I started this business, I was speaking to a friend of mine from university. He goes, "Oh, great idea." And he said, it used to be big, eat slow, now it's, it used to be big, eat small, now it's fast, eat slow. If you don't get your product to market as quickly as possible, chances are someone else will. And then you're second. And no one wants to be second in this world at this point in time. So really, that's where the power is. Otherwise, it's survival. And to me, I really don't care. I'm here to support companies, whatever you need. You know, we've had... You know, one of our first loans was to a company, and a small guy, looked about 12. Apparently he was 18. He got $30,000 from us at that point. And it was look, the idea we thought was great. He said, "Oh, you know, we're also looking for $30,000 in equity." And my business partner and I sort of went, "Oh, don't think we'll do that. We'll do your debt." Anyway, latest thing was he was in New York, voted by EY's fastest 50 growing companies. He's got 300 employees over there, and he's got another 70, I think, up in Queensland. So unfortunately, we didn't invest, but he loves it. So anyone who wants a reference, you can call him. Look, that's really all I have to talk about. If anyone wants to come and talk to us, we're outside. But we work a lot with Wholesale Investor. They know all about us, and they will refer you to us if you have any questions. Look, we're just here to help early stage companies. So if we're happy to help, and we're happy to advise with if you are looking at this and whether you can do it and all that sort of stuff. We're happy to be there to support. So enjoy the rest of your day, and I hope you get what you need out of this conference, because it is a fantastic event. Thank you.
Thank you so much, Giles. So, first presentation of the day will be Andrew Glenn, Managing Director of Aviator Capital.
Good morning, everyone. Thanks for having me. So Aviator Capital is primarily a wholesale funds management business, and we specialise in commercial property syndication. So the thing I've been asked about the most recently is rising interest rates and how commercial property can act as a hedge against inflation, and how people's assets are protected or even maximised in an inflationary environment. So I'll go through a little bit of that today. And then I'll give you an example of how we actively deal with that challenge. So obviously everyone knows what inflation is, but you know, why does it matter? Because it reduces our purchase power parity, right? So if inflation is high and wages don't keep up, or our income doesn't keep up, then essentially in real terms, we're losing value, losing money. Obviously inflation is necessary in a modern economy, and that's primarily managed by the central banks. I wouldn't say that they've done a good job of predicting the current inflation, for a number of reasons, but we can talk about that later. But unfortunately, the only tool that the government has to deal with inflation is, they can put the foot on the brake or they can put the foot on the gas, and that's it. They've only got one tool, which is interest rates. So you can't really discuss inflation without discussing interest rates. So, and particularly for commercial property, that's of paramount importance. It's also interesting to note that over the last period, essentially since post-GFC, there hasn't been an interest rate rise until just recently. So you've got people in the industry who graduated from uni 12 years ago, have never operated in an inflationary environment. And there's not that many people who are well equipped to deal with it. So last rate rise was in 2010. If you wanted to have 5 years experience in an inflationary environment, then you're probably 40 by now, which is pretty surprising. I don't think many people in the industry actually realise that. I'd love to be 40 again, but here we are. All right, so managers that will thrive in a high inflationary environment have had that level of experience. Aviator Capital, who are we? Well, we started in about 2008, 2009. We started as a private investment trust, and we do still run a wide investment mandate macro opportunities fund, which I guess is a hedge fund, but it's not day trading. But primarily our business is property syndication. We have about 250 million in commercial assets, and then we have an asset management business that has 750 to $1 billion in commercial managements. So we're very familiar with all different kinds of clients and tenants and investors, and we're passionate about commercial property. All right, we have properties all around, well, up and down the East Coast primarily, but also in the Northern Territory, which I'll come to in a second. Our net yields after fees are currently 8 to 12%. Every fund is a single asset closed-end unlisted property trust, so there's no cross-securitization. Our investors know the exact bricks and mortar that they own, and we pay distributions monthly. So it's stable income, and that's what they're after. So that's why we meet it. So why does inflation matter in a commercial property environment? Well, most people would say I'm still getting the same rent year on year, got a good tenant, they pay their bills, and that's fine. But if that rent is fixed and inflation is 3%, well, effectively your value is you're only getting 97 cents in the dollar. And that's okay for 1 year, maybe. But in America, if inflation's running at 9.1, or let's call it 10%, then you're down at 90 cents, and that makes a huge difference. 1 year is fine, but the problem is it's year in, year out. It's every year, because we're talking long-term investment horizon, particularly because of the cost of commercial property, the acquisition costs like stamp duty and legal fees and things like that. So if you have a consistently high inflation environment and you haven't allowed for that, or you haven't built your model and your leases and your tenant negotiations around that risk, then you're actually going to take a bit of a hit and suffer some losses there. So properly constructed leases that consider the likelihood of inflation are really, really important. In the last 10 years, most of us have spent our time trying to negotiate fixed annual increases because inflation has been negligible. It's been the 40-year curse of Japan trying to generate some form of inflation, so we've gone fixed. But now we're changing all of our leases to try and capture CPI movements or fixed annual increases, whichever are greater. And that's a good tool to minimise the risk of inflation in a commercial environment. As an example, if you had $500,000 in annual rent and you had one a bulky goods retail tenant that had fixed standard 3% increases year on year on year on year on year, and that might be a 10-year lease, then your rent will probably increase $15,000 in that first year, and then compound again every year after that, and that's fine. But if inflation's 7, 9, 10%, then you're obviously not keeping up with the real parity there. If you have an office lease where it's pegged to CPI, then the rent might increase $35,000 in the same year. So the increase in income is that offset against inflation, or one of them. But the other one that's really important is the capital appreciation. So if we say the cap rate on the commercial property stays the same, then obviously the value of the commercial property goes up. So in the first example where the bulky good retail tenant, if that rent increase is $15,000, then of course, then you've got a $250,000 capital value uplift, and that's about a 3% increase, which again offsets some of that inflation. Those of you in the room who are more familiar with this would understand that the actual cap rate can change as well, because we're talking about a risk premium over the cash rate. But that increase in value, all other things being equal, is a really important hedge against inflation. And if you're talking about the office with a 7% increase, you've picked up about a 7% capital increase in the same year, as well as the increased income to offset rising interest rates and stuff like that. Now, that it might not be 100%. If you construct it well, it will be, or maybe even net positive, depending on how you've structured your debt. But I'm ignoring debt for valuation purposes. But when you compare that to an equity-based environment, if you look at the S&P 500 off 20% from peak, touching on the bear market territory technically, then commercial property can make a very big, or can be quite. It's not immune, but it's a lot more defensive, while providing high yield and high returns compared to cash at bank or even bonds. And if you've seen the bond markets recently, you know how detrimental that's been to fixed interest. All right, and then as I mentioned before, that the other really important thing here is that it's not just 1 year. We're not talking about a 1 year snapshot. We're talking about a 5 or a 10-year plan. So over the medium to long term, then commercial property really does well in an inflationary environment. And there's not only just the income side and the capital appreciation side, but also the replacement costs, because inflation carries through to all fixed tangible assets, as opposed to script or equity, right? So if you've got buildings, the replacement cost of a building goes up 10, 20%. So that makes the rents go up because new projects can't get out of the ground because they can't afford to unless the rents are higher, and that drags the whole market up. So that's another really important point. So how do we deal with this as a practical example? This is the fund that we're just launched at the moment. It's an office building in Darwin. It's older, but it's had about $6 million of capital expenditure spent on it to get it up to a 5.5-star NABERS rating. It's 100% leased by NT Government and Department of Defence. So if the Fed go too hard and cause a recession, and America sneezes, Australia catches a cold, government tenants are great at paying their rent. And in fact, with a Labor government, there's probably more jobs and more government tenants to come as well. Darwin essentially is the Canberra of the north. It's a very government-based town, but there's also resources and agriculture, huge LNG projects and so on. A-grade vacancy in Darwin's less than 1%, which is one of the reasons we like it. With debt modelled at current interest rates, as of today, we'll be able to deliver 8.5% net return for investors paid monthly, with government tenants in an 8-year WALE, or just under an 8-year WALE. So we think that's pretty attractive and hard to replicate. So that's very competitive. The other thing we really like about it is the leases are pegged to NT CPI. So if Australian CPI will come out at about 11:30 today, we'll find out what Australian CPI is, but NT CPI will hopefully be higher than Australian CPI. I know that sounds absurd, wishing for high CPI, but in this specific case, that's going to give us an immediate boost from 1 July, because the rent will be backdated. But we're expecting our net operating income to go from 1.97 to probably $2.1 million straight away before we've even settled, which is great. So we purchased on the old passing rent, and then we get a good boost for our investors straight away, which will probably add well over $1.5 million of capital value on day one, which is about a 10% capital gain on top of the 8.5% net yield after all fees. And that 8.5% is starting. It can go up after that because we've been quite conservative in terms of modelling for capex and lease up and things like that. But 8-year WALE, government, 8.5% net yield, and a protection against inflation. So that's how we try and structure in terms of getting clever assets with clever leases and minimal risk to try and shift that risk-return ratio where investors get a very safe long-term income with minimal risk. All right, that's a little bit over my time, so I apologise for talking too much. But I'd love it if we've got a desk outside near the front door if you want to come and ask me any questions or find out more, or just talk generally about commercial property, I'd love to hear from you. Thanks very much.
Thank you so much, Andrew. Up next, we have Aidan Howarth, General Manager from Liebke Co.
Well, good morning, ladies and gentlemen. Thank you for your time. Great to see you. So my name's Aidan Howarth. We're from a Canberra-based organisation called Liebke Co. And really today I'm glad we got to hear from Aviator Capital before, where we've got some property development opportunities which I want to present to you today based in the sort of the Canberra market. So without further ado, so firstly just an introduction into Liebke Co Group. Who are we? What do we do? So we're a small team. We're about 15 people, but we've been growing quite rapidly. We're a Canberra-based and family-owned organisation. We operate in 4 key areas. We're property developers, investment managers, we have private equity, and we're investors in real estate as well. We retain our own assets a lot of the time. The team's grown from about 18 months ago. There was just 4 of us. The founders started at around 2017, started building, developing, and has scaled up fairly quickly. So we're about 15 now. January last year, our development pipeline was around $22 million of end realisable value just in the townhouse sector. We've been able to expand that to today. We've got a $192 million pipeline. It's across apartments, townhouse, A-grade office, and childcare. We partner with the usual suspects in terms of senior lending, CBA, St George, La Trobe, Wingate, and Cox Architects are an incredible firm that we work with closely. Colliers, JLL, Knight Frank, Hall & Wilcox. So why Canberra? Here we are sitting in Sydney. Some of you guys are maybe from Melbourne or Brisbane. Canberra is obviously a lot smaller and sometimes it sort of falls off the radar, but it's an incredibly strong and resilient market. So some of you might not know this, but it's a AAA rated economy. Just a couple of days ago, the CommSec report, the State of the States report came out. Canberra was ranked number 2 in the country. So it's consistent. We have some of the lowest unemployment nationally. Some of those figures are a little bit out of date now from this month's data, but and we also have Australia's highest median income, $1,910 per week versus the national average of $1,737 per week. And that really underpins a lot of particularly the residential market. You might not know this, but we're now the second most expensive housing market in the country. Last year we overtook Melbourne in that spot, obviously Sydney's being the first. ANU is a number 1 ranked university, and we have some of the lowest vacancy rates in A-grade office in the world, so we're at 2.4%, and we've got an excellent, strong, growing population. So they're just some of the reasons why we're in Canberra. So I'm going to present sort of 3 different opportunities this morning. The first one is a 10 townhouse development. We're at the stage where we've settled the land. The DA is about 2 to 4 weeks away from coming out. We've hit our pre-sales targets already. So we're looking at raising capital for the construction portion of this. So it's just under an $18 million gross revenue on completion. We're looking to raise about $4 million in preferred equity from investors for this particular project, 14% IRR, and it's about an 18-month term. Another example, we've already funded this one out, but just to by way of an example of what we're doing in the childcare space, we bought this site DA approved with a pre-lease in place, and we've already had it funded out with some investors, and we're about to start construction. It'll be about a 15-month deal. Childcare, if you haven't looked into that, maybe you have if you're in the property space. Very, very excellent asset class, very resilient, really growing asset class as well. The third one, we are raising for this one as well. This is open currently. So this is the DKSN North Office building. We haven't developed this property. We've actually bought it off the plan as what's called a warm shell fit out. And we're going through the leasing process at the moment. It's on the market. You can find it online. There's 5 floors of A-grade office. It's about 2,500 square metres of A-grade office all up. We've already got some heads of agreement signed to lease this building up. But essentially, we're raising capital from investors to help settle out the land and pay for incentives and leasing and fit-out costs. It's a fairly short-term thing. It might be 6 months, maybe 12 months on the long end. And we'll either sell the asset or Liebke Co will retain the asset and we'll refinance investors out and hold it ourselves. It represents about a $22 million gross revenue, so, based on current market caps once it's fully leased. One of our larger sites that we've got at the moment is at 90 Northbourne, very close to the CBD. It's a site that we exchanged on earlier this year. We're currently in planning phase. And what we're really excited about this one is we're looking at bringing Canberra's first mass timber A-grade office building to the market. It's been done in Sydney and Melbourne, which you might have seen a few, but hasn't been done in Canberra yet. So we're really excited about that. In Canberra, there's really been a flight away from B and C grade office to A grade, hence the lower vacancy rates in A grade. So we see a real opportunity there. We're raising $8 million for this one. That'll help to settle out the land and hold it through the DA phase. So we think that's probably going to be about an 18-month term. That's the first raise. And then once we have the DA approved and the pre-leasing in place, we'll do a second round of raising for the actual development portion as well. So unfortunately, I apologise, this slide didn't save properly. But where is investor money used in terms of the capital stack? Obviously, with the capital stack, the total development costs of a project, the higher you go up the capital stack, the higher the risk and the higher return. We've got great relationship with senior lenders who are normally 50 to 60% LVR. Investor money is coming into the preferred equity or the mezzanine sort of space, hence that sort of mid-teens return. So why invest? Okay, there's a bunch of reasons. We've got an exceptional property and finance team. Collectively, our development team has delivered over $860 million worth of development in the ACT and New South Wales over the last 12 years. So we've got a very, very experienced team. You get to choose which deal you want to be involved in, whether it's residential or a childcare or an office. They've all got slightly different parameters. We've got a great deal flow with the size of that pipeline, 192 million, and expected to grow. Given the suppression in the market, we're actually really excited, and we're looking at sort of purchasing a few more sites over the next 12 months, as there's great blood in the streets and lots of fear. It's great buying time for us. Liebke Co's money will always be in the first loss position. So essentially, investors will get paid, at the end of the project, investors get paid after the senior mortgage, the senior lender, first mortgage. So that's important to us because we want to make sure that our money is always acting as a buffer to investors' capital and returns, and it demonstrates our alignment with the project. We're always first money in, last money out, and most of the time, before we brought the project to investors, we've already substantially de-risked it. Like you saw on that 10 townhouses, we've settled the site, it'll be DA approved, we've got our pre-commitments and pre-sales in place already. And Canberra's an exceptional market. As you guys, you might be aware, but from the peak, Sydney's already down 4.4%, Melbourne's down 2.2%. Canberra hasn't dropped, not that it won't drop, of course, but it's a very resilient market. We think there's a lot of headroom there. There's still great opportunity in these particular sectors, in townhouse, in office, and in childcare. So, look, I'm just about out of time. That's gone very quickly. If you'd like more information, come and chat with me. I can give you information on each of the projects. Love to chat with you, answer any questions that you might have, or connect with me on the Crisp Deal Room. And would love to have you on board. Thanks very much.
Thank you so much, Aidan. So up next, we have Michael Edwards, Investment and Development Director from HS Consortium.
Good morning. I'd just like to introduce you all to HS Consortium. We're a funds management company specialised in property. We effectively lend money to property developers secured by mortgage over the property, personal guarantees, company guarantees. We predominantly lend into the residential sector, being apartments, townhouses or land subdivisions. We then raise the money from wholesale investors. Each fund has got a new IM, so the investors know exactly what they're investing into. Since inception, we've managed over $310 million in investments. And that includes our private equity, which we put into developments ourselves, and also wholesale investors' money. We have three types of investment opportunities at the moment. First one is mortgage funds. These are properties secured by either first or second mortgages. First mortgages generally go to an LVR of 65%. Second mortgage security goes to about 75%. Our first mortgage loans generally attract to investors between 7 and 9% per annum return, whilst our second mortgage investments at 75% LVR investors receive between 14 and 16% on their money, with interest paid along the way. So interest is generally paid either monthly or quarterly, so investors get an income stream during the investment term. We have development funds. Our recent development fund we've just completed in Hawthorn in Victoria, 21 apartments. Target IRR for that one was 15%. Construction occurred during COVID, so we probably had about four or 5 months of delay. However, even at the end of the project, the investors still received their full 15% per annum. So in fact, they actually benefit because the project went longer, they still got their 15% per annum. We also have some SIV offerings, which attract about 6%. We always co-invest in our funds, so money goes in from ourselves first, and also then from the wholesale investors. The HSC team are very experienced in their fields. The executive team here, we cover off banking and finance, property development, accounting, construction and project management. So we're very experienced in the property and finance fields. And the team over their over their careers have been involved in over $3 billion of transactions. We're supported by external parties. We operate under an AFSL, which is through Mark, their AFSL, and we have a independent credit committee. Scott Keck and Adrian Blake, they're Melbourne-based people, very experienced, and so all our transactions we do have to be approved through the investment committee of which they sit on. Being under the AFSL, we have compliance regulations that we have to adhere to, and so we meet and report to our compliance manager very regularly. So that's it. Just we're from Melbourne, but we'd like to speak to all investors who may want to come invest in our fund, and we're here to talk. Thank you.
Fantastic. Thank you, Michael. Up next, we have Tyrone Shum, founder of Property Investory.
All right. Thanks so much for coming over to watch. My name's Tyrone Shum. I'm the host and founder of Property Investory. Now, as you can see up here, the tagline is "Make your money work." Very cliche, and I'll explain to you shortly the reason why behind that. All right, who am I? I'm a licensed real estate agent. I used to work for LJ Hooker and also Ray White. I'm also a property developer and also a property investor as well, and I've been involved in over $30 million worth of property transactions as well too. Now, just a little bit of background behind Property Investory. It all started back in 2017 with a vision and a podcast. And you might be going, a podcast? What's this got to do with here? So let me tell you, it was actually inspired by my good friend Mike. Mike is a very good friend of mine who was also going through the corporate sector, climbing the corporate ladder, and just trying to get out of the rat race, basically, looking through at property. We initially both started off in that kind of space, and him and I also had about, say, 2 or 3 properties when we first initially started, and we're thinking, how can we actually get out this corporate rat race that we're in there? And we're thinking, okay, how do we get into property investment and generate passive income from that? So a few years later, I kind of lost touch with him, and I was actually starting a family, as you do, very, very busy with very, very young kids. And I was just like, okay, I'll pick up this magazine, which I just sort of stumbled across, called the API magazine. Maybe some of you guys have heard of it, but in there, I actually saw my good friend Mike across a full 2-page spread. And the title said, Man on a Mission. And I looked at it and went, wow, what did Mike do? And in the article it said that he already accumulated over a dozen properties, was generating passive income from there, and he was also running his own mortgage broking business, which to me was like, wow, Mike, what did you do? So I reached out to him, obviously had it caught up with him, and from there it inspired me to actually learn more about what exactly he did. And through that, I decided, okay, I'm going to reach out to fantastic property experts, people who have done and been on that journey, and start a podcast. And basically, fast forward to 5 years later, we've had a very, very successful podcast, which we started in 2017 as well. Through that podcast, we've had over 3 million downloads, 10,000 plus subscribers and listeners on a weekly show that we deliver, so forth. Now, as you probably all know, in 2020, COVID hit. And I will mention before that, actually, sorry, the sponsors. So yeah, through that podcast, we generate a lot of sponsors. We've had a lot of financial institutions, such as banks, Commonwealth Bank, Citibank, etc., NAB, ING. We've also had Domain as well sponsor us on a podcast. And obviously, you could see we're doing quite well because we had such great sponsorship through our podcast. Now, as I was mentioning, in 2020, COVID hit. And the first thing that usually gets kicked on or I guess reduced is the marketing expenditure. And because of that, our sponsorship unfortunately got cut. So what we had to do was we actually had to pivot, and our business had to make some very, very tough decisions. And we actually decided to go, okay, look, we've got this fantastic opportunity where we've got a very, very strong following of property investors. And these property investors also all had a lot of cash and equity, and they wanted to actually put it in a place where they can earn a great return. We also established a fantastic relationship with a lot of developers and also brokers and so forth, and they had great deals and property developments that they were needing funding. And because during that time, we actually found that a lot of the banks were not lending, a lot of the institutions were not lending because of COVID, we thought there'd be a fantastic opportunity to be able to put these two together. So let me ask you this question. Has any of you guys got extra cash or equity looking to get a greater return? Just raise your hands. Fantastic, excellent. Well, let me explain to you what I just said. Basically, we have property investors and developers and all these brokers bringing us fantastic deals. And the big idea in, say, 60 seconds or less is that we filled this market. So instead of actually having the bank here with us, we actually were able to provide and source all these deals and provide to all our property investors, giving them about a 20 to 30% per annum return, a fixed interest rate. So we're acting almost like the bank. Okay. So let me explain to you how this all works. We're basically putting two parties together. So the first thing is that we had a number of private property investors, and these private property investors had a lot of cash and equity, and they were sourcing excellent deals that were actually very, very stable and securitized. Then what we did was we contacted all these developers and pretty much said to them, look, if you're looking for funding, this is what we have. And then essentially we put these deals together. So we're acting almost like a bank. All right, so I think you probably want to know maybe an example of how this all works. So back in 2019, around about November, I was introduced to another developer who was actually had a 1-into-4 lot subdivision in Rowville. And this deal was actually very, very simple and straightforward. He already had it all fully funded. And something unexpected happened. And basically, one of his personal family members passed away unexpectedly. And he just didn't feel right to be able to take the money that they had put into this investment. So he returned it back to the deceased family members. So he was left with a bit of a situation where he'd go, okay, what am I going to do? So he reached out to me and said, look, would you be able to lend me $230,000 for, say, 12 months, and I'll give you a 15% return. Pretty straightforward deal, simple loan. And on top of that, it was securitized against this particular property. Now, interestingly enough, 6 months later, which was bang smack in the middle of COVID, around about April 2020, he reached out to me and said, hey, look, Tyrone, would you actually like to get your money back now? And I said, well, of course, I'd be more than happy. Well, what I'll do is I'll give you your 15% right now. That was for 6 months instead of you having to wait for 12 months, and we'll refinance you out. We'll pay for everything that we've said we owe you, and pretty much get you out of the deal. So true to his word, I got all my money back. So I had my principal plus a 15% return in just 6 months. So if you actually worked it out, that's about 30% return per annum. And since then, I thought, how can I actually get more of these type of deals in place? And it kind of just struck me, and that's where this opportunity from our business pivoting from where we're having sponsorships from podcasts jumped into all these deals. So far, since 2020, we've had completed 14 successful deals, 19 that are currently in progress, with 27 repeat investors out of the 50 plus investors. And we've had a lot of traction to date. In fact, we've actually funded over $31 million worth of transactions and deals in the last 2 years alone. So it's been phenomenal to see that. Now, just to give you a bit of a background behind the team, this is a fantastic team that I've got. We've organically grown, which is great because all our investors have a huge trust behind us. We've got great lawyers, great commercial brokers. I've been the one who's been involved in a lot of these transactions, and I know quite well what's happening. We've also got some excellent, strong partnerships. Groups like the Jagger Group who provide constantly deals for us. We've got great commercial brokers. We've got Latrobe Financing who also help us with some of the financing as well. And also Smart Capital Group, who's also another developer. Now, last thing I want to mention as well is because of the podcast, we're usually ranked around about #1 for property podcasts on iTunes. We've got over 200 plus reviews constantly. It continues to build up our brand and also trust through all the property investors that listen to us as well too. And that's what actually helps us to be able to build a great community of fantastic property investors who are like-minded and want to invest into deals like this as well. Okay, what I want to do is probably just leave you with one question. Now, if you could take $1 million now, or you had a choice to take $1 million now, or if I gave you 1 cent and compounded it daily for 30 days, which one would you choose? Now, if you want to find the best answer for that, come and visit me at the booth. All right, make your money work. Thanks so much for your time.
Fantastic. Thank you, Tyrone. Up next, we have Jamie Miller, Head of Marketing and Growth at CrowdProperty.
Morning, everyone. Thanks for having us. Looking forward to a great event today. As I was introduced, my name is Jamie Miller. I am Head of Marketing and Growth for CrowdProperty Australia. I'm standing in for our CEO, David Ingram, today, who's overseas. So yeah, I'm taking one for the team. Hopefully I can get through the slides in the right order. And I was one of the founding team members at the end of 2020, prior to our launch. So what is CrowdProperty? And simply, we solve project finance for small-scale property developers. So we essentially have identified a need for finance, and we match that with an interest in alternative returns for investors. So we directly source unique property developments, and then we find and invite wholesale and institutional investors to come and invest in those developments as project loans for up to 7% per annum return. Just to sort of quickly show how this works, the bottom row there are some deals that we funded in Australia. Typically, we'll fund those in around about 7 days or so. But if you look at the top line, CrowdProperty originally started in the UK about 8 years ago, and they now fund deals in under a minute with over 2,000 investors. So it's kind of like buying concert tickets. You can't get in quite often because there's so many people trying to get on that deal as quickly as possible. And they're doing probably 5, 6, 7 deals a week. We're doing 1 or 2 a month at this stage. So a little bit about our timeline. So in September 2020, we raised a friends and family fund for about $750,000, which was oversubscribed. We launched our platform in Australia in May 2021. And in September, we raised our seed round for $1.5 million, which was also oversubscribed. And in April 2022, we paid back the first investors on our first deal which is about 15-month deal term, and they return their 100% capital and interest to those investors. And in July, where we are now, we've now reviewed over $350 million of project loans, loan applications, and we've recently launched a partner fund, which I'll explain a little bit more about later on. We were at Emergence, another wholesale investor event back in, I think it was March, and at that stage we'd only reviewed about 100 million in loan applications. So you can see the growth of interest in our platform. So I'm going to talk to you today about the pain we're here to solve, our solution, what's in it for investors, what's coming next for us, and what you can actually invest in today. Can I just get a sense in the room here? Are there any property developers in the room today? Anyone who's developing property? Okay. And who's here who's an investor looking for opportunities for alternative returns? Okay. All right, let's start with this. Every business should start with a pain. In Australia, for small-scale property developers, and we're talking about residential developers who do projects up to about $5 million, there's a lack of trust with traditional lending sources. Okay, this is documented. There's also a significant housing shortfall. So we've got a lack of trust in lending, and we've got a problem that we're not building enough houses. Developers have consistent problems. If you look at some of the things, this is real quotes from a survey that we've conducted. My favorite in the middle there is banks might be cheap money, but it's a higher price in the end. Nobody understood property. This is critical. And you need to talk to someone 3 layers up to get a decision. These are key pain problems for small-scale developers. In a survey that we ran in the UK, we asked what is holding you up from building more houses for small-scale developers, and far and away the biggest problem was better sources of funding. There are other significant issues like an improving economy or improved planning, tax policies. Now, these are all government-related levers that we can't influence, but one thing we can do is improve a source of funding. Part of the problem is that when you get traditional funding sources, there's a series of profit pools, everyone clipping the ticket along the way from where the money comes from to actually handing it out to the developer. What we've done with our platform is we've cut all of that out. We've got a CrowdProperty platform in the middle. We source the deals on one side, we source the investors on the other, and we match the two together. It's all about creating speed, ease, certainty, and expertise for the developers, and above all, transparency, so that there's no hidden fees, no hidden extras. And by leveraging market-leading technology, we can create efficiency. And by bringing direct property expertise into the organization, we create effectiveness. So what is our solution? It's quite simple. We select the projects, and we have a significant level of due diligence so that we produce, we find projects that are lower risk and have a very stable profit margin. We bring those to our platform where investors can then review the individual projects and put a pledge against it. The work begins on the project once it's funded, and when they complete the project and exit, whether either they retain that, refinance it, sell it, we pay our investors back their capital and interest. Now, the key to this, don't worry about trying to read this slide. This is really just illustrating some detail. But the key to putting stable platforms, projects on the platform is that we have a rigorous due diligence process. Now, in 8 years, the UK has funded, I think, over I'm forgetting my numbers now. Anyway, a lot of projects. They've reviewed over 16 billion dollars worth of deals, and in that, they've only funded 3.5% to 4% of those deals. Because the due diligence is so rigorous, they won't just accept anything. And because of that, they've had a 100% capital and interest payback record in 8 years. They've never lost a deal. So this process is all about getting to know the developers very personally, and our property team working very hard to qualify the projects. We manage the loan monitoring through our tech platform as well. That's just some of the screenshots from there. And we have a small team that we're growing in Australia. I just wanted to highlight in particular our property director, Daniel He, and property developer manager, Alan Wang. These are our 2 property specialists in Australia who have deep expertise. And also we rely on the UK team as part of our investment committee. And between them all, they've got about 100 years of experience in property development. So what are the benefits? Benefits to investors is firstly, save time. We do the due diligence for you. If you want to invest in property development project loans, there's a lot of detail you've got to get through to understand that that loan is secure. We do that for you. unique projects. Any project on our platform is not available anywhere else. We're sourcing unique projects that you're not going to see in other platforms. There's no overheads. It costs you nothing to join our platform. All of the income for us is on the developer side. Diversification, you can move your investments across a number of projects, a number of geographies. And of course, as a business in Australia, we're developing new products that give you further investment opportunities in the future. So the key points I'd like to touch on is it's first mortgage security. You can earn up to 7% per annum target interest returns, which is also a number that may change in the near future with changing interest rates. Fixed returns from 6 to 18 months. Curated higher quality, lower risk projects. You can be selective with either investing in projects or our partner fund, and it's open to wholesale investors, individuals, trusts, SMSF, and companies. So what's next for us? We've just been approved for our retail license, and that's going to be launching later this year. So everybody will be able to invest, and we'll be having another seed round for growth around the retail launch. So what can you invest in today? We have a partner fund that allows you to invest in a fund that we distribute against projects. That's for the investors who don't want to look at the individual projects, just want to know their funds are being deployed. And for that one, you'll get a quarterly interest distribution. Or you can invest in some of our projects. So here's a couple. I'll be very brief because my time is up already. We had a project in Rowville, Victoria, which we've just funded. So unfortunately, that one's gone in the time we published these slides and came to the conference. That was for $1.13 million. And that's for a heritage renovation down in Rowville. A renovation down in Rowville. We also have this project in Auchenflower, Queensland, which is they're moving a heritage building to the front of the lot, doing a renovation, and then building 5 apartments behind. And that one's ready to go. I think we're putting that one up on the platform for $780,000 in the next week or two. Georgetown, Tasmania is an incredible place, boomtown. It's got less than 1% rental yield, availability. And this developer is building townhouses down there, and with the green minerals investment down in Georgetown, it's one of the rising towns in Australia for property. A couple more. Glenroy is a co-living development that's already underway in Melbourne, and a 20-lot subdivision that we've got underway in Salisbury Heights and Adelaide. So some really interesting projects. If you want to find out more about those, please come and chat to us in the stand outside. Otherwise, you can contact me, Head of Marketing, or when he gets back, our CEO, David Ingram, and 2 of my team are here today to talk to you about further opportunities. So we look forward to that. Thanks very much for having us, and we'll chat to you later on.
Fantastic. Thank you, Jamie. So now we'll have a short morning break where you can go and network with the similar companies and have a coffee, and we'll be back in 20 minutes for some more presentations. Can everyone start making their way to the presentation hall, please? We'll be starting with the next presentations in a couple of minutes. Can everyone start making their way to the presentation hall? We'll be starting with the next presentation in 1 minute. We'll be starting the next presentation, so please make your way to the presentation hall so we can start the next presentation. Yeah. Please make your way to the presentation hall. We'll be starting the next presentation now.
What is the time? 26.
Okay, welcome back everyone. We'll be starting the next set of presentations with Mark Global, CEO and co-founder of Primal Organix.
Hi everybody, how are we going? Good, fantastic. Well, I'm super excited to be here today. We're an Australian manufacturing company helping people all over Australia overcome some of the most common health challenges. And I'm really excited that over the last 3 months or last 90 days, we've helped so many people through so many different outlets that our business is growing really, really fast. And today I'm going to share an insight to Primal Organix about the company, about the product, but most importantly about the amazing people, the amazing results that people are getting from our products in the areas of pain, anxiety, breathing difficulties with post-COVID, and other particular common illnesses. And our products now have reached over 20,000 customers in Australia. In the last 90 days, we sell directly into health food stores and pharmacists. We've gone from 60 outlets to 120 in the last 90 days. And what is the most impressive part about that is the repeat orders and the size of the repeat orders that our pharmacists and health food stores are giving us. So let me just give you some insight into the company. And I get asked this a lot of times, what's your role in the business, Mark, and where do the products come from? So I'm really going to give you a bit of a story about Primal Organix and how it started. On the left there, you can see the creator, who's my business partner, who's my cousin, Mr. Frank Gimperi. And Frank is what we call the Chief Scientist Officer of the business. He's the creator of these beautiful Primal Organix products that we've already moved over 20,000 products around Australia and getting ready to go into commercial markets overseas. He's created these products and he's an amazing person that just wants to help people. And his motto is he wants to help each person, one person at a time. And it was his beautiful wife back in 2016, 17, when he was flying back to Melbourne because they're in WA through funerals. His mum, his dad, my dad, our aunts and aunties passing away, that his beautiful wife, Beverly Gimperi, said, with what Frank does and what Mark does, it could be a great business. And at the time, what people don't know is that Frank was the king of medicinal cannabis for the last 10 years. And we have a lot of recipes, and part of our capital raise is to actually move into the medicinal cannabis space, which we'll talk about shortly. But my background was running a registered training organisation with the Australian government, an RTO, delivering certificate programs in Cert 4, frontline management, business sales, leadership management. And to run an RTO, to build an RTO, you have to be a fit and proper person. And I sort of said to Bev, it's a great idea that Frank's helping all these people and I'm running a registered training organisation and have a lot of corporate contacts, but at the end of the day, he's somewhat doing it under the table and I've got to be a fit and proper person. And in 2018, the Victorian government set out a document to become the leading innovative hub of medicinal cannabis. And in that document, the Victorian government said that if you were an individual or an organisation somewhat, experimenting in medicinal cannabis, you could come and apply for licences and you wouldn't be in any sort of trouble. That was a game changer. So what we did is we put together a 60-page pitch deck and went on a mission and started raising capital into the stock exchange in Melbourne, investment bankers, VCs, the whole lot. And effectively what happened, people laughed at us. They absolutely laughed at us. Who's this guy, Frank? Where's he from? Who are you? What do you know about medicinal cannabis? So I went back to Frank and I said, you know what? As a sales trainer, as a salesperson, as a business owner for 30 years in business, it's going to be hard to raise capital this way. Why don't you create a range of products that works on the endocannabinoid system like medicinal cannabis, and we'll go out, get a startup loan, we'll build a brand, we'll go to do some trade shows, and we'll build a business from there, and then we'll come back and we'll get these licenses once we've actually been successful. So that's what we did, guys. We got a startup loan. We created our beautiful brand of products that you can see here for anxiety, for PMS, for pain, for breathing, and we're on a journey. Our traction to date has been absolutely incredible. We have 120 supplier agreements signed off. We don't sell through a distributor. We did that during COVID. We fired 3 distributors. They can't get it done, all right? This is a complex product, guys. So we go directly to the pharmacist. We go directly to the health food store. We have 120 supplier agreements signed off. In the last 90 days, 60 supplier agreements. And these customers, when they're ordering, like today, I saw an order come in. It was just over $1,000. I was sending the order out. And I looked at their order a month ago. It was $500. So it's a repeat order, but the repeat order is doubling. All right, that's what we're seeing. We're selling directly into 120 pharmacy/outlets, over 22,000 products sold to date. And guess what our best-selling products are? You better believe it, anxiety. Why? Why do we think everybody has anxiety? You take our anxiety product, it's a money-back guarantee. You can go to the 120 outlets. There's a 7 mil tester there. You can take the product 30 seconds under your tongue, straight into your bloodstream, straight into your central nervous system, straight up to receptors. It'll manage your anxiety in 30 seconds. All natural, vegan health products, non-addictive, non-pharmaceutical. Top selling product, anxiety, sleep, pain, PMS, and immune for COVID. Our pain is also sublingual and topicals. You can come over to my booth and have a look at them. So let's talk about the money side of the business. We are a high-profit organisation. I come from sales, 30 years in business, guys. I ran a registered training organisation. Look at me in LinkedIn. You'll see what I do. I've worked with some of the biggest companies, and my job with those companies was to increase sales revenues. They didn't employ me to do sales training or recruitment or study and analyse their underperforming sales team through psychometrics, because that's what I'm trained in. They asked me to do one thing, increase sales revenues. So my cousin Frank, my business partner, he manages all of the R&D side, all of the production, getting the product out. I sell it, collect the money, run the business. Our products cost $36 a unit to make. Manufacturing cost is $6.50. Profit margin is 80%. Recommended retail and our price is $65. Average monthly order, $550 now, going up higher month by month. 792Ks in sales revenues. We've hit well over 800,000 now. And the key accounts that we're selling directly to, not through a distributor. Understand this. Nature's Work, Go Vita, Bloom's Chemist, Amcal, Terry White, and we've just opened the first pharmacy in SA Priceline. Financial projections, we've sold 22,000 units at $36, 792. We're going to do 2 million next financial year, 4 million, 8 million, 16 million. This is how we're going to do it. We're looking for capital. We're looking for over $5 million of capital to actually launch some new products and to open global markets. This is the use of funds. Please come and see me. My name is Mark Garbelotto, Primal Organix. We're issuing 10 million shares at 50 cents a share. Please come and see me down at the booth. Thank you. Thanks for your time.
Fantastic. Thank you so much, Mark. So up next, we have Nicola Lloyd-Martin from Nectar.
Thank you for your time. I'm Nicola Lloyd-Martin, and I'm representing New Zealand's most advanced digital lender, Nectar. So 4 years ago, Nectar found product market fit, developed best-in-class technology, and launched its core digital lending product. We're now raising a Series A to further enhance our automation capability, to double our loan book within the next 12 to 18 months, and to further scale. We are close to operational break-even, and we have more high-quality customer demand than we can service. We have strong backing from our debt funders, GCI. They are an Australian debt capital provider with $500 million under management. They are backed by 500 family offices and high net worths here. So at the core of Nectar's performance is its proprietary technology, which the team has built and continue to improve. But our proprietary technology, it doesn't just underpin the strength of our loan book. It is also the reason for our market-leading speed and our operational efficiency. So we are not only finding the right risk-adjusted loans to invest in, we are also doing it faster and cheaper than other New Zealand lenders. Of course, Nectar has an amazing team making all of this happen. So with great pleasure, I will now hand over to our CEO and founder, Simon Nausbaum.
Hi, I'm Simon, the founder and CEO of Nectar, New Zealand's most advanced digital lending business. Nectar provides loans of up to $30,000 to a wide range of consumer borrowers through our award-winning data and technology platform, with borrowers able to apply and receive a loan offer in 7 minutes from their mobile phone. I have been involved in the consumer finance industry in New Zealand for 25 years. As a director of Instant Finance, New Zealand's most successful subprime lender, I increasingly became aware of a large and valuable opportunity, one that other lenders were struggling to take advantage of, and one accessed through technology. The key complaint I hear from borrowers is that lending processes are too long, too complicated, and require too much information. Borrowers want answers fast. Do I qualify for a loan? How much can I borrow? And what will it cost? At Nectar, we have developed our technology platform to provide borrowers with a faster, easier, and more transparent way to borrow. We recently issued our 10,000th loan, reaching $78 million in loan funding, and have just received one customer complaint. Our customers rate us an average of 4.9 out of 5. Customer experience is the forefront of what we do. It drives our internal culture and is what sets us apart. The market opportunity for digital lenders is large and growing. Nectar's initial personal loan product targets a 5.5 billion serviceable attainable market in New Zealand. This provides around 800 million in annual recurring revenue. You may be aware that worldwide fintech lending businesses such as Nectar are increasingly eroding the market share of banks and traditional lenders. These businesses are struggling with digital transformation. They tend to have bureaucratic, high-touch processes that are dependent on dated legacy technology. The result is poor customer experience, inflexible risk management, high servicing cost, and high customer acquisition costs. In New Zealand, the bank's share of the personal loan market has fallen from 68% to 55% in just 4 years. Nectar acquires customers both directly and through third-party partners. Nectar was the first digital lender in New Zealand to offer loan brokers the ability to submit applications to Nectar's loan assessment system through an API integration. Nectar's response time to approve loan applications from brokers is significantly faster than other lenders. Being first to provide a loan offer often means Nectar wins the customer before others are even able to process the application, which has driven significant growth in the broker channel. Our newest product, Nectar Pay, allows retailers, service providers to provide finance to their customers through our API or an easy-to-use retailer portal.
Developing our technology to work across multiple channels reduces our customer acquisition costs and is allowing Nectar to cost-effectively build market share. While other loan platforms have a high marketing spend to origination ratio, as high as 10% in order to achieve growth, Nectar's comparable spend is half that. Nectar's technology provides not only a superior customer experience, but also low customer and loan acquisition costs and high operational efficiency. Nectar streamlines and automates processes that are traditionally time-consuming and expensive. Nectar's advanced credit decisioning engine enables highly automated, responsible, timely, and accurate credit decisions and is central to our competitive edge. This technology is difficult to replicate. It has taken 4 years of continued iteration of our systems through real-world learning and data analytics. Our operating metrics are class-leading. The business is achieving a 23% effective interest rate, with losses less than 3.5% of average principal outstanding. Nectar's loan book is currently 27 million, generating 600,000 per month in revenue, and is near operational break-even. This Series A raise, together with the debt funding relationships we have in place, will enable Nectar to continue to scale and double the size of the loan book over the next 12 to 18 months. While Nectar's arrears and loss rates are well within our KPIs, we're conscious that consumer demand may soften in the short to medium term, and that macroeconomic uncertainty is increasingly likely. Counterintuitively, this presents a clear opportunity and comparative advantage for Nectar due to our data-led approach to risk-based pricing, which accounts for borrower and market risk. Banks generally do not use risk-based pricing and tend to reduce lending during these periods. Nectar's return on investment has a number of drivers: a high yield loan book, increasing loan book profitability as cost of debt falls, our ability to price risk and serve a wide segment of customers, a superior ability to organically capture market share and service that market with exceptional customer experience, a high rate of repeat customers through our automated remarketing technology, and our ability to rapidly scale off our technology platform while keeping our fixed cost base minimal. All of these things are only possible because Nectar has an amazing team. Chris Evanson heads Nectar's lending operations, has significant credit experience and was instrumental in setting up Farmland's consumer finance business in New Zealand. You have already met Nicola. Our CIO, Paul Bryant, has 25 years of commercial experience in fintech, working for a number of investment banks, and was involved in setting up a large UK-based hedge fund. Senyu Wang, a member of the Nectar board, is an experienced venture capitalist. He was general manager of Google in the north of China and is founding partner of several fintech investment funds with 100 million under management. Nectar is raising a minimum of 4 million at a pre-money valuation of 20 million. 3 million of the funds raised will be used to support the growth of Nectar's loan book. The remaining million will be allocated to improve Nectar's end-to-end processing capability, make additional hires to the lending team, and increase our marketing activities. The market opportunity is large, fast-growing, and highly profitable. We welcome the opportunity to tell you more.
Thank you for your time. Please come and find me if you'd like to know more about Nectar.
Thank you so much, Nicola and Simon. Up next, we have Zoran Lozevsky, CEO and founder of EIZ Global Finance.
Good morning, everybody. My name is Zoran Lozevsky, founder of EIZ Global Finance, which allows SMEs or small to medium enterprises to monetize their invoices today, to have funding available for them to fuel their growth today. Just find this. We also provide the opportunity for transactional investors to invest directly in this particular asset class, because for too long, this particular asset class has been dominated by global, regional, and large local banks. The market size for invoice financing in Australia is around 75 billion and growing at a CAGR of 7%. In comparison, globally, this industry is around 3.3 trillion and also growing between 6 to 8% globally. And the growth here is predominantly driven by small to medium enterprises, which have little leverage versus their large customers. In Australia, we have 2.4 million active active businesses, and 2.3 million of it, or 95%, are SMEs, and they're finance constrained and underserviced by the local and large organisations. All the time, SMEs are being requested to provide property security for business lending. They want something which is easy to use. And also, we have investors that are looking for alternative investment options that are short-tenured and very strong yield. How do we fix this problem? Every year, Australia will be requiring an additional $5 billion of funding of growth per annum to fund this particular area. However, the large banks and the global banks will have credit limitations able to meet this particular growth demand. And EIZ Global Finance is here to contribute to provide funding in this area for small to medium enterprises. We're going to do this by targeting clients in the retail, or suppliers to clients in the retail space, also in the mining space, in the ASX 200, also in the state and also federal governments. We're going to provide something that basically is following the flow. You don't name finance and invoice finance. You don't follow the client. You follow the transaction and you finance the transaction. That's the way you run this particular business. We want something, we're going to build it that's basically, it's easy to use for clients. So basically they will see their invoices, they will fund those invoices, and they'll receive that from us. We're also going to provide transaction investors or transactional investors with the opportunity to participate directly in this asset class. And this is very unique for transactional investors because you're directly participating and you can pick and choose which trade you can participate in. We're providing an end-to-end cycle in terms of digital enablement. So this is where, for example, a client may be a prospect, becomes a client, transacts on the particular platform, and also reporting. It's all fully digitally controlled for them. The particular platform that we have implemented and completed and ready to operate is fully digitally capable. It is scalable, which is very important. It can handle commercial bank volumes, and also it's also designed enough to be able to handle the intricacies of invoice financing, asset-backed lending, and also trade finance. The other side of this area, and with any institution in the financial space, is governance. Governance is absolutely key. And we've put in very solid foundation stones in this area in terms of regulatory, in terms of compliance, and also risk. And we've worked with our partners at Kingwood Mallisons on the regulatory side and also on the legal side. And we also work with Deloitte's financial advisory on the risk side. Product benefits. In addition to the items above, the key areas here for clients is, A, you can receive more funding here than we would normally receive because we're looking at the finance flow. Secondly, if you are looking at making a request in this particular area. It's not noted on your credit record, which is very key in this particular space. And it's also an alternative source of funding for clients. For transactional investors, what's in it for them on top of the benefits here? Well, the first thing is it's high velocity, which I mean it can turn 4 to 6 times per annum. Your money comes in, you'll receive your money within 2 or 3 months, and you go again. So again, reducing risk. It's strong yield vis-a-vis the investment tenor. You're able to choose the transaction which you wish to participate in. Very unique. And the underlying product is highly structured. We only advance 80% of the transaction on day one. The transaction is also can be trade insured, depending on the circumstances. So again, very much covered on the over-collateralisation. Zero commingling risk. What I mean by that is the client's customer pays East Global Finance directly, not the customer. Monies are not commingled in their general funds. And in terms of the product itself, it's disclosed to the client's customer, which we call an obligor. So again, very strong risk processes in doing this transaction. 3 numbers which I want you to remember here. The market is 75 billion in size. It's growing at 7% CAGR every year and expected to grow through to past 2026. The last number is quite interesting here. It shows the maturity of the market within Australia. This market represents about 4% of Australian GDP. However, in the UK, this same market is 15% of that area. It provides tremendous growth potential. Another 3 numbers which I want you to remember, which I've alluded to. 5 billion is the per annum growth of this sector every year for the next 4 or 5 years. We are aiming as a serviceable attainable market around 63 million by 2026. A reasonable target to achieve. In terms of clients, there are, for me, if I'm targeting, there's 2.3 million SMEs in the marketplace. I'm aiming for 74 by 2016. Again, a reasonable target to achieve. And in terms of financing margins, it's greater than 10%, and this is above the base rate of funding. Some metrics here in terms of where funding is, based on my previous experience. SMEs can range anywhere from 10% to plus 14%. Non-investment grade corporates between 2 and 4, and investment grade corporates between 0.4 and about 1.2% per annum. Gives you an indication of where the margins are. Target for success, very, very simply, I'm aiming for something which is achievable. So it's 1 client per month on average for the first 2.5 years, and for the rest of the 2 years left over, two clients per month on that area to achieve that number. And in terms of funding, look, we're aiming to get to around 63 million by 2026. And again, on average, around 850,000 per client on average, more than achievable. The inquiries that I'm getting coming through is multiples of that. Execution risk. Every investor wants to understand what am I getting into. First thing, track record. Can the founders deliver? 2007, I created invoice financing for a large global bank in Australia in 2007. Done deal, every aspect of it, sleeves rolled up, done. For the next 10 years in that particular organisation, I transformed their transaction banking business and increased revenue by 8 times in 10 years. I was then taken to Singapore to run their regional business of Global Trade Solutions, which has a book of 27 billion euro or 40 billion Australian dollars, runs commodity finance, trade finance and invoice financing across 12 countries and about 3,000 clients, all under my remit. Again, track record is there, knows his business inside and out. The governance side is also very important here. Credit risk is absolute paramount. And for me, I've partnered with one of the major providers in this area, which is Tenubu Square, a large global provider of insurance aggregation. They're based in Paris and with a global footprint. They've been integrated into our system in basically providing risk services. On the regulatory side, on the AML and the TF side, we've partnered with Deloitte. We've come out with a low risk rating in terms of our assessments with Deloitte, and the modelling is through their main platform. And in terms of the programs, AML and CTF programs, we've had Kingwood Mallisons develop that with us. We've completed and also implemented those particular programs. And in terms of the secret sauce of financial institutions, it is your transaction documents. It's your suite of transaction documents, how they operate, under what conditions, and how you structure them. They've all been done. And again, in terms of Kingwood Mallisons, I've been working with the same partner for 15 years, and we've developed this again over the last year with that. So again, proven, tried exercises. The team, it's myself, Zoran. I have Anthony Lazewski, same surname, my son, working in the business. And again, I was one of the trainers within the global bank. The global bank is BNP Paribas. I worked with them and basically trained up pretty much most of their experts in my area. And again, I'm going to do the same within this area, and Anthony's focusing on the digital and also the marketing side of the business. But again, it's not only just us two. We have an ecosystem that we've developed very close relationships with our legal partners, which is Kingwood Mallisons, with Deloitte's from the financial advisory side, and with Tanubu from the actual risk assessment side, plus also from the side of... sorry, and I know they're moving me on. So in summary, what are we asking for? We have two aspects here. There's transactional investors getting involved in the transaction itself, in and out. We're looking for $10 million in that particular area. On the equity side, we're seeing a lot of interest in that area. We had a roadshow about 3 weeks ago in Europe. And again, we're looking at about 15 million on the equity investor side. What are the key things to look at here? You know, first, people talk about burn rate. There's no burn rate here. I'll be very categorically open. We have a turnkey financial institution ready to go today. Everything's done, digital systems, platforms, compliance, regulatory, legal. And also in terms of, people always ask, how big can you grow? So the SAM is quite sizable. It's many multiples of the SOM. It's in the billions of size. So investors ask me, how much do you require to go? How deep are your pockets? This business can actually grow quite substantially. It's a business which is, and the funding only goes into purchasing invoices and running the business. Everything else has been handled.
Okay,
thank you very much.
Zoran. Thank you so much, Zoran. Next, we have Ulrika Lobo, Director of Blue River Finance.
Oh, sorry. Hi, I'm Ulrika, Director of Blue River Finance. Just going to make sure I've got the hang of this. Great. I'm going to tell you a little bit about us, go through recent highlights, discuss the current opportunities in the market, and show you why the private debt market is a diversification tool that should not be overlooked. Blue River Finance is a boutique first mortgage fund offering loan assets to investors with a target return of 7.5% per annum, which we've exceeded over the last 2 years. We originate, manage, and transform a portfolio of commercial loans secured by Australian real estate to mortgage-backed securities. We started this fund in 2020 as we understood the opportunity we could create for investors in providing liquidity to a market in uncertain times. We've transacted over 25 million in loans over the past 2 years, and we've had all loans come due repaid in full with no defaults, distress, or losses. This is a testament to our ability to adapt and make strong credit decisions, particularly in a time where there was no precedent set. Our record captures our activities when we were experiencing the highest impact of COVID. To provide investors with more comfort, Blue River Finance also became a corporate authorised representative under an AFSL since 2021. We have strong deal flow of 250 million annually, and we're offering our access to strong deals and our proven ability to manage loans from entry to exit as an opportunity for investors to diversify their portfolios without compromising on a high level of return. If you take a look at the diagram, you can see why there's a great opportunity in the first mortgage debt. Secured loans, in particular first-ranking mortgages, is the most secure debt position in the capital stack due to its indefeasibility of title and lender-friendly loan covenants. This means that you can enjoy a high level of capital preservation and a great return. As private lending is an inefficient market, this offers a premium return that outperforms other investments from a risk-adjusted perspective. The asymmetry can be seen as the same loan in the market can receive a rate of 9% per annum and 6% per annum by two different lenders, depending on their comfort and motivation to transact the deal. This is also because timing, flexibility, and complexity attract a private lending premium that's difficult to quantify but highly valued by companies. A private lender that can offer this will be able to strike a deal with a strong return. The overall risk-adjusted premium from a private mortgage debt is greater than other asset classes, as downside risk is mitigated by a first-ranking mortgage. As Peter Backer said in the panel earlier today, it's not just about the return on capital, it's a return of capital, and that's what we do best. Investing with Blue River Finance provides diversification to your overall investment portfolio, but also diversification within your investment with us. We do this by targeting underlying security across Queensland, Victoria, and New South Wales, and various borrower types. Our loan-to-value ratio, or LVR, which means the loan as a percentage of the property value, is an average of 68%. This means that on average, we have about 32% equity buffer across all our loan assets, should a borrower be unable to repay a loan. This is a great position to be in to have also in uncertain times, as the equity buffer also offers protection against fluctuating asset values. We're coming out of a low cash rate environment rapidly. Commercial flexibility, speed to transact, and reliability of funding are extremely important right now, and this is the premium liquidity that private loans offer the economy. As such, private lenders continue to grow their market share by 7.6% per annum year on year. Moving into the new economy, writing loans with loan terms of 12 months or less will be the prudent approach for us while reassessing our lending rates on a monthly basis. Assessing a borrower's ability to meet cash flow requirements and manage their liquidity will be important for exit strategies to stack up, as is working with businesses without strong ATO debt. Without high ATO debt, I should say. Lending against updated property values with at least 30% buffer on contracted as-is valuations is something else I look to do. Although investors rushed to bonds for stability after the fall of financial assets in 2020, private debt is a more profitable option with stable returns and a secured position. There are about $7 billion in commercial loans that come to the end of their loan term each year, not including new loans. With tightening serviceability, contracting asset values, and increasing rates, we'll see more displaced commercial borrowers in the coming years. These borrowers will need to use private lending to rebalance their assets and liabilities while they get through the credit crunch. They can use private lending to buy time to offload assets, swap assets, or make new investments to better their financial position. We're seeing offices and other commercial properties, in particular warehousing and industrial assets, have buoyant cash flows at the moment, and we expect it to continue over the next 12 to 24 months due to leasing contract terms. Overall, we expect that while oil prices increase, the market as a whole will struggle with inflation, recession, and rising energy costs. Managing uncertainty and timing will be critical during this time, especially as we feel the impacts of increasing inflation domestically following a low rate period. We anticipate the high percentage of owner-occupied assets, high ratio of household savings, low wage growth, and low unemployment will buffer some of the inflationary impacts locally. We anticipate this until the oil prices stabilize, which will create a turning point to support business recovery and growth as sentiment improves. In the meantime, we'll remain agile and responsive to changing market conditions while keeping capital preservation features intact. Our investment strategy is built around a targeted deal flow model from reputable agents in our network. We look at the character of the borrower, collateral security, capacity to repay, conditions of lending, credit history, the cushion dollar amount in the event of a default, the concentration within our portfolio, and the capability for cooperation in the face of unforeseen circumstances. Overall, we assess a borrower's creditworthiness, which includes their reputation, experience, financial information, repayment plan, and exit strategy. We also require property valuations from an independent, experienced third-party valuer. Our risk management strategy closely follows our investment strategy. Combining our due diligence on the borrower, property, loan purpose, and exit, we're confident in the viability of a loan. We ensure that we've got all the securitization aspects of a first-ranking mortgage, including a corporate guarantee and personal guarantees from the directors. We also make sure we review our portfolio design to ensure exposure across borrower types, property location, repayment profiles, and LVRs are balanced. We take an active management approach in accordance with capital preservation. We're looking to raise $40 million today to expand our loan book and offer investors access to high-quality loan assets. The minimum investment amount with us is $200,000, and we're targeting a minimum return of 7.5% per annum, but we expect to return more over the coming years as interest rates rise. We also have a special offer for investors looking to place $1 million or more with us, and that we're targeting a minimum return for them of 8% per annum. We have a stall today, so please come and talk to me for more detail on what we do. We've got a lot to offer an investor, especially with our active management style and our focus on capital preservation, particularly in these unprecedented times. When you invest with Blue River Finance, you invest in receiving a stable and great return and a diversified portfolio with a capital preservation focus. Thank you for your time.
Thank you so much, Ulrika. Next up, we have Sean Fox, founder of FOXI Capital.
Hey everybody. So if you've been here for a couple of days, you've seen me on this stage a few times now representing some of the other companies that I own. This one today, I've got an ask. So I've kind of just been up just talking and sharing information or on the panel discussion. Today what we're looking for, I've launched another fund, so we're raising $100 million. I'll tell you up front, I want $100 million. So everybody's got a check, come and see me straight after this. We invest in multiple different asset classes. We're also a full retail fund. When you have a look at us, you'll see we've got a retail front face and we raise money in that market. For the last 3 years, well, here's a bunch of things that we do, but the last 3 years, I've been raising on this project here, or 2.5 years. It's a mine, so it's a mine fund that I'm going to talk about today. So actual mining, physical mining. I've worked on a mine in Toowoomba for about 6 years on trying to get this deal. It took me about 3.5 years to convince the owner to sell it to me the way that he did. He was caught out post-GFC, had this mine sitting there. He was distressed. It was a distressed asset, but he was more emotionally distressed than he was financially distressed at the time. Brian, I'll give you a quick story. Brian, who had this mine, was a stone cutter. But when I say stone cutter, he had 300 staff at one point, built 2 tunnels in Sydney and a tunnel in Melbourne. So when he cut stone, he really cut stone. And he purchased this mine, and I joke with him that it's the world's largest hobby farm. So it's a sandstone quarry out in Toowoomba. When he didn't have guys working on something, he'd send them up there with equipment and they're just digging around and doing stuff. So when the GFC came through and he got caught out in his haulage business, he went from being a position in life where he had no debt whatsoever, and then he lost half of his properties, lost his business, he sold the equipment on the mine, kept the mine, but then had a lot of debt. And he's a little bit older, he's got a young family. And he discovered that what he wanted to do was stay in his own place. He started another haulage business, but didn't want to expand out past what he knew. He couldn't take another hit, if that ever came across. So Brian was stuck. He didn't want to sell the mine. He didn't want to operate the mine, and it was just stuck there. And I said, look, Brian, sell me this mine. And so what I did is I paid $5.2 million for it. And I don't know if any of you have an experience in mining, particularly early mining assets. The price of an early mining asset is what you decide to pay on it for somebody who wants to take. Right? So probably the land at that point was worth maybe about $1 million. We didn't bother assessing it. It had some permits on it. And it had what I needed, which was some early reports. There was some drilling. Not comprehensive. It was like he took a shotgun and a map and he shot it and said, that's where I'm going to put cores. Right? He was looking for colours of sandstone. Now, the reason I tell you this story is this is one of the methodologies that I use in assessing an asset. We see a lot of distressed assets. And what I did with Brian is I paid off all of the debt in his life, $5.2 million. is the price of the debt in his life, everything that he owed. If he owed money on cars, the guy down at the fish shop for some chips, whatever it was, we cleared that up. And what that did is that saved his relationship. Because I don't know if you've ever dealt with a distressed asset or if you've ever been in the position that you're really strung out in a business, right? And one of the first hurt points is your marriage, right? Because you borrowed money from her mum and from your grandma, and it's a stressful time. So paying off that debt fixed up his life, and he went back to no debt in his life whatsoever. We took over the asset, and I left him 20% ownership. So he got everything he wanted. He still has the mine. It's a legacy site for him. Now, this mine's amazing. It's 113, and look, we've pretty much finished on this one here. 113 hectares in Toowoomba. It was a sandstone mine. We knew it was silica, so we needed to get in there. We needed to proof up that site. So what I did, we spent about $16 million on it, and we went from $5.2 million in the purchase price to an as-is valuation, sellable valuation, full measured JORC report of $122 million within 2.5 years. The future valuation you can see there, which will be in the next 2 months, is $416 million. That's the as-is sellable. If I close my eyes and sell it to Boral, that's what they're paying me for that particular site. And I know that we've got that valuation because I just got the reports back from the lab, and it's sitting with the geo, and he's got to give me the reports and release it. So what that story that I'm telling you there is, that's my history, my checkable, searchable, factual history in mining, how I assess mining projects, how I assess a good venture to be in, and then raising money, and then what we can do with it, we'll turn it around. Now, we'll turn that on by Christmas. That's fully permitted. We can do 1 million tonnes a year out on the roads. We've gone through the whole process, and now we're just putting working capital into the site. And we're estimating to make somewhere between 170 and 230 million a year on that site. So that's a pretty good one. Out of all the different mines I look at, sand's my favourite. Unlike with the gold mines that we have, you have to move dirt, pick up dirt, wash dirt, and then you've got some money in it. On a sand mine, you just pick it all up and you sell it. What I'm doing is raising $100 million. Over the last 18 months, we've assessed 270 minings, predominantly in Australia and some in North America. Of those, 37 we really enjoy. A lot of them came from that distressed asset. We always keep those owners involved. And what we do is we pick up their networks, their knowledge within the space. We ended up finding some more mines that we wanted. What I've also done, like I love infrastructure. If you've heard me the last few days, I've talked about infrastructure, and it's in every industry. So what we're also buying is we've got 3 drill companies that we've assessed, gone through the process, and we're going to start putting offers down on them. And the reason for that is every time I go to do some research on a mine site, I'm waiting 3 to 5 months to get those drill companies out there. There's just such a demand for it. So it made sense to me to buy them to make sure my mines are getting assessed first, and then putting that out into the market. The strategy we have with this, so it's a $100 million raise. We have a really, really good timeline and sort of pipe of the mines that we'll be settling. And some of them will be going through like the Pleasure Point mine, where we're going to be proofing up their balance sheet to full measured resources. So very, very strong assets. Others are either in production now or were in production, so we can turn them on. So we'll be looking at, and when we say here, targeting returns, this mine fund that people will be buying shares in, that fund itself will then be lending to those individual mine sites. So we'll be lending, and we're targeting around about sort of 12% lending terms on those. We'll capitalise the interest in. And then, like we're doing at the Pleasure Point mine, we proof them up to a certain point and we replace it up for the much cheaper debt that's out there. And I don't know if you've had much exposure to the mining industry. Institutionals and banks, whatnot, don't want to lend to mining operations until they're at that measured resource or until their operation. But if you've ever been involved in a mine, once you're in operations, you're making a lot of money and you don't really need the banks anymore. So it's a bit of a chicken and the egg approach. And that's what this fund is doing now. So we'll be funding those early stage mines, but we will own them. So 15% of every single asset that we invest in goes to the fund. So if you're investing with me, the dividends that you're getting are from interest on loans and also the equity share. Like the shares that you own in that fund is then owning 15% of every single asset of those. Potentially 37 is what we're assessing at the moment. We'll see what we're left with. The last part, and tying it all together, tokenization. And everybody in this room, I'm sure, has invested in funds at some point. And if they're not listed, it's hard to create a liquidity pool for it. You're in, until the end of that approach. If you're looking at mortgage funds. Or until somebody doesn't offer an acceptance and wants to buy it from you. So what we're doing is we're tokenizing all of our funds at the moment, which we're listing on our own digital asset exchange that I've been talking about the last few days. And so that creates a liquidity tool for you. Now, My, I'm not giving advice, but my recommendation is any of the shares that you hold in any of our funds, probably don't sell them because they're very, very high dividend paying assets. And if anybody's seen any of my media online, the YouTube channels and whatnot, I don't like to sell anything. If it's making me money, I like it to sit there and then go make some more to bring that in. But guys, that is my talk today. Feel free to come down and have a chat to us. Give me some money if you've got some, but have a good day.
Fantastic. Thank you, Sean. Up next, we have Simon Odell, Managing Director and Co-founder of InsurTech Gateway.
Thank you. So we are InsurTech Gateway Australia. We attract genius founders to solve big problems and in doing so reinvent insurance. Founders struggle to break into the $6 trillion insurance market due to startup killing barriers to entry. InsurTech Gateway is Australia's first independent and regulated incubator, unlocking the insurance industry to global founders. From an annual pipeline of 150 InsurTech startups, we identify and back the 2 to 3 who are ambitious enough to solve some of the biggest challenges we face today. We provide cash and services to help them build an MVP, prove their idea and achieve product market fit. In exchange for cash and services, we achieve equity. As the world's challenges increase, serial founders are flocking to Gateway with their ideas. We're raising capital to help support them. So in a bit more detail, the problem, the insurance is highly regulated. It's very difficult to launch MVPs. Often founding teams lack the credibility needed to secure critical insurance partnerships. There's operational and compliance difficulties, and this leads to high failure rates. We provide licensing in 2 weeks, not 52 weeks. We provide access to global insurance partners. We provide pre-seed investment capital, and we provide a venture building platform. This is often where a lot of the magic happens. We provide mentors, resources, and an InsurTech playbook. We have very happy founders. This is Gil Sneer, founder and CEO of Audit Cover. I'll read his quotes here. Lean startup methods are not enough to break into InsurTech. The 3 primary reasons: securing an insurer to take on risk capital for an unproven product and team. You need to be authorised and regulated to sell insurance, and the user experience, product and service needs to be compliant as to our operations. I would hate to think how long it would take us to launch, at least 12 months. The solution for us had to be Gateway. They helped us launch in weeks. The red line here shows the cash that we invest. The blue line is our number 1 performance metric. We've achieved just under 2.6 mil a couple of years in on our balance sheet in portfolio value. As you can see here, the red proportion, we achieve the bulk of our value from our sweat equity, our services, as opposed to our cash. Where are we now? We launched in 2020. We have 5 portfolio companies and the value is 2.6 mil. Our 5 portfolio companies are rapidly growing up the growth curve as we bring new InsurTechs online. Where are we headed? As a proxy, I've overlaid our sister company, the InsurTech Gateway Incubator in the UK, who started 3 years prior to us. They have 3 portfolio companies valued at over 200 million and are doing quite well. To help attract the best founders and generate greater certainty of success post-incubation, we've provided 2 follow-on services. One is the InsurTech Gateway Fund, which is backed by global insurers. That provides late seed and Series A investment capital. And the Global Incubator Network. So we have incubators in the UK, a pilot starting in EU and the US to help with replication once product market fit's achieved in the primary market. Looking at the bar chart, InsurTech is one of the fastest growing and hottest spaces in venture capital right now. 15.8 billion in funding volumes in 2021, which is more than double the prior year. Looking at the pie chart, you can see that it's just a drop in the ocean compared to the size of the insurance industry. InsurTech is just getting started. I'd like to pull back the curtain a little bit on the way that we at Gateway look at InsurTech. We're the most prolific backer of InsurTechs globally between our incubators and the fund. Horizon 1 represents the first wave of InsurTechs, which is essentially tech fixing insurance, fixing the way insurance is currently done by deploying technology. An example in our portfolio would be Cobra, that do a pay-per-kilometre car insurance. They're not necessarily bringing new premium to the market, just essentially creating more competition and shuffling the deck chairs, as they say. Horizon 2, insurance fixes tech. So think about decentralised platforms, crypto, blockchain, shared economies. By bringing Lloyd's of London and A-grade underwriting paper to decentralised platforms, it helps bring legitimacy, resilience and strength to decentralised platforms to allow them to thrive and flourish. That's a really exciting space for us, Horizon 2. An example, a portfolio company example, is CoinCover, who came to our London office, I think it was 2019, with an idea to insure crypto assets. Some of us thought it was a bonkers idea, some of us thought it was brilliant. They're now in market insuring over $1 billion in crypto assets. Horizon 3 is quite exciting. It's combining tech and insurance to fix global problems. A portfolio example is Kita. They're the world's first insurer of carbon credits. So Kita removes the carbon delivery risk from buyers and sellers in the carbon market. Our portfolio of 5 in Australia and 20 in the UK have a fairly consistent blend across these 3 horizons. In concluding, word has got out that the insurance market is open to founders. InsurTech Gateway, as I mentioned, between Australia, the UK and our fund, we're the most prolific backer of InsurTechs in the world. We have inbound inquiries daily from climate scientists, physicists, NASA engineers, data scientists, all wanting to break into InsurTech to solve global problems. And we've got really exciting deal flow in the pipeline, and we would love to back more. Our team is a combination of successful startup founders and long insurance pedigree. Robert Lumley from the Lumley Insurance family had a global insurance business, plus, as I said, a mixture of successful startup founders. So we're looking to raise capital at the moment. 50% is subscribed from our existing shareholders. We're leaving 50% open for new strategic investors. Please reach out. Thank you.
Fantastic. Thank you, Simon. Up next, we have Brian Collins, FinTech and Food Tech Managing Director of Startupbootcamp.
Good afternoon, everybody. As mentioned, my name is Brian Collins. I have the pleasure of being the FinTech Managing Director at Startupbootcamp Australia. And for whatever reason, every time I come to the Wholesale Investor events, I always seem to be near Shane. So I'm just going to go off of his piece. We're raising $5 million currently for a new sustainable FinTech fund. And I'm going to talk to you a little bit more about what that means and what that is today. But the first question you might be asking yourself is, what in the world does sustainable FinTech actually mean? Well, back in 2019, right before COVID hit, Startupbootcamp globally, and we'll talk more about the business in a second, declared that we would make sure that all of our programs, everything that we ran, would be tied to the UN Sustainable Development Goals. And you've heard the term sustainability over and over in the news. We hear about it in terms of energy transition, we hear about it in terms of circular economy, but we don't often talk about what role sustainability has to play in the finance sector. But you might have heard of something called sustainable finance. And this is really important, especially in a country like Australia, where depending on the report you look at, it's either the 1st or the 7th richest country per capita in the world. That means that the decision of where each of us in this room manage, bank, and invest our money is one of the largest ways we can lead to a more sustainable future. Now, the concept of sustainable finance is not new. It's been jumping around since about 2016, 2017, really started to make its own way in 2018. There's a ton of different reports that you can look at in the sustainable finance space. There's one that I particularly like, which is the Boston Consulting Group report, which came out in 2018. At the time, their headline number, they declared that in 2018, there was already $30 trillion earmarked for sustainable investments. but they also declared that they believe that that number, that the industry of sustainable finance as a whole, would grow to reach $30 trillion in the next 5 or so years. That is a huge change considering they put that current market value at about $50 to $100 billion. So with a huge industry shift like that, as angel investors and startup investors, we have to ask ourselves, is there a startup trend moving in that way as well? Many of you may know that fintech is the largest portion of the startup space. For every dollar invested into startups globally, 54 cents are invested into fintechs. There's 2 ways to make money in the fintech space. You either have a really large fund that you're investing $30 million minimum check sizes in, and you pick the winners, or you figure out what the next delta is before it becomes that major delta. Think blockchain in 2014, buy now, pay later in 2017. Every year we look at between 20 and 30,000 startups to pick the 10 different companies to come into our FinTech Accelerator program. And what we do is we look at the trends across what those startups are focusing on and what those FinTechs are focused on. After we started looking at the UN Sustainable Development Goals and doing a deeper dive into sustainable finance, we pulled the keywords out and put those into the trends. Before we did that, we saw huge increases of 200% increases around asset and wealth management, future of finance, which includes blockchain, Web3, cryptocurrencies, and financial health and well-being. This data, by the way, is from 2019 to 2021. But when we put in the UN Sustainable Development Goal keywords, as well as a variety of other pieces around sustainable finance, it was extremely clear sustainable finance was the largest increase of where founders were putting their time in the fintech space. So we believe that there was a huge opportunity there, which is why we've decided to launch a new Sustainable FinTech Accelerator program, accelerating 10 different companies a year for 3 years, or 30 companies in total over the next 3 years. This is backed by our Sustainable FinTech Fund. Now, to do that, and I keep referencing the UN Sustainable Development Goals, we've taken a deep look at those goals and pulled the 8 out that are most either directly affected by or can affect the financial industry. We've broken those into 3 different categories: financial well-being and inclusion, sustainable business practices and communities, and financing for a sustainable future. What we then did is, this is no longer a guess for us. We built this hypothesis last year, and during last year's program, we actually used these as our key criteria to determine which companies, for-profit businesses, that we would be investing in. I'll talk a bit more about how the portfolio is doing in a bit, but let's just say that last year's fund is the fastest growing fintech cohort we've had so far by investing and utilizing these criteria. Even though in every report you look at globally at the moment that shows funding is going down, there's 2 areas where funding is staying consistent, and that's climate tech and sustainability. Now, the difference between investing in an accelerator versus investing into a fund is that when you invest in a fund, you invest $1, and by investing that $1, you get $1 of equity back. Because an accelerator works with startups over a long period of time, usually at least 3 months, we work very directly one-on-one with them each and every day. The investment portion is one portion of how we gather our equity. It's also service-based. It's also working directly with the founders, getting them POCs and pilots, gaining them later investment. That means that instead of $1 for $1 of equity, we are immediately able to get $1 with our $1 of investment, $3 of equity, and even higher if we raise above our minimum of $2.5 million to get up to $5 million. It could be as high as $4.25 immediately in portfolio valuation. Now, if you haven't heard of Startupbootcamp, we are the world's largest industry-focused accelerator. We started in Amsterdam in 2010, and we've expanded around the world. We started here in Australia in 2018, but globally, we've accelerated over 1,000 startups. The number we are most proud of is that next number, 76% active. If you know anything about the startup space, you know that the normal number we associate with startups is 1 out of 10 succeed. We've almost 8x that with the process that we use to keep our startups going, to keep them engaged, and to keep them focused. They've also raised over $2 billion globally. And it's not just startups we work with. We work with global companies from all over the world because they know that this process works. Our previous FinTech program, our Financial Health and Wellbeing program here in Australia, had the pleasure of working with Bupa, Australian Super, NAB, Capgemini, EY, Deloitte, Dias, and many, many others here in the Australian space. And then globally, we work with all of the companies companies you see here. Because again, these companies are looking for real opportunities with fintechs all over the globe. Now, I mentioned I talk about the portfolio, and I did want to bring that up. As I mentioned, we've been running a program for the last 3 years. We've invested in 27 companies during that time, and the portfolio valuation of those businesses has now increased to $190 million in just 3 years. We invest globally, not just in Australia, but all over, including the US, the UK, and a variety of other places. Last year, we invested in our first Fijian company. And if you haven't been looking at some exciting things coming out of the South Pacific, especially with fintech, there's some amazing opportunities out there. Again, we're looking at 20 to 30,000 companies a year to find the best companies that we can work with to fit into our new sustainable fintech program. And again, just to prove how well this process works, taking from some of our global programs as well. We see the biggest exit that SBC's ever had, which is a 300 million euro exit to Munich Re, as well as a neobank out of Africa called Kuda, which just became a 500 million euro business. So what we're looking for today is, for many of you, we know that this might be your first investment into the startup space, so we've tried to make this as easy as possible. Our minimum investment is $25,000. That's it. For $25,000, you're getting equity access across 30 different companies over a 3-year period. We're 70% of the way to our minimum, which allows us to launch the first year of the program and get going, but we're looking for a total of $5 million. So $25,000 minimum, $450,000 maximum. I'll be around for lunch, and I'll also be here at the event tonight. Would love to talk to you if you think this is of interest, or if you think that sustainable fintech is an important part of where we should be putting our future for a sustainable and long-lasting future. Thank you very much.
Thank you so much, Brian. Up next, we have Dermot Butterfield, founder and CEO of Wych.
Hello, everybody. I'm Dermot. I'm founder and CEO of Wych, as I mentioned. I'm here to talk to you about open banking. Recent Australian Reserve Bank survey showed that 50% of Australians and homeowners would be facing serviceability stress at 2% OCR. New Zealand one showed that at 5% retail rates, 20% of first-time buyers and first-time buyers and investors would be facing serviceability stress. We're already in this zone. We've passed the 5% in New Zealand. We're already at 1.35 in Australia. People are experiencing the pinch. So whether you're a bank, a mortgage broker, or other service provider, how do you gain, maintain, and retain customers with this type of pressure? If we start at the beginning, there's more than 250 fields on a standard mortgage application form. How many people spend time filling these forms in? How much time do they do? How much time do the mortgage brokers spend supporting those customers? How many of those customers are not in a position to purchase? How many of those customers don't make it all the way to the end? How do we help those businesses make those better decisions? Using our white label solution, we provide a simple process that takes the hassle out of managing your customers' finances. By connecting to the bank using our open banking solution, we streamline the process of customer acquisition, maintenance, and retention. Apologies. If we look at an example, this is Jack. He wants to buy a home. He can pay rent, but can he afford a mortgage? This is where we can help. We can show what Jack can afford, what his deposit would look like, what his interest rates and other expenses would be, his rates, body corporate insurance, how that would impact his commute, average power bill, average cost to maintain, and compare that to another location. This week, we head to Brisbane to talk to a bank who would like to see how we can help their customers. Right? So this is a real-world example. This is Olivia. She's feeling the pinch. The interest rates have gone up. How can we help her manage her finances? Right? The bank can see that because of the interest rate changes, there's already between $900 and $1,200 increase per payment for their mortgage customers. How are they going to be able to accommodate that? Well, we can help them understand where their income and outcome is going, what their monthly expenses are, changes to utilities, people like her, areas insurance, and understand how she can change those pieces. The market opportunity is substantial. We've built a product that can service customers in Australia, New Zealand, the UK, and Europe. We have the ability to do that using our standard SaaS product. forgive me. All of the customers we have about 1,000 customers, we have about 1 million customers in our pipeline. They've all come to us off the back of our accreditation. That allows us to essentially scale very quickly. What that looks like is a competition space where the competition is regionally segregated and predominantly read-only. Forgive me, the notes are incorrect on the screen, so I'm trying to... We provide the write-ability where most of our competition only provide readability. That allows us to make changes on behalf of the provider. So imagine your bank, we can pay bills on your behalf, we can move money between your accounts. We can affect change in their customers' outcomes. The second piece is most of our competition is regionally segregated. So a provider who wants to provide outcomes in more than one region has to have multiple partners. We can do that in one space and we can connect the dots between those pieces. Our go-to-market plan is a dual acquisition strategy of partnering with business and directly pitching to enterprise customers. By initially targeting banks, mortgage brokers, and superannuation providers, we have the ability to free up their customers' money to target their products. From there, we have the ability to swiftly deliver their users' goals, capture and engage. And using social proof campaigns, we'll build on the active community for their digital village. We're a Microsoft co-sell partner. That means that we have the ability to convert their capital expenditure into operational costs, which means that they can reduce the burden of getting it over the line within their businesses. Further, we have 2 MOUs signed, a 3-year contract in place, and discussions with 2 more partners. Together, it gives us a pipeline of just short of 1 million end users. That 1 million end users will give us an MMR of between 1 and 3 million Australian, because we have a subscription-based model. Before we take into account enterprise support, customer integrations, and bespoke changes which the providers are interested in. This is our pricing. Look, it's been a bumper year for Wych. We launched our alpha product in August. We got our CDR accreditation in December. We signed our first partner last October. Our beta launched in March, and our paid product launched in May. There's a lot done, more to do. This is me. I'm Dermot Butterfield. I started my career almost 20 years ago in Intel, the chip manufacturer, focusing on delivering insights and business focus. During that time, I acquired valuable experience in automation, data, and software development. I've specifically spent the last 12 years helping startups achieve their technical goals, including taking a business insight company from concept to IPO as a chief architect. It's these skills that I bring to Wych, and which has enabled us to deliver what we have. On our team, we also have Amy as head of comms. She's a marketing guru who keeps us on brand and helps turn this language into something that works with customers. Much easier when you put somebody who can do that. Alan is our lead engineer. His expertise is across multiple spectrums, allows us to essentially expand in our technical space and do so always within the right decisions. And we're raising 750,000 to expand our team to be able to onboard that 1 million customers that we were talking about that are sitting out there. Currently, we can do so at about 1 a quarter. That's 1 partner a quarter. We'd like to be able to expand that to get those customers on board as fast as we can. Second piece is increase awareness. All of the customers we have come to us. So those partners have come and knocked on our door and said, I like what you're doing. I'd like to be able to put it on board. We'd like to make sure that everybody's aware of us, and so we want to expand our awareness. And the last piece is partners. When you do what we do, security, compliance, and all those pieces are very important. We want to be able to demonstrate we have the ability to grow and meet the requirements, because this is a regulated industry. And we're going to be using our certification. We want to make sure that the banks and the mortgage brokers who we're working with are confident in what we're doing. That's essentially my speech. If you'd love to come and talk to me, I'm the one at the gold table in the main room. Otherwise, look for us on CRISP. And by all means, reach out. Thank you.
Thank you so much, Dermot. Up next, we have Travis Clark, Managing Director of Marketech.
Hi, I'm Travis, the Managing Director of Marketech. But first things first, you're all pretty techie, so you should have heard of BrainChip. It's a computer chip that's supposed to be able to learn. It listed out of Perth back in 2015. But by 2019, it was still struggling for direction. So they set about looking for some alternative uses for the chip. The most obvious thing that a capitalist will want to use artificial intelligence for is to make money in the stock market. Now, just like a human brain, the brain chip doesn't know things. It has to learn, and you'd have to teach it. So for it to be good in the stock market, it would first need a really good trading platform to learn on. Sure, you can buy and sell shares on a cheap and cheerful Robinhood-styled platform, but if you want to be really good at it, as a human, you will need something like the professionals use. In Australia, the professionals use Iris Pro, but it's at least $400 a month, plus the high cost of market data, which can take it well beyond $800 each month. Iris originally built the ASX online trading technology back in the 90s. They built the ASX data stream, order router, and the trading platforms. The platform they put online for the online brokers to then upsell probably ran on something like Windows 3 to start with. Naturally, they're a bit better now, but they're still not Iris Pro. So retail investors are all trading the riskiest real asset class with a product that is below the standard used by that of the professionals, which doesn't really seem fair. It also seemed unlikely that Iris would let us hack their IP for the brain chip money machine. Luckily, Marketech were also based in Perth. They'd built a live stream market data scanning engine called FastIQ. And being a lot newer than Iris, it was already in the cloud, so it could be easily scaled and would operate at full strength on a mobile phone. They'd already spent millions on it, and because it was based on a live stream scanning engine, it would be the perfect sandbox for our robot trading machine. Anyway, after reviewing the brain chip function at the time, it became pretty obvious that the idea had a few holes in it. But what we did discover was that the Marketech platform has the potential to be a huge money spinner. So we funded it by cornerstoning some of the brain chip founding investors and focused on commercializing just one of the many products that Marketech's FastIQ engine could power, the perfect online trading platform for serious and active retail investors so they can compete on their mobile phone against professional traders. Well before COVID and Robinhood, the online brokers were the banks or CMC or Bell Direct, which all have a virtually identical business model. They make their money off brokerage. Then they offer you a simple free website that you have to keep refreshing, and then they upsell you to the web-based Iris platform. They make their money on the churn, which the Hayne Royal Commission hates, and then another company altogether owns the tech. So there are these two big, lazy profit margins that we could combine into one, with much newer tech who weren't likely to compete. At the time, we guessed that CommSec was averaging about $20 per client per month, with only their heaviest traders making them money. Live ASX data still costs money, even if your clients don't trade. Ours is live streaming, like the pros. So we put a $20 margin on top of the $20 monthly ASX data royalty, added on the GST and called it $45 a month. Then we needed feedback from real-world traders, but not the casual traders, definitely not the Reddit army. Sticky, wealthy, long-term stock market addicts who will still be around after the market stops going up and still have all the money. Yes, the forgotten Gen X and the boomers. We first connected our platform to third-party settlement to let people trade on the market, and a Macquarie cash management account because retirees love their interest, and after the GFC they won't risk pooling their assets ever again. Then tax reporting, and finally market commentary. At this point though, I'd like to thank the ASX because we could open source you our code, but then you'd spend the next 2 years working out how to get a stable trading connection and clean data from the stock market itself. Or you could build a Robinhood using instructions off the internet, but you can't use a Robinhood if you're a serious trader, or to teach a robot trading machine how to trade. So it's a very, very wide moat that we've now crossed. Then we ran a few ads to get a sample set of hard traders, and trade hard they do, with brokerage from $5 on HIN and live streaming with all the charts and alerts and tools and insights that a pro trader needs. Marketech focus is really, really good, and it will only get better. And it's only $45 a month. So anyone doing a couple of decent trades at CommSec would be better off, and they'd still be paying a lot extra for a proper trading platform. Then we set about perfecting the layout and the feature set. Using the power of online feedback, where people will definitely tell you without any filters what they need in a platform to make money with. Now we've almost finished perfecting it in every way that they could imagine for us. And if you don't believe me, there's a 2-week free trial on our website. A trading platform has to be live and functional almost every weekday of the year. So to move an old system from the cloud and onto mobile is expensive and highly risky. The only other serious trading platform, Iris, has a virtual monopoly and much bigger growth projects to work on. So CommSec Iris and NAB Iris and BellDirect Iris and CMC Iris are still only fully functional on PC and twice the price with higher rates of brokerage on top. There are about 1.4 million people now that the ASX calls active online traders, but we think that number should drop back quite a lot in a bear market. Still, at $20 a pop, that smaller addressable audience still represents a whopping $168 million profit a year. Based on our current conversions, it seems to immediately suit the most valuable 10 to 15% of ASX traders, but its low price should increase that audience significantly. And we don't believe the current alternative will be updated, and we don't believe anyone else is working on a replacement. So now, we just need our slice. Our retail brand is the only one that is true fee for service in Australia, and therefore the only company that doesn't care if our traded volumes drop. It means that our motivation is to make the platform better, not to convince you to trade more often. We could build up that retail brand, and anything over 8,000 subscribers would be profit, but that would require a much bigger marketing spend. So we would be keen instead to list on the ASX for its free visibility. Or we could white label it to the other online brokers or normal stockbrokers with a much lower break even. And there are about 1.4 million people paying more for less, or about the same, but for a lot less, just in Australia and just online on the ASX. But we could also turn Marketech into an advisor platform, or a Forex trading platform, or even crypto, any tradable market in any country. But the jewel in our crown is actually our algo scanning platform, which is due out later this year. You'll be able to tell your phone what you look for in a trade, and it will scan the market for your trades in real time. You'll be able to come up with your own trading system, learn from your mistakes, get better at trading. In other words, you'll become the brain chip, which you can't do if you don't have a professional grade trading platform to learn from in the first place. So what happened to BrainChip? Well, it's actually done quite well. At one point, up a few %,000% from its lows, and still holding on to a $2 billion valuation. So the BrainChip founding investors that have now backed Marketech are very happy indeed. So now all I have to do is replicate that success for them. Marketech offers the only live stream pattern scanning engine that you should invest with or in because you respect money. Thank you.
Brilliant. Thank you, Travis. Up next, we have Peter Smythe, the founder of Hound Group.
Good afternoon, everyone. I'm all that stands between you and lunch. A difficult position to be in. I'm the founder of Hound. What's Hound? Well, Hound is a new SaaS platform specifically developed and designed for mortgage brokers to drive growth and profitability through customer retention. It might sound strange, but there's absolutely nothing around like Hound at the moment. This is a new space. Let me set the Australian mortgage broking scene for you, if I can get the slide to change. Why won't that change? It's eating up my time, Megan, and the slide won't change. Ah, we're there. So the Australian mortgage broking scene. Brokers currently settle about 2/3 of all mortgages in Australia, and they manage about half of them, all of them. But they don't have the appropriate equipment to provide ongoing service to their customers. So what this means is that customers find that they don't know whether they're in the right mortgage and they don't know whether they're paying too much. And this means that these customers are vulnerable to approaches from competitors, and so therefore runoff is very high. If you're a mortgage broker, you probably lose 20% per annum or more of your customers every year. That's not a viable basis for a business. Hound changes all that. And it's still not moving. It is now. So where are we up to at Hound? Well, we've got significant traction with a major financial group, and that gives us access to over 1,200 brokers. That's a great start, but we've got to go on from there. We have an industry-leading team, and I'll show you some pictures shortly, that have extensive experience in the sector and have a wide network of relationships. And this, the mortgage broking business, is very much relationships-based. So they are leading us out into the mortgage broking world. And our sales and marketing plans are well underway. Data and technology are actually the Achilles heels of the mortgage industry. Today, no one has the full picture. Not lenders, not aggregators, and not brokers themselves. No one has the full picture. So at its core, Hound is a data business for brokers that puts them in control of all their customer data for the first time. Again, remarkable that I'm saying this here in 2022, for the first time. And part of this, an important part of this, is giving brokers access to open banking. This is an innovation that puts Hound very much at the forefront. So with all that in mind, let me show you what a day in the life of a mortgage broker looks like. This is a mortgage broker's year. They operate in a world of complex, clunky, archaic, unfriendly industry processes. And guess what that means? That means they end up wasting most of their time, locked in these processes. So this graphic shows what happens over a year for a typical mortgage broker. They start the year with 130 customers. Over the course of the year, 30 of those run off. And remarkably, in most cases, the broker doesn't even know they're gone until they disappear from the commission statement. If they're lucky, they might capture 5 of those. But most of their time is spent on acquiring new customers and completing loan applications for those new customers. So with no time being spent on their existing customers, guess what happens? They run out the back door. So they end the year pretty much as they started, back at 130 customers. Very busy, on a hamster wheel, going nowhere. And brokers operate this way because of 2 fundamental problems in the industry. One, they don't have access to adequate and complete CRM data on their customers. And 2, even if they did have that, they've got no technology to interrogate that data to actually manage retention of their customers. So the end result is brokers work really hard, and while they're trying to build value in their business, they end up building no value in their business. And yet the reason they got into the industry in the first place was to build an asset they could sell so they could retire. So what does Hound do to solve all this? Well, we solve the problem by bringing all the data for a broker's customers together in one place. And we keep it up to date. That's the first thing we do. Importantly, this database belongs to the broker. At the moment, the broker doesn't have that. But the broker, with Hound, the broker has a database that is theirs and theirs exclusively, and they have full access to it always. Furthermore, Hound then uses a whole lot of clever tech to do the grunt work, to trawl through that database and pop out for the broker those customers that need to be contacted now, people with current servicing needs. And it sets up those appointments for the brokers. It also automatically does annual reviews. At the moment, brokers don't do these because they don't have the time and they don't have the information. And by not doing these, of course, this is at the root cause of why they get so much runoff, because they're not providing annual review ongoing service. So the proactive service that Hound's providing, right customer, right message, right time, means that runoff slows, retention improves, and the broker can grow their portfolio. In addition, Hound also tracks key performance metrics for the broker and reports them regularly. So the broker can actually see how value creation is building in the business, rather than waiting till the last minute when you want to sell your portfolio and then get a rude shock. This way you can track with the metrics the build-up of the valuation of your portfolio for its future sale. So the graphic here simply shows you the before and after situation, with the orange bars demonstrating the growth that Hound brings to the platform. So what's the competitive framework look like? Well, brokers are reliant upon the SaaS platforms their aggregators provide, because that's their gateway to lenders. But these platforms don't do anything to help them manage the back book of their existing customers. Only Hound does that. How do these platforms compare? Well, the aggregator platform, as I said, doesn't do anything to manage the broker's back book, and the repricing tools like Sherlock, they're just doing those transactions, not the full capacity, so the benefits are also limited. So it's only Hound that does the full job for the whole back book, and that's why our target extra revenue is 6 times the extra cost of using Hound. A little bit about the market. As I said, brokers rule, brokers dominate the market. Today, the revenue pool is about 3.4 billion per annum. But this is an industry which is in transition because some regulatory changes and compliance changes are driving traditional mortgage brokers out of the industry. And the go-to business model is transitioning away from transaction-based to being value creation. So this is forcing consolidation, greater utilisation of technology, and getting together to share costs. So if we look out 5 years, we reckon that 18,000 brokers licensed today will compress down to an addressable market of about 12,000 brokers managing 2.5 million loans. So what does this mean for us financially? We're targeting to penetrate 20% of that addressable market in 5 years' time. So that's 2,500 brokers and about 500,000 loans. That'll give us a bit over 20 million revenue. It'll give us profits of 7.5 million. But the important thing to note is this is just from doing the broker SaaS platform. This is not doing any of the other growth opportunities we've identified that will be enabled by this SaaS platform. We're actually looking to exit at a 10 times multiple somewhere along this journey, and we expect that'll probably be in conjunction with the transaction to actually pursue those extra growth opportunities. So that makes sense. What are we looking for today? We're in our Series B raise, looking for $2 million, but really 1.25 is our hard target. We're already most of the way there. We need another 400,000, and we'll close the round in the third quarter. We're going to use the funds to ramp up our sales efforts, as I said earlier, and we want to put 50,000 loans onto the platform in short order, and we want to bring on a CEO who's going to help drive the business at a day-to-day level. I promised you a picture of the team. There they are. A whole lot of smart tech and data people, as well as a whole lot of mortgage industry luminaries, and that, ladies and gentlemen, is Hound.
Thank you so much, Peter. Up next, we have Carlton Teyer, founder and CEO of Syncogate.
Good afternoon, everyone, and thank you for your time. Most appreciated. Just make sure I get this. So nobody in the room is going to argue with the importance of education, and it takes a great man to reinforce that education continues at all levels, from young right up to adults. Now, we are an education technology company. For those of you that don't know, EdTech or EduTech. I put a brief description up there, and in fact, I'm surprised that despite we've had pandemics and we've had the increase in digital learning, home learning, remote learning, and we're the only EdTech company that's presenting at this event over the last 3 days. So, children, what's the problem? It's the way our children are learning today. The models are the same they were 50 years ago. They haven't changed. And the models are broken. Our kids are growing up with digital devices, they're growing up with digital technologies, and yet education is not teaching them the same way. And that's in essence what our company is doing to try and change or alter the mold, I won't use the word disruption, of teaching and learning systems. Now, a little bit about our company. We merged two businesses not so long ago. We are a content company. We've got access, we built up access to over 3 million pieces of digital resources, whether they're books, whether they're journals, whether they're research material, from over 12,000 publishers, from the great Oxford and Pearson down to very small publishers around the world. The other organization, Gate, of course, built an incredibly innovative learning platform built on artificial intelligence using gamification, and it was more about engaging and energizing students, starting off at kinder right up to grade 6. So we brought our two companies together. Now, most of the challenges we face in mergers is the alignment of things like visions and people and processes and culture, etc. We are very fortunate that our two companies share the same vision. And up on there on the slide are many of the areas where we're aligned together, and it's the basis of our strategy and plans going forward. Some of the important highlights, most of you in the room today are investors. So what you really want to know is, how is your company differ to what's out there? Now, there are many learning platforms. There are very few content aggregators like our business that has such a large portfolio of resources that we can offer. But bringing together the two, the content and the platforms, and it's a very smart platform in the sense that while today it's being applied to children, we plan to take it into the adult area in vocational education and do other things with it. But we own our own IP, so we have the flexibility of doing different things with our platform. I was talking to someone not so long ago who's got a great idea in the medical area and how we can actually incorporate our platform for some of those type of programs. Education is a broad-based sector, and it means that it's an ecosystem that you have to form through partnering with different organizations. We've built our business on the depth and breadth of our products that we have today. Whether it's in the content side, whether it's on the learning platform side, whether it's in a combination of providing tuition-type programs to kids, as I've talked about, that's the depth of what we've got to offer the market today. And more importantly, as an innovative company, we're continuing to innovate and introduce new products. Things like our children's e-library, which is scheduled to be released later this year, is essentially going to be the jewel in our crown. Reading is vitally important across the world, especially in China, and that's something that we've earmarked as one of the big growth areas for us. In addition to that, we are going to become a major player in the vocational education area, and of course, we have one eye firmly set on the metaverse. As a totally digital company, we think that we are well positioned to build, the education of the future in the metaverse, and that's something that we're very much focused on doing. Now, what brings everything together, our strategy, our plans, our products, etc., is our go-to-market model. And it's about playing in the right market. For us, the markets that we are very focused on are the Asian markets. The Asian countries that are in the emerging and developing stage is where we see the greatest opportunity for our products. The range of products that we've got have to be customized for all these markets because education is about nuances in these different countries, and we've got to be sure that we can comply as we do in every country. And the third element to what we're doing is our partnerships and forming strategic partnerships like we've done with two very large government organizations in China. One happens to be the Open University of China, which is in fact the largest institution on earth with 3.8 million students that they have. They're an online institution, which is why they like what we can bring to the table. And we've done that. We also have partnerships with the government regulators there because breaking into the Chinese market requires you can either do it through the back door or you do it legitimately, and we've chosen to spend a lot of time and money getting it done the right way. So partnerships are critical, and one partnership in particular that I want to make mention to I'm excited about this because when we merged the two companies, we suddenly had strong interest coming out from this company that was based out of the UAE. They're one of the fastest growing education providers. Certainly, they're big in the UAE, but in the African, Asian, and European areas, they're going to be a company that's on the move. They liked what we were doing. They liked what we were able to offer, and immediately they talked about a potential partnership with us. We're going to sign a contract with this company this week, and we expect to, through this little JV that we've got with them, we're going to generate something like $540 million US between our two companies in the next 5 years. Now, the difference is going to be, they'll be focused on the in-school stuff, we're focused on the after-school stuff, and we're bringing our content to the table. Quickly wrapping up, I've talked about innovation and our products, and we've got the depth of our products there. We'll continue to innovate, and we'll continue to bring new stuff to the table. Now, the rubber hits the road with our projections, with our revenues. We're on track. With this quarter, we're going to exceed our budgeted figures. We've already got strong interest for orders coming out of Malaysia and Indonesia, so we're well on the way there. And this is how we measure ourselves. We've got metrics that clearly state what we need to achieve and how we're tracking against what we've achieved. I'm not going to spend too much on our team, other than to talk about the fact that we've got a distributed team around the world. We don't believe in having them in one country simply because we want to attract the best talent. And finally, we're raising $5 million, around $5 million. Obviously, we're going to do it in tranches. And I can just leave on one point there that one of the fastest growing and biggest edtech companies now in the world is a company called Byju's in India. They do tuition like us. They started off with about 200 million market cap just 3 or 4 years ago. Today, their market cap is $22 billion, and they're still a private company. So with that, I want to ask any of you, if you're interested, I'll be outside. Please feel free to come and talk to me. Thank you.
Thank you so much, Carlton. Up next, we have Alex Solo, co-founder of Sprintlaw.
Awesome. Hi, everyone. I'm Alex. I'm the co-founder of Sprintlaw. So Sprintlaw is a new type of legal provider, and we're on a mission to reinvent the way that small businesses do legal services. We've been around for about 5 years, and we're growing fast. So we now have a little bit over 4,000 small business clients, a bit over 2 times annual growth, and $4.8 million of annualized Australian revenue. We've won lots of industry awards, and we were recently ranked as the fastest growing legal business in the Asia-Pacific region by the Financial Times and Deloitte in their fast growth companies list. Now, we're originally from Australia, but we launched in the UK in early 2021, and the plan for Sprintlaw is to bring the brand to a number of other countries in the coming years. So the starting point for our business was answering the question, why is seeing a lawyer such a headache for small businesses? And research was telling us that 75% of small companies weren't going to see a lawyer when they had a legal problem. And the leading reasons were that lawyers were seen as too expensive, too slow, and too confusing to use. And for any of you who've worked with a lawyer before, it's probably no surprise. I mean, most lawyers still operate using the billable hours model, which actually dates back to the 18th century and really incentivizes inefficiency and complexity, because basically it means that the longer you take, the more you're going to make. And so this kind of model is really low tech and not very scalable. And the result is that the small business legal market is very fragmented, with small businesses serviced by a network of thousands of old-fashioned suburban law firms. Our model was to create Sprintlaw, a very different kind of legal provider. And what we've done is we've turned legal services into a suite of simple packages and products that cover the majority of legal needs for small businesses. We deliver our products online through an e-commerce style shopping experience, and they're serviced by our team of expert lawyers who are supported by our automation technology and our data-driven learning system. So the result of our model is that we're able to provide the same or higher quality services than your average traditional lawyer, but at a fraction of their cost, which saves our clients time, money, and a lot of headache. So what do we actually do? Well, most of our work comes from selling our fixed fee legal service packages. And these packages are designed to capture all the different sorts of legal services small businesses commonly need. So we have general things like our company setup package or our trademark registration package, as well as more niche packages like our gym terms and conditions package for gyms or recruitment T's and C's package for recruitment businesses. The packages include both the actual document or deliverable, but they also include phone or video chat time with one of our experienced lawyers. We also have subscription offerings. Our main subscription, our Sprintlaw membership, is optional, but it's one which about 75% of our customers end up signing up to, and it's a really key part of our retention strategy. As a Sprintlaw subscriber, you get access to unlimited quick calls with our lawyers, discounts on our fixed fee legal packages, and then access to our legal software tools, so do-it-yourself doc generators, e-signature tools, and legal document storage lockers. So how do we reduce our costs? Well, while traditional law firms are very much incentivized by inefficiency, as a fixed fee productized provider, we're very much incentivized by efficiency. And so we've spent the last 5 years automating every single operational aspect of a law firm you can imagine, from collecting client information to issuing engagement letters to regulatory compliance, payment, generating documents, and so on. And our legal automation system basically means that we have a legal team supported by our workflow automation system, and we have no secretaries and no paralegals. And so our system runs about 150,000 of these operational automations every month, and it's one of the most sophisticated systems of its kind in the world, as you can see from this very impressed-sounding quote from the CTO of Zapier, one of the world's leading automation companies. But where I think our secret sauce really lies is in the way that we leverage legal data to improve the efficiency and the quality of our services over time. So through our learning management system, which we call the Sprint Yard, we frequently analyze, collect, and de-identify data in all of the legal work that we do. And then we use this information to create package-specific resources for our lawyers, package-specific templates, package-specific clause libraries, package-specific checklists, and package-specific automated client questionnaires. And so the result is that our lawyers have all of the ingredients of fixed-fee legal work right at their fingertips, and they get significantly faster at providing legal services over time. So you can see on screen we have an example of a privacy policy. We've done 408 of these privacy policies. It used to take our lawyers 4 hours to do them. Now they can do them in 15 minutes. But it's not just the speed that improves over time, it's the quality too, because after doing a package hundreds of times, we've basically seen every real client world scenario. And so, the proposition for a customer becomes simple. Would you rather use the lawyers that have done hundreds of privacy policies, collected data on every single one, and fed it back into the document that you're getting? Or, the suburban lawyer that's maybe done a couple of them a year and probably lost their paper-based records? So how do we scale? Well, a key feature of Sprintlaw is that we're a fully online team, and we have a mix of employees and on-demand contractors from Australia and across the UK as well. And so this means that we don't need ever-expanding office space as we grow. And so when you combine our online team with our workflow automation system and our learning management system, you get a really scalable model, and we're able to service our client base of 4,000 small businesses with just 15 lawyers. To acquire customers, we've structured Sprintlaw like a B2B SaaS business with a sales team and a digital-first marketing strategy. And we've invested particularly in content marketing, SEO, and SEM, and we have multiple leading law websites. So our websites generate over 500,000 web traffic every year, and we're getting about 1,500 small businesses inquiring with us every single month about legal services. To retain customers, we put as many small businesses as we can on our subscription offering, and we nail our customer experience, as you can see from our really high NPS score and our Google reviews. Our business model is pretty simple. So we'll acquire a client for about $900. We then expect to make around $900 profit from the first package we sell. So this might be a startup, for example, that needs a company setup package. And we then expect to make around $3,000 to $5,000 in lifetime profit over the next few years if the client subscribes to one of our subscription offerings, or if they come back and need, let's say, a privacy policy, a lease reviewed, or maybe an employment contract. Our potential market is really, really big because basically every single small business needs legal services. And so just sizing the markets we're in, which is Australia and the UK, we estimate that our serviceable market is about $10.5 billion. And so with our current revenue, we've got a long way to grow. And having proven we can take Sprintlaw from Australia to the UK in the last 12 to 18 months, we're now planning to launch Sprintlaw in a number of other markets over the coming years. So we'll be launching in New Zealand later this year, and we're then looking at going to Ireland, Singapore, Canada, and eventually the US over the next few years. So how are we different? Well, the result of all the things I've been talking about is that we've designed the most cost-effective, high-quality legal service for small businesses that exists in the market. And that's basically because we've simplified everything, we've automated everything, and we hold the best data set of SME legal data of any business. And while there are a couple of other legal innovators out there, the majority of the market is still dominated by these very traditional suburban lawyers who hold 85% market share and are basically begging to be disrupted by a massive scalable provider like Sprintlaw. A quick note on our team. Our team consists of ex-top tier lawyers, including myself and my co-founder, Tomo. We also have technology experts and operations specialists, the majority of whom have worked together for over a decade in various jobs. Our advisory group includes a public company CEO, top-tier law firm partners, top-tier legal technology experts, digital marketing experts, all of whom are invested in and advise the business regularly. In terms of this round, we'll be raising a 2 to 3 million bridging round at the moment. We've already got about 1 million of that committed. And the idea of that is we'll be spending those funds more on growth, more on marketing, and also investing in our tech and product. And then the plan is to raise a much larger equity round next year to help support that international expansion. So that's it from me. I'll leave you with this inspiring quote about our mission and vision. If you want to have a chat, I'll be outside in the next room. Thanks, everyone.
Fantastic. Thank you, Alex. Now we have a break for lunch. So we'll be back here in 20 minutes' time for our next session of the day, where we'll be listening from panelists on capitalizing on megatrends in public markets. Thank you. Hi everyone, please make your way back into the presentation hall. We'll be starting with our next panel session in a couple of minutes. So please make your way back in and we'll be starting in a couple of minutes. Please make your way back into the presentation hall. We'll be starting in a couple of minutes.
Is there a monitor down at the bottom?
Hi everyone, please make your way back into the presentation hall. We'll be starting our panel in the next minute.
Questions that we always get asked when we're sort of hosting sessions is that how do we actually curate opportunities for wholesale investor? And for me, I think one of the simple ways to try and describe it, and if you look around over the last 3 days, we've had some incredible founders, some incredible presenters, basically talking about their companies. And the reality is the first areas that we're looking at is that we're trying to look at the sector that the company's in. And that's always as a starting point for us, because typically, they're all saying rising tide lifts all boats. And for us, that's a starting point. Then from that, we're looking at the team behind the actual company. Do they have that sort of been there, done that experience? Have they built and sold businesses beforehand? And then also, we're looking at, if they're B2C businesses, we're looking at sort of traction and we're looking at metrics associated with that company. And then the B2B side, we're also looking at areas around, do they have blue chip clients, blue chip partnerships, etc. So for us, there's some of the key areas that we're looking at as sort of trying to understand, the opportunity that is represented in the companies that we're actually showcasing at WI. So hope that sort of gives some context. Now I'll hand back over to Meg to introduce the next panel session. For me, this is pretty much, this session, the people involved, is pretty much the highlight of venture and capital for me, between June Bay, between Paul, between Niv as well. For me, these are multi-year relationships of people that I've sort of got to know over a period of time and watch what they've been able to do across working with small caps, large caps, and in every area. So I think from an investor's perspective, this is probably the most interesting, relevant panel session and insightful as well, that you get the opportunity to participate, to watch, whether you're watching it now live in the room or you're watching it afterwards. I've just said I'm very, very grateful for each of the panelists that are involved in this next session. So over to you, Meg, to do the intro.
Thank you, Steve. So up next, we have our panel session on capitalizing on megatrends in public markets. Here joining us today, we have Chun Bei from Tribeca Investment, Paul Rayson from Hearts and Minds, Roy Chen from RC Global Funds, and Niv Dargan from Peak Asset Management.
Are we on? Looks like we don't have a moderator. We'll have to make up our own questions, which will make it even easier for us to
can talk for ages.
to answer them. All right. Well, I'll look, start. I suppose we'll introduce ourselves first. I'm Paul Rayson, the CEO of Hearts and Minds Investments, which is a listed investment company. We invest in global equities. We have a concentrated fund. The unusual part about Hearts and Minds is we all do it on a pro bono basis, and therefore, in the absence of any investment fees, we're able to donate up to $15 million a year into medical research. So it's a little bit of an unusual company that has a commercial purpose, but also a social purpose as well. And the only other relevant bit of background for this particular topic is before that I ran ComSec for a number of years, so I've got some understanding of investment markets. But I'll pass to you, Jun Bei, to introduce yourself.
Sure. Thank you, Paul. Jun Bei Liu. I work for Tribeca Investment Partners. I run the Tribeca Alpha Plus Fund, which is a long-short fund, just over $1 billion. And actually been participant of the Hearts and Minds, and I've got to know the wholesale investors for the last 5 years, I think. And it's been an incredible honor to be here with my panelists and talk about the megatrends.
Roy, do you want to introduce yourself?
Sure. I think it's already on. Yeah, I'm just doing a small PR for our company. Roy Chen, I'm the founder and portfolio manager for our small little outfit of running global shares. We currently run our flagship fund, which is investing in global energy and infrastructure related equities. And we spent a number of years building up the track record. So we have maintained a very low profile. Hopefully from now on, we'll start to raise our profile because we think we can offer some interesting kind of diversification for a lot of other investors.
And Niv?
And Niv Dagan, Executive Director of Peak Asset Management. We're a boutique investment management corporate advisory business. Done a lot of things over the years with Steve and Jun Bei and Paul. Our model is all about co-investing. We look at IPOs, predominantly placements, small caps. In everything that we do, we have to co-invest and back it with our own capital. And then we help the companies beyond capital. So whether it's networking or joint venture partnerships or updating a pitch decks or introducing through our networks, but anything that we can add value, that's our key. So it's great to be here.
Okay, in the absence of questions, I'll just start talking and introduce the topic, I suppose. Megatrends. What do I know about megatrends? Megatrends are obviously, long-term trends that, over the long term will transform whole industries or in fact, create new industries. And I suppose in the sphere of public markets, they're best represented by thematic ETFs. In Australia here, you've probably got 15 to 20 thematic ETFs, and in the US there's hundreds that represent, not only the major 15 or so global macro trends, but also, subsectors and niches that you can invest in to get exposure to megatrends. But the point is, I think, they're long term and they will emerge over the course of many market cycles. So the market downturn we're experiencing right now, I think you'll find if you look at the prices of many of those ETFs, both locally here and in the US, many of them are down, 30 to 50%. Some of the niche ones are down 60, 70%. So now might be a good entry point to start to get some exposure to megatrends. But I think the important thing is that they are long term. There'll be long periods of time where they underperform markets. I did take time to look at the largest ETFs in the US, and the top 15 thematic ETFs of all, but bar one, have all underperformed the NASDAQ over the last 5 years. So it's a long journey. So it doesn't mean they're poor investments, it just means it's a long exposure. So thematic ETFs are obviously one way to do it. I'll pause there and come back on other ways to do it, but I'll pass to Jun Bei now.
Yeah, I think it's a really interesting point, like megatrends in the public market. one of the amazing things about public market, clearly I'm a fund manager, invest in the share market. I think it's just incredible opportunity and liquidity for you to gain access to those mega trends. Thematic investing is possible. Well, it actually does very well across the share market, just simply because it's very liquid. You've got your ETF, you've got your shares that give you access to those markets. And another incredible thing about the trying to capitalize on the mega trend in the public market is that with the market volatility, share market worry about different things from time to time. They worry about recession, they worry about interest rate, worry about inflation. That creates significant amount of volatility in prices. So, for a long-term thematic investor, it's absolutely give you opportunity, the access to those companies that will, play into a lot of those themes. And to me, that is just a fabulous opportunity, because private market, you just have no access to it. It's incredibly difficult. And I guess another thing with with the mega trend in the public market at this point is that we have a number of theme that's playing through our market in the last few years. One big one is this electric vehicle. In fact, we were talking about it, before the session. We were talking about, is Tesla going to be a different company? Tesla going to be bigger than GM, or that sort of conversation in 5 years. It is a mega trend, and we can play that through the public markets. In Australia, it's a little bit limited, but in Australia, we kind of play it through the resources side of things. The component, the EV components, whether it's copper, whether it's nickel, or whether it's lithium, cobalt, and a few other commodity that's really highly required for the battery usage, which we know battery is a big cost, goes into the electric vehicle. So, these are the themes are playing out, and then with increasing demand for these sort of vehicle, over the next many years, we were looking at the demand trajectory is incredible. We just can't keep up. Just means, demand for a lot of those commodity will be quite high. And so that's how how the opportunity exists, in the share market. And then, as the share market investor from time to time become disillusioned because there might be recession at foot, this is the time when you can actually pick up those opportunities that is presenting. So, that's how I see it at this point.
Now, Niv, you're an expert in base and battery metals, so what would you like to say?
Don't know if an expert, but now look, I agree. I think ETFs are a great way to gain exposure to a basket of assets at a time. Having said that, there are some restrictions in terms of liquidity, in terms of the net asset values that might be trading at below par. So sometimes, we believe that investors can also get a direct exposure through the stock market. I mean, if you compare that to, call it property, that's the beauty about it, having, got liquidity and low base of entry and a low cost of entry as well. Going back to some of the things that we're seeing, absolutely. Look, we had Goldman Sachs JBWE just come out only 2 months ago saying that the lithium bull market is over. And there's a huge supply-demand imbalance right now, and we strongly disagree with that. We're seeing the electrification of vehicles continuing. There's huge demand. Just today, and looking at what BMW is saying, that they're moving actually away because of the electricity costs are rising. They're moving actually to green hydrogen, and that's going to be a key driver force to fueling their infrastructure. The problem with a lot of these companies is just is really the infrastructure spending and the cost, and things are still not viable. And last panel I was over here actually was at a renewable panel, and I was just having a chat to Rachel just before, who runs the Australian Shareholder Association. She's here, and we're just having a bit of a chat. And look, what we're saying overall is that there's a really, really big gap between still renewable energy, their cost, their usage, to traditional such as fossil fuels. And that's why you've seen the price of coal and the price of oil and gas drive up significantly. It is going to take some time, but we are seeing still green energy, green hydrogen, the EV revolution are still key themes that we still like, and we're still buying at these levels. And there's a huge disparity. If you're looking at, for example, the uranium ETF or the green hydrogen ETF, or even the price of lithium carbonate, the stock prices have fallen by about 20 to 30% relative to some of these ETFs. There's a big gap, and we've been using that gap essentially to add specific stocks that we see some value in.
And Roy, what trends are you watching?
Well, as my 3 previous panelists have highlighted very well about megatrend being picking something long term. And so, in a sense, what we do is we are not that different from ETF, except we are actively managing a number of these mega trends. So I'm just going to highlight two of them. And this goes back all the way from the time I graduated. One of my classmates wrote about energy. And this is about, we're talking about decades ago. So I remember that always, that energy is something that is going to be needed all the way through human society. The only thing that changed over the years is the mix of different energy. I mean, years ago, you wouldn't heard so much about renewable, but now it's everywhere. It's a buzzword, and it's serious because of climate change. So the two areas that we are most focused on, one is on, within the energy, oil and gas side, LNG. And you just think about LNG, Australia, obviously, the company most involved in that is Woodside Energy, now previously called Woodside Petroleum. So if you look at liquefied natural gas, it's actually growing faster than gas itself. And every day, people tend to focus on the ups and downs of oil price. But the more interesting thing is actually looking at gas. I mean, just think of during the height of the pandemic, LNG was trading at $2 per million BTU. Now, partly because of the crisis in Ukraine and the war, and also the energy crunch that Europe facing last winter, low storage level, now we're talking about $40 per million BTU, from $2 to $40. And yesterday, I was actually attending two other conferences, one from energy consultant, Wood Mackenzie, and another global infrastructure, both talking about LNG. It is unlikely to be anything back to those $2, $10 for the next 3 or 4 years, because it takes a lot of time to discover the big resource of gas, to develop, build the plant, liquefaction, the regasification, all the infrastructure needed. I mean, the whole of last year, despite all this demand, there was only 2 projects that have gone to FID. So just think of the demand, and then now Germany tried to win itself Russian gas dependence. So obviously there's some big winners, and the biggest winners of all in this area is actually the US, because the other one that's been busy building liquefaction plant. They signed a lot of contract with China. Under Donald Trump, they forced China to buy more US goods, and one of which was LNG. And now China is laughing because China bought a lot of LNG last year at relative to today's term low price. Now they're even re-exporting some of the LNG to Europe at high price. So LNG is one, and the other one, and is, you can build a pipeline in Russia, got plenty of pipeline to Europe. You can pipeline over land, but to get that energy, like liquefied natural gas to Japan or from Qatar to Europe, from US to whatever, how to get that energy across, you need the LNG vessel. So shipping is another area that we're very bullish. I mean, during the pandemic, we switched our focus from shipping of people, which is airport, airline, to shipping of goods because of e-commerce. So we went into UPS, FedEx, Deutsche Post, DHL. And now then came container shipping. Just look at the freight rate from Shanghai to US West Coast, again, gone through the roof. Now we're starting to see a little bit of slowdown in look at Walmart result, and there's some slowdown in the mix of what consumers are buying because of high energy price, high food prices. So you need the vessel, and the world is short of vessel. So LNG, shipping, and food.
I still remember when oil price went negative briefly. During that pandemic, I woke up middle of the night looking at the Bloomberg, was thinking, is that possible? Remember, it was for a day or two. It was an incredible experience to see that. I absolutely agree. I think energy is, it's very interesting, and it's certainly a trend. During that energy transition, you'll see a lot of shortage and demand for product and things around the pipeline or, alternative energy. like when I think about, when we run our portfolio, we always look at the short term and then the structural and then the strategic. Our societies forever changed post the pandemic. The digitization to me has really just reached a new level. For the short term, yes, we're short energy, we're short a lot of those things, but eventually we're going to work it through. You're seeing the oil prices now becoming a little bit more volatile because the potential for recession and everywhere else. These are the things you can capitalize for the short term. For the next couple of years, yes, you can make a lot of cash out of those businesses, those old school energy businesses, because no one is investing more in those assets and they have remaining residual value that is probably more than what their share price is indicating at the moment. However, when you run a portfolio, you want to have something that will future-proof your portfolio. You don't want them to disappear after 2 years. Then you kind of go, what's beyond that? You want it to grow, generate that return. And to me, these are, this digitization is a huge thing. I don't know, when the pandemic first hit, when we had to sit at home, we didn't think it was possible we can actually live and work and do everything so seamless like it is now. We didn't think it was going to happen, but it did. It requires a huge amount of investment into those space, whether it's Zoom, or everything else to make that infrastructure available. And now it is. And then now we also have the culture to be able to work anywhere and everywhere. So that is something that is here to stay. And we need to realize those sectors that supply to that whole supply chain, in the short term, they might get impacted. Zoom share price is tanked. And yes, absolutely. In the short term, or Netflix, share price hasn't done very well more recently because the interest rate's gone up, or the valuation comes out of it. But when you take a longer term view, these are the businesses will remain with us forever. Netflix, for a period, it became the biggest media company. It is out there investing in the biggest media deal, making all the movies. All the Netflix originals are on the top charts. All the actors, actresses want to work for it. Making programs and producing for Netflix. They will be the biggest content holders. Their business model may evolve over time, clearly, because the subscription model isn't going to be sustainable and other things evolved. But these are the businesses that will become very dominant in our lives. And what the current public market is probably not reflective of its true long-term valuation. And these are the times where, as an equity investor, you just see a lot of opportunities of picking up things that in 5 years will be a whole lot larger, and that will future-proof your portfolio, while at the same time you may want to take advantage of the shorter term, your commodity boom and all of that, to construct the portfolio together.
You're right, it is a mix of short-term and long-term, and I think base and battery metals are a good example of that, where many of the share prices at the moment are factoring the impact of a recession on their volume. So their share prices are quite depressed. But I think they will benefit from the gradual unlocking of supply constraint disruption, so there will be some price upside, and many of them are exposed to the longer-term trends of electrification and decarbonisation. So you've got the beauty of a relatively reasonable price now, upside from the ongoing turmoil we're in terms of supply side constraints, but the longer term exposure to EVs and decarbonisation. So that is a sweet spot right now, I think. Just rounding out the exposure on public markets. So as I said, thematic ETFs are one way to do it. I looked at the 5-year numbers of the largest ETFs. All of them bar one, which was global clean energy, underperformed the Nasdaq. Clean energy outperformed, which was interesting itself. So it is a very bumpy ride, I think, with thematic ETFs. You can try and pick winners in certain trends, and I know we've talked about energy and a few other things, but we've got genomics, we've got artificial intelligence, we've got big data, we've got personal healthcare. There's no shortage of these trends. Picking individual winners, though, is very hard. Finding the next Amazon in e-commerce or Apple in devices is very difficult to do. So that's a very difficult thing to do, and I probably wouldn't recommend that as a way to get exposure, other than choosing to invest in leaders that are already in well-established trends, like the mega cap IT companies and the next tier, where those trends still have a long way to run, and you've got obviously well-established leaders. And the third way to get exposure is through an active fund manager, like June Bay.
I was going to remind you, you do have a fund manager sitting there.
And I having looked at the the performance figures of ETFs, I would probably recommend an active fund manager. Very hard to get pure exposure to a particular trend, but there are a few here in Australia, and there's certainly a few in the US, particularly the broader decarbonisation trend. And at least with an active fund manager, you've got someone really monitoring developments in the market, because the market dynamics are quite volatile. There's regulation, there's changes in competitive intensity, there'll be a handful of winners and a number of losers. So if you've got an active fund manager watching, risk weighting their exposure, whereas an ETF is purely market weighted, that's probably a sensible way to play a longer term trend. But the important thing, this shouldn't be your core portfolio. From my days in ComSec, I saw many new investors, their whole portfolio was in their 3 favourite thematics, which is really risky. It's a risky way. You really need a core holding of a broad index or a number of more mature companies, and play as satellites your 3 or 4 favourite thematics. Don't put all your eggs in 3 thematics. That's one thing I can give you. Steve? Who wants to answer that one?
I don't mind saying a few words. Well, I mean, the younger generation, they demand certain things that we may have overlooked, people like myself. They want a better environment to live in. So that's why things like climate change become important. And that's where renewable energy become important. So I mean, even though we like oil and gas investment because those companies provide us a lot of free cash flow, the dividend and all that, but for the future generation, to go to a cleaner environment, you need a lot more clean energy. So for example, June mentioned about digitization. I mean, we also invest in things that tie to digital infrastructure. Think of electric vehicle. Electric vehicle need a lot more chips than traditional internal combustion engine vehicle. And we're now having a chip shortage. So there's another trend that you cannot overlook. But to me, I'd like to see my children, my grandchildren live in a cleaner world, a healthy world, and a more peaceful world. So those are trends that we can embrace and try to make the best out of it.
I think absolutely young people are very socially conscious, very socially and ESG focused, very, very much so. They've been brought up in a world that is so, there was so much discussion about electrification and everything. So when they invest their dollar for investment, they always invest with the things they believe will make a difference. So this is one, all the research has done. So, they will absolutely be the future investor to drive a lot of those trends. As talked about before, they also grew up in the digital world. They will use things very differently from we do. My kids started playing Roblox when they're very little, and we spend I don't know how much money in buying those little gift cards. It's coming to you. So, and these are the new rise in those businesses that as older investor, we thought, how can they even have a business? But, it's incredible. It's, they got hundreds of millions of clicks every month or active players every month. And then they just have money pouring in because those gift cards they sell to use on those platforms. These are the rise of the digital community in the future. And we, at this point, we just can't fathom. But we need to watch those trends. And these are the kids that will, when they grow up, they will invest in those things. And they will be the one probably invest in the cryptocurrency and all of that, because a lot of those game coins can be used within those platforms. And the rise of the gaming and digital gaming has been huge relative to, the advertising dollar that's been spent on the normal traditional media, multiple times larger. So that's the trend that is going to dominate, the future investing.
I just want to add to a few points. So the SEC, which is a regulatory body in the US, has just made it mandatory for large organisations to report the ethical, sustainable footprint. So technology is very, very interesting in terms of how do large organisations actually report the ESG in the annual report, right? I think that's a big mega trend. Another is food security, as you mentioned. I mean, the generation these days are a lot more conscious about the environment. They are a lot more conscious about clean energy and the electric vehicle revolution. So that's also. The key, though, is finding, I mean, ETFs, and this is probably the advantage of ETFs, I know we're talking about ETFs, is that you don't necessarily have to choose specific management teams indirectly to drive the organisation. The key to how to identify stock picks is backing the right teams and the right people behind it. So good CEOs with a track record of execution and delivering shareholder value, skin in the game. And I regularly talk about that, but how much has a CEO or the management team paid for their shares? Have they received freebies? What's the team like? I mean, the CEO might be a great salesperson, but the best way we find, for example, when we're doing a site visit, is actually speak to the account managers, to actually speak to the people on the ground that are actually building, and just to get some feedback and see what the culture of the business is like, right? So I think backing the right people and the right management team is critical, but also deep diving in terms of who's behind it, where things are at, and what motivates them is also important.
I think doing your home, the broader idea of doing your homework is really important. Take the EV ETF, for example. If you look at the composition of that, you've got mining companies, you've got new car manufacturers like Tesla, you've got a whole lot of old traditional manufacturers, you've got retailers, you've got semiconductor companies. But it's not, the earnings of that ETF parcel, if you like, is probably going to be more driven by traditional earnings than it is by exposure to the new megatrend. And you've also got to think over the long term, where is value going to accrue? Is value going to accrue to the resource companies or the manufacturer, or is it probably more likely going to accrue to the IP and the soft assets that are in that exposure? So doing your homework as to which part of the value chain of a megatrend is pretty important. But again, that comes back to doing your own research or choosing an active fund manager who can do that work for you. We have time for questions. Can we take questions from the floor? Steve and I have got a bet between the relative value of General Motors and Tesla, and every 6 months we measure the value. At the moment, Tesla's up 35% versus GM down 15%, but I'm still confident that the old guys will make a comeback.
Look, if it's a 6 month, I'd be going with Steve, not you. If it's 5 years, might be a bit different.
So the other part to MegaTrends is also adoption curves. I know you're obviously very long short as far as how you're approaching. So how do you assess where a new technology or a new How do you assess where a new technology is in their adoption curve? And how, I suppose, how do you looking at it from a trend perspective? So I know typically, so you mentioned about crypto before, typically people that follow crypto try and understand where the developers are going and where the engineers are going to look for trends. I suppose, where is that adoption in the sense of EV adoption? Where is it in renewable energy adoption? What are the cost impact? Like as far as renewable energy as an example, solar energy is now cheaper than it's now the cheapest form of electricity ever. So if you're thinking about, like, how are you assessing where it is in the adoption curve? Because obviously there's a point in adoption curves where the value gets compounded from the investor side. So I'd love to get your perspective on that.
Look, energy is interesting. I 100% agree with what Roy's saying as well, just in terms of the LNG footprint and the supply-demand imbalance and the fact that transportation and shipping, etc., is a big issue. Uranium is something that we haven't talked about. So we're actually listing a uranium IPO. It's a company called T92 Uranium. We've got a great board and a great management team. And look, uranium on a footprint actually as per energy usage is going to be one of the cheapest and cleanest in the world. And that goes beyond solar, and that goes beyond wind, and that goes beyond green hydrogen. So look, we like uranium. Obviously, once again, backing the right team. It is early. Regulatory is potentially an issue, but we are seeing globally a big shift away from, call it China, Kazakhstan, Russia, in terms of energy usage, and we think uranium is very, very interesting.
I'd like to say something about, in terms of future trend in energy, is one, currently it's not economic, but you hear a lot, especially my ex-boss, Andrew Forrest, talk about this thing all the time, hydrogen. Might have to give another 10 years or more. but that will be one source of clean energy that can replace natural gas one day. It could be, as I said, 10, 15 years away, but because there are other things that electric vehicle can't do. I mean, you want to fly an aeroplane, you can't put all that tons of battery into the aeroplane and fly the aeroplane. That's why today jet fuel is still needed. But if you look at the future, the only thing that can possibly replace jet fuel will be hydrogen. So it's just a matter of time.
I suppose that goes back to the adoption curve perspective, right? Because if you look at all new innovative technologies, there is even just the simple car, like it's when it went from horses and carts through to cars, there was a period of sort of 10 to 15 years where that transformation happened. And the adoption, like if you look at the traditional sort of S adoption curve, like what does that look like for hydrogen? Where would you, is it at the early adopter phase? Like what phase is that, would you describe that as being at?
Well, currently, there's alternative other than green hydrogen, blue hydrogen, gray hydrogen. Even shipping hydrogen is a bit of a problem. So people are talking about shipping ammonia and then convert ammonia back to hydrogen at the receiving end. So there's a lot of technology involved in this area, and I can only say that this is a space worth watching.
I think the point is that, as you know, they're long-term trends, so you're going to have lots of ups and downs. You need to be very patient, and you can have drawdowns along the way, so you just need to be very patient, and it needs to be a part of your portfolio, not the entire core of your portfolio. We're out of time. Any last comments, Junbei?
Look, I just thought, in terms of the mega trend, it's, we're seeing incredible, many of them playing through the public markets. And just like what Paul was saying there, make sure you run a diversified portfolio, don't put all your eggs in one basket. And then, because that journey is going to be bumpy, no journey is ever smooth. We talk about which one reaches the adoption, the tipping point of the adoption phase. You can say electric vehicle and the like, and because it's now generally accepted, you want to have an electric vehicle at some point in the next 5 years. Everyone think that way. So, however, along the way there will be bumps and journey. We may have a recession, might become a bit too expensive. Maybe lithium price is too high. The car price can't be lowered enough. And then these will pass. Will work its way out over the next few years. And but the longer term trend is here to stay, and we can all see it. That's what makes investing in the mega trend actually in a way easy. But just make sure you size them properly, and and you can wait out the difficult times.
Just last words. I mean, 100% agree with the panel. Diversification is really important, and backing the right team and the right management team is critical. So yeah, just want to say thank you.
All right, we might call it a wrap there and make way for the next session. So thank you.
Thank you.
Thank you, everyone.
Thank you very much.
Thank you so much for coming in, guys. That was fantastic. So next up, we have Peter Yang, co-founder and CEO of EIZ Technology.
Good afternoon, everyone. My name is Peter Yan. I'm co-founder and CEO of the EIZ. Today, I want to introduce our business, EIZ. We call ourselves next generation e-commerce fulfillment logistics technologies, but it sounds quite difficult to understand. But the easy way we explain is we're helping e-commerce business to run the logistics like Amazon. Sorry, which part? Okay. So our business is a logistics tech business. So we use data-driven technology to helping e-commerce business to solve logistics and fulfillment problems, challenges. Our business started from 2018. Currently, we are top 3 in Australian market. And we are, this year, 2022, extend our business into USA. About the revenue and what we achieved. In last financial year, we achieved 20 million Australian dollars sales revenue. And our fulfillment partner, more than 40 of the partners in transport industry and 3PL fulfillment industry. So our fulfillment partner already in Australia, New Zealand, and USA. Currently, we have over 4,000 registered business users. About like market size. In e-commerce, 10% of e-commerce business sales revenue spent on logistics. So we can tell now in Australia, e-commerce logistics, the market size is 3.1 billion. Southeast Asia is 12 billion. US is near $60 billion. The market trend is going to tier 2 marketplace is catching up. What is the tier 2 marketplace? Catcher, Kogan, Madu. That's all tier 2 marketplace. And the standalone online store like Shopify, WooCommerce, the sellers are getting more and more selling on the standalone marketplace. So the people who sell and doing e-commerce, they need multi-channel management. About our typical customers and problems, so we focus on medium to large size customers because the business is a good size, but they have money, but they need solutions. So you can see for them, the operation costs are high because they don't use automation machine. The second one, and the integration costs are high. Logistic management costs are very high. The lack of the market entry when they go to overseas, and then the lack of the logistic service resource. They need typing, search, and find out what's the other options. And also, they didn't use the data very well. What we do is, you can see, our business model is like Airbnb for logistics. So we contract with all the partners. They do in transport, they do in 3PL. And our customers, they don't need to looking for service. They come to us, and our system use the data analyze and help them to find out the best matching service providers. This is our global version. This round we do fundraising because we want to go global. In Australia, you can Google that. But when you want to sell your product into US, it's extremely hard. But when you're using it, so the sales channel we have been integrated. The transport company we have been contract. You just ship your stuff, first on selling, and we will do others transport for you, and logistics as well. That's our customers triangles. So we focus on medium size, but also we can have a solution for enterprise, but also we're helping a lot of entry-level businesses come into the market. The reason we love entry-levels is because entry-level may, with our help to grow, become a medium to large size business. That's how we grow our business. So start from 2018. This is a calendar year, by the way, because just now 20 million is the Australian financial year. So our business is growing from 100,000 Aussie dollars in 1 year, and this financial year, we're definitely getting over $23 million. In this market, this is our competitions, the player in the market, but we're quite unique because we focus on the level of the logistic technology. So we believe B2B and B2C, they all come together. Online and offline, they come together. So we developing our solutions around the reality of the business. That's our plan for US market. We have been planned that localization of service for US market. Now we got our first customers in US got stock in our partner warehouse. So what we do is we don't want to put in the people grow to the market. We want to grow with our customers because our customers, they want to go global. So this year, this financial year, we will bring at least 6 customers from Australia and New Zealand to US, help them to selling in US. At the same time, we'll grow our business and engage with the local sellers. That's our global plan, and not just in Australia, New Zealand, US. Our plan is a global plan. Southeast Asia market is also a very big market for us. Like Australia is in the middle of this Southeast Asia market and US market. I believe we can cover this part. Our background, currently our company crosses 3 countries. We have 40 employees. And my background is I used 7 years ago, I was helping Alibaba and doing the logistics global-wide. We was like an Alibaba channel partner. So we learned how Amazon and Alibaba run the logistics business global-wide. I believe this is a chance for us to build up this digital platform and helping general sellers and merchants grow the business global-wide. This round, we're looking at 5 million to 10 million investment. The money will spend on the new market extension and developing as well. Thank you very much.
Thank you so much, Peter. Up next, we have Jamie Engel, CEO and founder of Neutopia.
Hi, everyone. Pleasure to be here with you today. Hope you're having a good time. I'm Jamie, the founder of Neutopia. And what we are is a digital platform that is designed for personalized content, recommending future learning, and building community. Our target is both industry, member associations, and also higher education. We have a range of current clients, some very large schools, and we're currently clocking at about 16,000 monthly revenue, and we're set to double that in about 3 months. Now, the problem, it came from when I started in education about 10 years ago. I got asked to be a teacher after a very successful career in Hollywood, working on big movies. And I came into education, and I was kind of perplexed by the kind of platforms they were using for learning. And I thought, gosh, this is 2014, and we have Spotify, and we have Netflix, and some of the things that were talked about in the panel just before about trends around personalization, content delivery, how the supply is moved. I was just looking at that and thinking, why aren't the platforms a little bit more like Spotify? And some of the key things that I noticed were problems was, as a teacher, I couldn't see anything around the interests of the learners. I couldn't see what their pathways were into their jobs. It was very hard to onboard them. And the biggest thing as a organization is not having the ownership of the social network. So Neutopia is really focused on, for knowledge communities, and again, this could be higher ed for alumni, it could be enrolled students, it could be industry associations, and even new types of knowledge communities in the Web3 world. How can we offer something that the organizations can own the value that over time, as people build social networks, they can have control over? What I used in the meantime was things like Slack and then Facebook groups, and then implementing Neutopia, you could really see what was happening. Now, our solution focuses on the personalization aspect, the ability to see all of the analytics behind, so understanding what are the top topics that learners are interested in, and that can inform and provide business insights to the types of programs, events, and offerings that the organization has. And then the other aspect is a very modern interface. And it really matches the expectation of people now, as opposed to the kind of learning platforms that are sometimes used at universities. Our business model, very simple. We currently, for our enterprise, are 2,000 a month and up. For some of the larger clients that we have are double that. And we're also looking at some lower priced models where we can use the platform, but a simpler version, and sell that more quickly. Now, the competitive landscape is interesting. We looked a lot at learning platforms that are currently used, but we also looked a lot at the community platforms. And what we noticed is community platforms have more of the personalization aspects, but not much around the learning, and the learning platforms have the learning, but not much of the personalization. So we position Neutopia right at that intersection where it has the best aspects of personalization with also offering future learning. So I'll give it a use case. So it might be for alumni, how 1, 2, and 5 years after they graduate, their interests might change quite radically. So they might graduate in engineering, but then want to become an entrepreneur. And the university will typically have no knowledge of that change in interest. So this platform allows the organization to track the changing interests over time, much like Spotify or Netflix, and evolve what the offerings are so that they're optimized to be the most relevant to the end user. Now, we have an amazing pipeline. We've already got some of the larger universities in Australia on the platform. We have an amazing government tender that we're a part of, that we will be the digital platform connecting 7 learning providers in Victoria and about 40 other major organizations to offer personalized learning pathways to citizens of the state of Victoria. And we're sitting in the second and third pillars here. So we are working with some higher education clients, some large organizations, and getting into next year, we're excited about this lower priced option so that we can scale up to meet a lot of needs of communities that will come to us after seeing competitors and saying we're interested, but they're needing a lower price point. So that might be a 300-person entrepreneurship incubator program. And then going forward from there, we're looking at either entering into North America or Asia, and then a bit beyond that, ideas around how, once we have a critical mass of clients, that we can start to operate more like an aggregator platform, direct B2C rather than B2B2C. Have the privilege of working with an amazing team, all with over a decade of experience in education and technology. So my co-founder, Jen Wilson, has built and exited a technology company. Stephen Rudder helped set up the Sydney School of Entrepreneurship and worked with all of the universities connected in that network. Mark has over 20 years experience in education sector and is quite sought after consultant for alumni engagement strategies with Australia universities, Canadian, and also in Asia. And Meg Tate leads brand and communication. What we're looking forward to next year, towards end of 2023, is revenue above 1.7, and the large number of clients is, as we move into that cheaper price point, scaling up to meet the need of a lot of smaller knowledge communities. And then finally, we're doing a seed raise. We're looking to close the end of August. We have about 200,000 already committed, and the other 70% in the pipeline. So it's looking very strong, and we're using the funds for sales and marketing, technology, and also funding the expansion of the staff. Thanks very much, and the QR code is out at the table, and I'll be at the back if anyone wants to meet. Thanks.
Thank you, Jamie. Up next, we have Liam Gilchrist, co-founder and CEO of Lexical Labs.
Everyone, here at work, okay? I'm Liam Gilchrist, CEO of Lexical Labs, reviewing contracts with AI so anyone can drive them. So, contract review is slow, expensive, and fraught with risk. Businesses worldwide spend over $300 billion reviewing and negotiating commercial contracts every year. I was a lawyer for years. I used to spend years reviewing commercial contracts. The work is tedious and repetitive, but important. And the risk results from a lack of visibility and understanding of an enterprise's contracts. And this bites both before and after a contract is signed. So our solution is Tiro. Tiro is an intelligent automation tool that guides users through their contracts. So users upload contracts that they're negotiating, and Tiro will analyze them against their key requirements, what we call a playbook. So here it is in action, reviewing an issues list and summarizing the key terms. So Tiro empowers business managers to review their own contracts, and it frees up lawyers and contract specialists to focus on the more valuable, rewarding work. It can be used to review and amend a contract, create an issues list, review a whole portfolio of contracts, whatever the workflow. Tiro can, at the end of the day, it can reduce the time and cost of contract review for a client by up to 80%. But what's really transformational is the improvements it makes to risk management and to people's jobs and welfare. And it works because we have a founding team that really know this space. Collectively, the founding team has over 45 years of deep legal experience at legal law firms. We have 20 years of software development experience, a PhD in AI, and we've worked together for 5 years. Now, what makes Tiro unique is the way that it handles complex business contracts, the lifeblood of enterprise. So, for example, an agreement to purchase a complex piece of equipment could be hundreds of pages long, have hundreds of clauses in it, multiple schedules, complex interrelated provisions governing rights and liabilities. So the two pillars that make Tiro unique is it can analyze and read these contracts like a lawyer would, and it has the flexibility to match its output to that required by the user's workflow. So focusing on the first point, reading the contract like a lawyer, and just focus on the bits highlighted in yellow. But Tiro both reads multiple clauses and documents together, and then it holistically applies logical reasoning to the result, what we call lexical insight. So say a customer wants to understand its exposure under a contract. As shown here, many AI systems can identify basic concepts and clauses and analyze them on a clause-by-clause basis. But Tiro analyzes everything logically as a coherent whole. So it can answer questions like, what are the parties' respective liability caps under a contract? Are there any carve-outs? Is this overridden by anything in the schedules? Because only with this deep level of analysis or lexical insight can the customer actually answer questions like, what is my exposure here and does it comply with my risk policies? Now, on the other point, on the flexibility of the output and giving our customers the ability to interact with their contracts in lots of different ways, we'll see some examples of that in the case studies shortly. But that's why we focus on that's why we serve large enterprise. We're going to start serving smaller, agile businesses later this year. So to give you a feel of the customers that we deal with, here's a case study of a typical customer. This is a large, advanced, global equipment and materials manufacturer. They operate globally. They have revenues of about $4 billion. So these guys see around 3,000 contracts every year. And with a central internal legal team of only really 2 contract specialists, you can imagine they had very little visibility over the contracts that are being signed. Most of the contracts are negotiated by the contract managers in each of the various divisions. So we introduced Tiro. We allowed the business managers to review their contracts using Tiro. And this meant that the internal legal team had complete visibility over their contracts that are being negotiated before they're signed, transforming risk management. And interestingly, with these guys, because it was done in collaboration with their insurance provider, it also has the potential to reduce their insurance premiums in future. Another example of a case study, this is another quite typical one. This is a major Japanese energy company. Now, we worked with their internal legal team again that included 4 English-speaking lawyers. Before using Tiro, the business team would send their English language routine commercial contracts to the lawyers who would review them. They'd take 4 to 5 days to get their results back, and they'd spend about 50% of this time on this mundane work. So we introduced Tiro. Tiro would do the review, and the final results would be checked over by one of the lawyers. and the results were transformational. The turnaround time to get the review back to the business was reduced to under 24 hours, and the lawyers were freed up to focus on more valuable strategic work. In terms of the bottom line, we saved 75% of the cost of this review. So here's our traction. We have 5 customers at the moment, all large global enterprises. We've got, ignore the pounds here, but we've got about 150K of annual revenues. We've got huge momentum at the moment. So we've grown 400% in the past 4 months. And the team is flat out on a pipeline of projects and pilots that we're working on. So we expect that to grow very quickly over the coming months. And the opportunity for growth is huge because the serviceable addressable market globally is over $100 billion here. So it is a vast and untapped market that we're playing in. So that's the end of the summary. At the end, we're looking at raising around $2 million. The money will primarily be used for our sales and marketing team, to hire a sales and marketing team, as well as to help push forward a large number of pilots that we're working on at the moment. So if you want to hear more, please come and speak to me. I know there's not a lot of time before the drinks. Maybe we can speak at the drinks or afterwards. Otherwise, please reach out virtually and love to get in touch. Thank you very much. Bye.
Fantastic. Thank you so much, Liam. So up next, we have Brad Smith, founder and CEO of Braaap Motorcycles.
Thank you for having me here today, and I appreciate you giving me your ear for 8 minutes, although many of you I've spoken to for longer than that already. So we're the Australian motorcycle company, and I'm coming to you guys today with an investment opportunity because I have a problem that we need a solution to, and that is that we have demand, we're profitable, we're an established business. I started it in 2005. But last year alone, we left over 10 million worth of sales on the table because we didn't have enough inventory. So we need to raise capital to put more inventory in our warehouses to capture our existing demand. In January this year, we had 1,200 orders in America that we couldn't fulfill. We had to pull back the orders and focus on our Australian business. So it's a good problem to have, but it is a problem. So I'm coming to you guys with an investment opportunity with 2 vehicles. We're raising a $10 million debt facility and a $2 million equity facility. So I'll get into sharing with you about who we are. Our current position is interesting in that we offer our customers incredibly good value motorcycles through the way we manufacture bikes. We've been able to give unmatched value to customers because we offer a bike at a super aggressive price point with high spec. The deal is that it's paid up front, it's direct to consumer, and we ask the customers to wait for us to build the bike. So we want to fix the wait times, and that will help us increase our sales as well. Like I said, we're profitable. I'm incredibly proud of that, and we're primed for growth and expansion. I'm going to share some of those ideas to you as well. Now, the most important thing to talk about to start with is the bike, because that's our masterpiece. Hopefully you've seen the bike out there, and I've sold a few bikes this week as well, actually. You guys are part of my target customer group. So, but the bike is our masterpiece, and the innovation for us is that we're the first electric motorcycle that's better value just because it's better value. Every other EV in the world is more expensive than its gasoline competitor, and you've got to bring your own theology or belief system on why you should buy an electric vehicle. We're just building the best value, happens to be electric. So for $5,000, you can have a full-size sports bike, you can ride to and from work, and obviously there's a lot of benefits of riding electric. We've already sold across our business since we've been established 10,000 motorcycles. For the electric model, we've sold 200 that get delivered in August. So we're starting the electric revolution, and our mission is to lead the mass adoption of electric motorcycling. Because again, every other EV or every other electric motorcycle is significantly more expensive than its gasoline competitor. So you'll see our bike, it looks awesome, it's full size, but at $5,000, you're in an electric bike. So that's a big push for us. I should also mention as well that we've got Euro 5 compliance and our US compliance as well. So we're ready to scale into these other regions. Obviously that's capital restricted, and we've had to really focus in on where our profitability's been with the resources we've had, which has been our Australian market. We're a highly awarded awarded company. We've been 4-time Australian Retail Business of the Year. We won the Census Social Responsibility Telstra Business Award. I've been named 2-time Australian Young Entrepreneur of the Year twice, but also something I'm very proud of is that in 2016 we had an incredible crisis, lots of media pressure, legal allegations from competitors. We navigated through that and we've built an incredibly robust business, and I'm an entrepreneur who has something to prove. That's why I'm coming to you guys. We really want to scale up and grow. So that's I think our team, my family and our investment group are really robust and primed for scalability. So 10,000 bikes on the road. We have a range of ICE bikes, internal combustion engine bikes, and as part of this capital raise, we want to electrify our whole fleet to offer more models of electric motorcycles. And again, ready to scale. Now I'm going to get into what we see as the future of motorcycling, but first I want to point out where we sit. Really, our brand, we know who we're not. We're not Tesla, we're not trying to build the fastest electric motorcycle, we're not Ducati, we're not trying to win MotoGP. We sit at the sweet spot between performance and price, so bang for buck. We're offering unmatched value to our customer, and that's really our whole ethos of our company. I started this thing in 2005 as a young man who wanted to make motorcycling accessible and affordable and make great bikes at super aggressive price points. So the future of motorcycling kind of leads in from that. We've got an opportunity at the moment at the intersection of technology and hardware. We've developed IoT devices and an app to put all of our motorcycles on the cloud. This brings us to an opportunity to pivot and be the only manufacturer that's vertically integrated in how we deliver to the consumer, because our customers, 24 to 44-year-old males predominantly, they don't own anything in the rest of their life. They don't own a DVD, they have a Netflix subscription. They don't own 50 grand worth of gym equipment, they go to Anytime Fitness and have a subscription. We believe that's a huge opportunity for us to pivot our motorcycles to a subscription offering. And it's unmatched value to the customer again, because no motorcyclist wants just one motorcycle. They want a dirt bike, a cruiser, a sports bike. We want to offer people to be a member of our shed or our ride club and have access to our fleet of motorcycles. We've got 50,000 motorcyclists in our database. We've skipped logic, surveyed them all, and we've presented a subscription offering that's ready to go to market. Apps developed, technology's developed, we're ready to go. We just need a fleet of bikes to do it. Now, this subscription model has come out of firstly studying the behaviours of our customer, and obviously the co-sharing, the membership economy is growing. But on top of that, we've got a huge problem that we need to fix, and that is that our customer thinks Afterpay. So they go to the e-commerce, any website, and they click pay in 4 payments, and there's no credit checks, there's no 1 week, put your pay slips in, give you a call, make sure that you have a good credit rating, all that type of stuff. It's an instant pay-as-you-go type thing. Now, the problem is that vehicles don't fit under Afterpay type legislation. Vehicle funding has its own credit code. Obviously, responsible lending is incredibly complex as well, where a subscription model allows us to offer the benefit to the customer of a low weekly payment plan, have access to the bikes, but keeps us outside of all of the compliance issues. So the problem for us has been that just last year, or even just last month, we had 220 of our riders want to get a finance product, want to buy a bike on finance, but Yamaha Finance and all of the major finance companies won't finance a pre-ordered motorcycle. All our bikes are pre-ordered, so they can't get consumer lending. Afterpay and that won't do it either. So we've got a problem with the consumer lending that we believe is a huge opportunity for us to move into subscription. There's over 10 million in sales that we would have captured just in the last 12 months from that alone. So this moves us to what we believe is the blockbuster movie moment of the motorcycle industry. At the moment, our competitors are profitable. Honda's a huge company. They've got an incredibly complex business model though. Manufacturer, distributor, dealer, lender, consumer, very fat. We believe that we can innovate this because ownership is a burden that we can remove through membership and subscription. So I've got plenty more to talk about. I've used up my 8 minutes, but the whole point I would like to do is to invite you to come out and chat to us. We're looking for people who can come on the journey with us. We already have a great crew of people. We have a great board. We've got the ex-CEO of Honda advising us, one of the general managers from a $1 billion lending book. We've got a great team around us, and we're looking for strategic and silent investors to help us fund the next phase of our growth. So thank you for listening, and we'll talk soon. Appreciate it.
Thank you, Brad. That was fantastic. Up next, we have Roy Jacobi, CEO of Tie Up Farming.
Hi everyone, my name is Roy and I'm from Tie Up Farming, and we are solving the fresh produce shortage by introducing farmers we're helping growers transition into the future of food production. A bit about our traction. We've seen more than 87% increase in our ARR, annual recurring revenue. We've got more than 35 paying customers, and we have interesting agreements with the likes of Elders and Woolies. So what is the problem? Today, farm data offers non-complete, fragmented, and a non-standardized view of the farm operation. So on the one side, we have some interesting solutions, like autonomous tractors, sensors, and so forth. But really what's happening on the fresh produce sector, we have a lot of manual work which is being managed by pen and paper, Excel spreadsheet, and specific software that does not talk to each other. So that caused the growers basically to be in the dark when it comes to making decisions about their yield, optimizing profitability, optimizing sustainability, and knowing basically what's happening. Introducing the solution, Tie Up Farming, cloud-based software solution dedicated only for the horticulture industry, fruit, vegetables, and nuts. It's an ERP system to manage the operation. We offer complete traceability, optimize sustainability, and increase profitability. How do we do that? We sit at the core of the farm's data. We aggregate and standardize all farm data into the one central place. We integrate into those specific solutions, and then we're using our proprietary software to digitize the whole farming operation. All those pieces of paper, Excel spreadsheets, everything goes into the one platform. And that is our secret sauce. Never seen before sets of data are being used to create an extremely granular profile of the farm financials health. And with that, we're helping them increase their profitability. And again, very important, increase their sustainability practices, improving their sustainability practices. Our vision moving forward, we want to actually create more tools like farm insurance and carbon sequestration monitoring. We're looking at a huge market, more than $7 trillion globally, and the current market in the US, Australia, and Mexico on digitization of farms in this sector, fresh produce, is estimated more than $2 billion and growing year by year. So yes, it is the least digitized industry in the world, but it has its benefits. We have 92% retention rate, which is very high. We've been around for the last 6 years. And the LTV is estimated in more than 15 years. So we've got a very experienced team. Myself, I grew up on a farm. We've got our CTO, Dr. Nazri, and notably our CEO, who came from a background of managing large farming operation. So today, we're looking to raise 2.5 million pre-A round, basically to scale. We've got product market fit, we've got paying customers, and we want to scale in Australia and start tipping our toes into the US. We'll finish up with
farming is a
short
really
video.
Powerful tool.
We need to capture costs ongoing throughout the growing season so that we're in a position to monitor what we're going to receive at the end of the year.
All the reports that you can generate are definitely auditable for Australian standards. So tie-up got all the data within the reports of whether it's a spray diary or other reports that you need that's going to pass an audit. And that's key. We've got to have reports generated out of tie-up that are auditable.
The ease of the app has been one of the key successes for us in the implementation of tie-up. It's been really easy to use very quickly, which is something we need.
So if you are into impact investing and you want to invest in something that having an impact today and scaling fast, please come and talk to us. We're at table 9. And thank you very much. That's it.
Brilliant. Thank you, Roy. Up next, we have Royce Crown, founder and CEO of Monarc Global, who will be joining us online.
I'm also the founder and CEO of Monarc Global. Monarc Global is automated real-time pricing for aircraft charter. This is everything that is non-scheduled in the general aviation space. I'll get them to do a slide, please. So our market globally is a $1.1 trillion market. That is made up of the entire aviation industry. Charter, which is non-scheduled aspect of aviation, is 40% of that $1.1 trillion. It is an industry that is very manual. It's Excel spreadsheets. It's pretty much what the last presentation said. It is a lot of systems that don't communicate with each other and don't actually produce real-time accurate pricing. Slide, please. The reason for this is that charter makes up so many other verticals. These verticals can extend to air freight and cargo, medevac, time-sensitive transport, which is a heart going from one hospital to the other, or much-needed equipment going from one hospital to the other. And these things are dictated by the customer. So even operators themselves do not have the capacity to generate real-time pricing ad hoc instantly when it's dictated by the customer. Slide, please. And this is where we come in, and this is our mission. Our mission has been to be able to provide charter aircraft provision to everyone, not just to the high net worth individuals who fly jets and helicopters, not just to the brokers who facilitate charter on a regular basis, but to everyone. And how we do this is by automating the charter first on behalf of the operator, giving them the technology in order to do so, giving them the ability to bring customers directly to their website and generate pricing that they can book instantaneously for their own fleet, but then also through our network of partners, aggregators and distribution networks. Slide, please. What we want to do is change how everyone views transport or travel today, from current experiences like you may see here to, next slide, the very luxurious flying on private aircraft. Now, I know most people are probably thinking it is way outside of budget to do so, but it's just not the case. You know, I've been in this industry for 26 years, and things have changed over these years, allowing more opportunity for everyone to fly private. A few examples is, even just Splendid on the Grass, we flew people in for, less than it would have cost to drive, from Toowoomba to Byron Bay. Backpackers from Gold Coast to Sydney, families from Cairns to Hamilton Island, and direct flights to be and less than economy seat pricing. These things exist. It's really got to do with accessibility, which is why we rely on our partners, our distribution partners, in order to distribute. And those distribution partners make up everyone who really never thought of private as an option as well. Next slide, please. Our growth has been extensive, and funding has been lax. But even without the proper funding, we have been growing very successfully since our inception in 2017. We were recently awarded the Deloitte fastest growing tech business in Australia by growing 6,339% over.
Sorry, Royce, the audio has cut out. If you could start again from slide 8. When the audio is back on, but it's not back on yet.
Can you hear me?
We can hear you now.
Oh, yes, perfect. Okay, so next slide, please. It's clear that even though Australia is a $1 billion charter market, passenger charter market, it's clear that the major advantages of this market are in the US, UK, and European markets, where private is more utilized and a far higher ratio of utilization. We do have plenty early adopters in the operator space as well as in the distribution space, with Expedia recently coming to us, but looking for a global product, which is where you guys will come in at the end of this presentation. Next slide, please. Our current partners here in Australia, very happy. Last time, actually, we pitched with a Wholesale Investor. We announced our MTA partnership with 460 plus travel agents, now having real-time accessibility to charter product for their customers. That's been going extremely well. We, after MTA, we brought on a 1,000-mile agency with another 80 plus agents, and recently just closed a deal with Hello World. So we've just, and their 13 brands. This is really exciting. This is bringing charter operations to those online travel agencies, where we do have plenty in the pipeline, have committed to utilize their service. Where we fall short as a company is really our internal assets. We have very few developers. We're a small team, and we are looking to expand that team so we can capitalize on these opportunities when they come in. Recently having to turn down Booking.com because they want a product in the global market in 6 months, which we could do if we had the assets on the ground. Unfortunately, we had to put them on hold, and that's really hard for a founder to do when the opportunities are there. At your reach, and you can't quite get there because of something as simple as money, really. Next slide, please. Aviation is obviously changing for the better. There are plenty of, I might have dropped that again. There are plenty of aircraft available to everyone, moving into the electric space, which is more cost effective and more sustainable in the global market, especially for those short haul trips. slide, please. It's horrible. Yeah.
Okay, I think we've lost Royce, but he is listed in the agenda. So if you are interested in reaching out about Monarc Global, please do so. His presentation is in there, and he will be happy to have a chat with you online. Thank you, Royce. Okay, so next up, we have our final panel session of the day. So I want to welcome to the stage everyone who's going to be talking about opportunities in private debt. So here today we have Chris Flavell from Aviator Capital, Ulrika Lobo, Director of Blue River Finance, Jeff Law from Commencer Capital, and Troy Harper from Aviation Capital.
I think we'll start with a quick roundtable introduction of who we are and which area of private debt that we come from. I'll kick things off. I'm Ulrika and I manage a first mortgage fund. We operate as a private lender in the market. We provide property-backed loans to businesses for various commercial purposes.
Hi, I'm Chris Flavell. I'm a managing partner, previously a director at Aviator Capital, but we've launched on the 1st of July a new company called Second Sphere Partners. So we're a partnership looking at capital raising for both companies. So we look at both debt and equity capital for growth companies.
Hi, I've got that right. Hi, Troy Harper. I'm with a director of Aviator Capital. We specialise mainly in mortgage finance, development finance to kind of small mid-tier companies.
I'm Jeff Law. I'm a fund manager at Commencer Capital. We're predominantly actually an equity fund. We run a VC fund for emerging companies. I do come from a debt background in my previous life, and in the current role, Commencer does originate debt and credit opportunities for a number of our distribution partners.
Great. So we've got our first question. In recent memory, investment has been relatively easy to come by due to the strong bull market we've been in. Now, as investment is drying up and becoming scarce, are you able to introduce us to the private debt space and your experience in it?
There's no doubt that as capital is more difficult to get for growth companies and any company really, just as you can see with the decline in the general market, share market, that new forms of capital are going to be critical to accessing and pushing out the requirements for any form of growth. And the interesting thing is just seeing the emergence of, for example, new fintechs who are doing revenue-based financing. So there is element finance, tractor finance. There's a whole new suite of fintechs that are coming out that are doing revenue-based financing. And the new funds, number of new credit funds that are coming to market through such as Commencer Capital's Jeff, but there is metrics. There's a whole raft of new debt opportunities that are going to be there, and looking to provide those for private companies.
Yeah, sure. And I think it's worth noting as well that debt is not a homogeneous space. You know, we get umbrellaed under private debt, but there's many different kinds of private debt. You've got private debt that's business loans, where we're not dealing with any assets. It's generally unsecured financing. They're higher risk, but they've got a higher return. You've got asset-backed funding, vehicles, equipment, and property. They have varying rates of return as well, depending on the quality of the assets that they're being secured by. And you've got bonds too.
Yeah.
Does anyone else have anything to add to a bit more information about the private debt space and their experience in it?
Sure, I'll jump in. Look, it's interesting. So we, again, in the construction space, you're seeing impacts of things that have seeded for quite some time. You've had, project lead times long, so you'll lock in financing. We're seeing the wealth of kind of increases in inflation and cost pricing. You're seeing projects being cancelled. But at the same stage, you also had a trend of particularly private lenders reducing their rates of return almost to directly compete with banks and things who'd retreated from the space. So if you're looking at, say, construction debt, that's come down from, maybe 8% to, if it was a good project, 5%. It's interesting. So some of these poor projects being washed out, you're seeing opportunities there, which were the opportunities in many respects to start with, which were work with quality tenants. But the demand for project financing is coming back, because I think you'll see, particularly as rates rise, you'll see reticence from larger lenders again to lend in certain spaces or to certain people or without certain, covenants. So, certainly in our space, in what we're seeing with other businesses, the demand from people for project financing coming private again is increasing quite significantly.
And the only thing I'd add, just a slightly different space that we operate in. We're probably more, not so much in the project space, but more in the highly structured, high-yielding corporate space. So some of the types of debt you talked about, but also that venture debt space where that sort of crosses over as well. We're definitely seeing opportunities there for increased debt. And some of it's for companies that haven't had debt before. For others, it's a chance to refinance some facilities they had in place previously that are now looking increasingly out of market for good and bad reasons. Some of them had equity raising covenants in there that are just very hard to meet and very dilutive in this market. So we're seeing opportunities to step in, take out some of those existing facilities, replace them with slightly longer term, not covenant light, but just sort of restructured facilities. We think makes a lot of sense for some of these startups.
Great. So question 2. Is it feasible for an investor to begin lending privately, and how does it compare to providing their capital to an investment firm for a fixed return?
There are several forms of, as there is syndicated deals for equity, there's syndicated deals for debt, but I think generally the highest growth sector of the market is funds, and there seems to be an emergence of a large number of debt funds and credit funds. Which is a good opportunity for the market to get higher yields, and as long as appropriate due diligence is done around the manager and what they're investing in, then those funds should be able to give superior returns, taking into account the risks that are in place. So going into a single deal is risky, going into a fund is risky unless you do due diligence on the manager and the depth of experience they've had. But both of those are, I think, legitimate strategies in the current market where rates are going up, and the sorts of rates you should be looking at now, it depends on the underlying asset base, but we see for growth companies, when we're putting deals together for the first debt that a company takes on board, a company quite often is willing to take on debt in the form of a convertible note or something like that at up to 10% or 15 high teens, which is far less dilutive than going out and raising equity at 25%, for example. So we put lots of names around them, but there are different forms of blended debt and debt and equity. There are venture debt funds, so parties like Partners for Growth or One Ventures or several of the large venture debt funds, and they provide a large chunk of debt and take a warrant, so an equity option on that as well, and that can defer or give you a longer runway before you need to go and do your next equity raise.
Yep, I also think, a lot of investors, particularly in property lending, do ask me that question, what's stopping me from going out and writing a deal myself instead of investing with a fund? And I think it's an interesting question because, yes, your first deal might be great because you've got something across the table, but is it going to be repeatable? Are you going to be able to do it over and over again? And the other thing is the experience if it doesn't go according to plan. How are you going to monitor the different aspects that might speak to, any warning signs or red flags that have come up throughout the loan, and how are you going to manage the downstream effect of that? So I would say that, for investors, when they're going about it on their own, it's a matter of weighing up all the options. How much experience do you have, moving to foreclose on a property, or managing legal teams and negotiating costs and processes involved, or even managing difficult borrowers and getting people to communicate with you, because that's something an investment firm takes away from your plate and gives you the return at the end of the day by managing all of these moving parts and these fluctuations throughout the whole deal. So I would say, yes, for a very experienced investor, it is possible to do this, but is it going to be repeatable? If you're not running it as a business, it's probably going to be less likely to have a success after success story. You might have one great success story, and that's great, but I think for repeatable outcomes and for managing various situations, it's great to go with an investment firm for that fixed return.
I think that's right, and I think also too the vector at which your client base comes from you when it's a one-off is really important. I mean, we started private lending out of our business before it was even really private lending, and you'd have friends who say, listen, I need money for this, or I need money for that. And that's when you're a one-off. That's kind of where you get some of these deals from. And so then you end up in situations where, exactly as you've outlined, are you taking somebody's house? Are you wandering into a friend's place and collecting the collateral that they've promised you? Those type of things. It gets sticky quickly, and unless you're out there sourcing, assessing deals as an investor, not as a friend or a referee, I think that's where you can potentially start to get into trouble. I think you actually have to treat it very clearly like an investment, dispassionate, and ideally your client base are not people that are known to you.
I've never got much to add to that, other than maybe access. You get a lot more access to transactions via going through a fund who's aggregating a pool of investors. As a lender, if you're putting out a smaller amount of money, it's hard to find transactions or companies that want to go through the cumbersome process of documenting a transaction for a smaller amount. So you get access to a larger number of deals.
What returns would an investor expect when lending in a private debt setting, and what are the risks associated with it?
How long is that piece of string?
It depends on the situation. So obviously, if you're going in as an individual into an individual deal, you can have a very wide set of returns. Everywhere from, if you've got some options for equity upside, you can have several times your money compared and lose it completely. So. It depends on the asset base that's being lent, how well it's been securitized, how well the documentation is, the process for working through any bad debts or deals that go wrong. So that's why you look at the track record of the fund manager if you're going to invest through a fund, or and look at the underlying assets that you know and understand and you're comfortable with.
And remember too that we don't go out as investors and say, hey, I want to get X. The pricing of debt in a lending scenario is meant to be a reflection of the risk. And so the higher the return, the more risky the loan is. So I think you have to kind of choose your return not based on what you want to get, but based on the amount of risk that you're prepared to adopt. And I think that kind of gets missed sometimes in the equation, because everyone's out there for the search for yield. But you can get to a certain point where you're taking on risks that you haven't acknowledged through the process for a payment which may well stop. So it comes down to that as well.
Yeah, and maybe just to expand a little bit on how we operate. I mentioned we have distribution partners, and they have access to a whole wide range of high net worth investors. So rather than having a single fund that they tip people's money into a range of opportunities, they'll approach that investor base every time there's a new opportunity. So they'll be aggregated with other investors who want to do those deals. We've arranged facilities for them as low as a straight 8% yield with no equity upside, and as high as 18% interest with warrants attached to it that provide quite a significant amount of equity upside. So a vast difference, obviously, and that's that additional risk that's been captured by those returns can come from a new sector, a lack of revenue, a new product, a different jurisdiction, a range of different things. So yeah, very, very diverse range out there. Even, we cap out at that sort of, high single digits. We're not looking at anything lower yielding than that, but there's obviously a world of loans that sit beneath that as well, that other funds are looking at and other banks are looking at.
I agree with Chris as well when he said that there's management risk and you've got to really look at the fund manager and assess that. I think that's the biggest risk. You've also got credit risk with different types of loans, depending on the security behind them and the structure. That means, are they going to be able to be repaid on time and without any losses? And if it does go over time, how are you going to recover any fees and charges and overdue interest that might have accumulated on that facility? I also think that there's a general expectation of where return lies. Generally, if you're going to a retail fund that does mortgage-backed securities, you're looking at 4 to 5% per annum. Private funds are usually 6% plus. If you're looking at second mortgage funds, you're starting at 12% per annum there. And then unsecured cash flow finance is generally 20% plus. But I have seen some, operators also charging cheaply for that, depending on the guarantees and the structures, at about 15% per annum too. But traditionally, I've seen more likely 24% per annum for unsecured business loans. So are there any little-known benefits of operating in this space rather than in more traditional markets? Little-known benefits. I imagine that means something that not everyone knows, but that we know. I have something to say on this one. I think a little-known benefit is how inefficient the private lending space can be, particularly in property lending. I made a comment on this in my presentation where you can charge 9% on a deal where someone else might offer 6% on the same deal. It's the same risk profile, the same structure, but it's a very asymmetric industry. It comes down to the comfort of the lender and also, what they can negotiate with the borrower more so than a perfect, efficient market where you can compare rates on a platform or in a market space or marketplace.
I'd agree with that. The interesting thing for me is just to look at the different forms of new investment that are starting to come out, as I said before, just these new cash flow lending and other specialist areas where, for example, for a SaaS company where somebody is going in and just willing to take over managed service contracts or software sales contracts, and they will pay out 12 months revenue or something like that. And these sorts of structures and the ability to do them very quickly and creatively, I think, are interesting. But the rates of interest are incredibly high. They tend to be, in terms of what's in the marketplace at the moment, in the order of sort of high teens or 20%. But when you compare it to the cost of equity and you compare the speed of execution and what that could mean to signing up a new large contract and what that can mean to a growth company, that's actually a very valid thing for them to do and basically can help them multiply their valuation X times because those sorts of companies are valued on a revenue multiple basis. So these are the sorts of individual pools, I think, of opportunities that are there if you know and understand those sorts of markets.
That's correct. I mean, we find the same in property. I think mispricing of debt is rife, and that's probably the little-known secret. Everyone has this view that, particularly if you go to a bank, that they're these enormous organisations that are all knowing. They're not. There's an ecosystem that exists, which is what we're in, very, very happily feeding very profitably off what they say no to. So it's refreshing to be able to make those decisions and actually assess something based on its merits without having the weight of an organisational position or an organisational strategy which may be out of kilter with what's actually happening in the market that you have to adhere to.
Perhaps just one last benefit that you may all be aware of, but certainly a lot of the deals and most of the deals we will structure will be, rather than having a fixed coupon, there'll be a link to BBSY or BBSW plus a margin, so you're getting that protection against rising rates, which can be quite useful in this sort of market.
For our founders here, what's the process to access private debt, and how long does the process typically take from inquiry to accessing the capital?
Specifically for founders and early stage companies, the big question is how soon can you get debt, and how soon can the company take debt on board without a personal guarantee, without you actually putting your own assets at risk. And that's a tough question. And sometimes, the risk that founders take on board is too much, and that's what leads to some burning out. And probably that's where the importance of having a good corporate advisor makes sense. So, so a gentle plug for getting as much advice as you can from advisors and taking that view before you go to that step. But then obviously taking debt on board is going to be cheaper than taking equity on board, and you need to always be looking at the next raise, which is of course why we're all here at Wholesale Investor.
I think it's also interesting. A lot of founders don't know what they don't know when it comes to options that are available in the market. It's a space that's being innovated all the time. There are different debt options, different players, different pricing across the board. I think the best thing to do is to speak to a broker that understands the space and understands your business structure, so they can point you to the best way to structure the debt that's going to be good, not just for controlling your business and managing the lender, but also from a price perspective.
And it's a document-driven business when it comes to actually, compliance and getting the loan put together. So the quicker, particularly in the property space, the quicker that you're able to, and it gets back to your point of saying using the right advisors, using the right brokers, the quicker you can put all of the information required into a format which is easily accessible, can be verified, and then put into the legal documents and documented, that really kind of drives just how long it takes to actually get your loan complete. And so, some people are really organised, have done the process before, they know it might be a couple of weeks, and you'll have people, we've seen brokers who, 6, 8, 10 weeks later, you're still asking them to put the same things together. So, that's the sort of thing that you want to avoid, but it really depends on, in many respects, how well you're advised.
Yeah, on the time it takes to put these things together, absent using a broker, in a bizarre way, it's the larger, lower yielding deals that take longer. Because the lender is going to take longer to get comfortable with the business that they're actually backing or the project that they're backing. There's a lot more diligence to be done, if there's a lot more history to get through. If it's a relatively newer company and they're giving up more for it, there's a much higher risk involved, there's probably less diligence to be done, and those deals can actually be done a little quicker. So it's a little bit perverse the way that might work. We certainly aim to get through deals from start to finish in sort of 6 to 8 weeks. But yeah, it can be very different for different companies.
I have a spicy question. It is, where does everyone think interest rates are going to be in 3 months and then in 1 year's time? Does anyone want to go first? Stick their neck out.
Well, 6%, I think, inflation was the print today, year on year, another 1.8, so that'll be another 50 basis points, I would say, out of that. Could be another of that again, I would have thought. I think there's still room to go from where we are now. But I'm no economist.
Mm-hmm.
Look, there was an opinion put out by, and I'll borrow somebody else's opinion for a bit, but it's mine too. Macquarie, one of their leading guys, put out an opinion saying that we'll see rapid rises and then we'll get to a point at which it will either stabilise. Because there's a lag with all of these things, the old economist description that you're driving the car, but looking in the rearview mirror, not out of the windscreen, because you're checking what's happened. You're not in real time what's happening going forwards. I think it's very true. You're going to find there's going to be a lag. You'll see increases. I think you're right. I think we've got another 50 basis point increase coming, possibly at least another 50 coming after that, maybe in 2 rises rather than one big one. But at a certain point, the other factor in all of this is that you've got the biggest users of bank refinance have been fixed rate loans. And most of the $120 billion finance facility that the federal government gave to banks during COVID to keep them afloat was what had went out and funded fixed rate loans. And that's why you've seen fixed rate loans so cheap historically, they've never been that cheap. It's because they'll be backing it with the money they were getting from the Fed, and then they were offering a fixed term. So that all expires 2024. So you'll really start to see pain in the mortgage market the end of 2023 coming into 2024. So I suspect at that stage we'll probably see some decrease, an adjustment down in the rate, because they may have got the settings too high too quick. And bearing in mind that the inflation we've got is exogenous. Everyone says, there's too much demand in the system. Yes, partly, but most of it, shipping containers had gone from, it'd gone up fourfold during COVID, possibly more in cases. You simply couldn't get, people were saying, I will pay you to put my container on first, rather than take what you've already contracted. So that a lot of that inflation was exogenous. It wasn't driven by demand. It was driven by supply chain problems and people trying to complete things. So I think there's a fair chance that they'll overshoot, and we may well see an adjustment down, late 2023.
Yep, I think that you're right. There were a lot of supply chain issues that have led to our expectations of where inflation is going to be, along with, the misguidance almost of the forward guidance of the RBA saying the rates were going to stay the same until 2024. Everyone locked in their contracts, but now, with having that cash rate so low, that has almost been an impossible promise. I don't think he could have made that promise just because of the entanglement between international markets and central bank objectives. The interest rate was always going to go up, and depending on international conditions, it would have been before 2024. There's just no way you could keep it that low for that long without affecting the Australian dollar and then having many, many downstream effects and issues for inflation. So, the prediction is that inflation is going to be at about 3.5%. I think with the expectation that we're going to have many more rate rises moving forward, that rapid increase of inflation is actually almost going to create an overreaction in the market in the short to medium term before it then stabilizes. So I think in 3 months, Troy's right, there's going to be probably 2 more 50 basis points increases, and then there might be steady increases after that based on how the economy has responded to it. And in 1 year's time, we're in our lowest cash rate environment ever. It's unprecedented. There were times when having 5%, 6% interest rates was normal. Having 8%, 9% interest rates was just normal from the banks. And I think we might see some of those 7s and 8s come into play next year, but I hope not.
I suspect we will. I think the artificiality that we had when we had all of the reserve banks around the world pumping extra money into the economies, and the amount of money they pumped in led to significant asset price inflation, significantly lower interest rates than we'd seen in decades. And so what you were describing is actually more normal. I've lived through interest rates, up in the 20s, mortgage rates in the high teens, and I don't expect that to happen again. But I do expect rates to normalise, and that will have the interesting thing for founders and for outlook for those who've participated in the markets over the last couple of years, is that's going to lead to a significant change in valuation bases for operational companies. The numbers that have been out there for a long time, and you can see it in public markets. You can see what's happened to all of the high growth companies, how hard they've been hit. And what that means it's not about the cost of the capital, it's not about the cost of interest, it's actually about access to capital. So for growth companies and for young companies, it's about how do we actually go about getting capital now, be that debt capital or guarantee, with using personal guarantees or small equity raises, and how do we shape that to what our future capital requirements are to meet our growth targets, to be able to meet our business building scenario that we're looking for the new unicorn that we're trying to put together.
Well, I think, does anyone have anything else they'd like to add before we wrap everything up? Great. I think we'll wrap it up here. We've come to the end of our session. Thank you to all the panelists for sharing your thoughts, and I hope everyone has something that they can take away and make decisions on the back of. If you'd like to know more, please come and grab one of us afterwards. We'd be more than happy to chat to you. Thank you.
Oh, look at that. I think they're the only panel session that finished with 2 minutes to spare, or is that my timing? All right, thank you so much, everyone. Thank you so much to the panelists. And look, it's been an incredible last 3 days. And obviously, when you put on a 3-day conference, you're always worried about attendance, you're worried about energy flow and all that sort of stuff. And as I said at the start of the day, the thing that you never have to worry about is how many people show up for the drinks at the end. So, on that note, thank you again for everyone. As you probably know, we're very passionate about what we do. We work incredibly hard at it, whether it be from the software perspective, whether it be from the event perspective. How we grow is by people introducing other groups to us. We work incredibly hard, not just across Australia, but in 3 weeks' time, we've got this event in Singapore. 2 weeks ago, we did this event in London, where we had something like, I think it was like 150 to 200 turnout in London. And I said, innovation is global, the opportunity is global. Everything that we want to do is try and help companies not just raise capital here or build strategic or commercial partners here, but also do it in other countries as well. And you guys play a long way of doing that. As I said, it's always fascinating how these conversations play out over the next few years. People that you meet today, you may find you'll be doing deals with 6, 12, 18 months from now in different ways, or maybe in that same business, or helping them expand into new markets. I said it's incredibly powerful, the network effect that goes along with the work with the work and with the platform that we've built with WI. So on that note, thank you so much for your support over the last 3 days. Now, feel free to go out, chat, drink, enjoy. It will be on the balcony area is where we're going to go. I think it actually kicks off technically at like 4 o'clock. I could be wrong on that, but so we've got a little bit of time. But yeah, feel free to have final conversations with the companies that are outside. And then, drinks and networking will kick off at 4. So thank you very much.